8 a.m. in Singapore, 9 a.m. in Tokyo. I'm Sri Jagaraja in Singapore, Japan, and the South Korean market's just coming online. Let's bring you the headlines this Friday morning. Asia getting a negative lead from a slump on Wall Street after 3 sessions of gains, led by the Nasdaq. US futures, though, not providing a great deal of direction ahead of key US inflation data. November CPI that hits tonight. Broadcom shares surging after the bell after an earnings beat and a $10 billion share buyback. And the renminbi weakening sharply after China's central bank moves to slow the currency's recent strength. Right, so we are keying off a wobble on Wall Street ahead of November CPI. Could be hotter than expected. That is the fear. But if we do see that, that has implications, of course, for the Fed, which meets next week. Japan and South Korea, with that, have joined the trading day. Nikkei off by about 135 points. Looks relatively contained at the get-go. Similar story for the Kospi. Actually, the Kospi, the losses there at the early open, a little bit more pronounced, off by 0.8%. Australia is out of the money, down by 26 points there. Right, let's bring it back to China. An offshore renminbi weakening sharply after the Chinese central bank raised the foreign exchange reserve requirement ratio for financial institutions. Sam Vadas joins us with the details, and they are not comfortable with the level of the renminbi and what that does to exports.
Yeah, exactly. It appears so, Sri. So the PBOC now raising that FX triple R from 7 to 9%. There had been some expectation that we could see authorities actually stepping in to rein in the recent, I should say, strengthening of the yuan. So this is what a lot of people are interpreting this move by the PBOC really is an effort now to try to, rein in the strength of the currency, as they do seem to be largely uncomfortable with its rapid rise lately. This did apparently catch some traders off guard, as perhaps they thought the authorities were a little bit more comfortable with this and had a higher tolerance. But this is also to crack down on any sort of speculation. So these banks and financial institutions will now have to hold more in foreign exchange in reserves. This will, like the recent triple R cut, take effect from December the 15th on Wednesday. And this is actually the second time we've seen the PBOC actually doing this. The first time was back in May, and it does come as we have seen certainly the Chinese currency rising more than 2% against the greenback since the middle of the year. In trade-weighted terms, when it comes to that CFETS basket, it's hit its strongest level since 2015. And as Sri suggested there, really we have seen what that has done to exports, particularly in the month of November. That has largely driven this economic recovery over the last year or so. So authorities are probably not comfortable with one of the bright spots in this economic recovery being impacted by the strengthening yuan. So really, this is widely being seen as intended to slow things down now, as a strengthening yuan may not be so good for the Chinese economy. So one factor that could be behind this is, of course, the strong appetite we've seen in terms of foreign investment into these Chinese government bonds. Data has shown that this has risen at its fastest pace in 10 months in November, actually to a record high. And this came after those Chinese government bonds were included in the FTSE Russell's World Government Bond Index. That was expected to pump $130 billion worth of foreign inflows into the bonds over the 3-year period. But this comes even as investor sentiment has been largely dented recently over some of these investor concerns, largely about these liquidity concerns in the Chinese property market. But we are seeing those high yield bond spreads, Sri, being narrowing as investors do seem to be sort of hopeful that that situation will be kept under control. And we have heard the PBOC governor reiterating that as well. Right.
And in terms of outright levels, we had Swan Tetkin from UAB saying that perhaps the authorities favour dollar China in the realm of 640, 650. I wonder if this latest set of measures is going to get us there. Yeah. Sam, thank you for that. Right, Broadcom shares surging after hours after an earnings beat and a $10 billion share buyback. Always fun for investors. Will Caloris has been covering the earnings. And Will, what did Broadcom have to say about all these supply chain disruptions? And does it have pricing power?
They very much indeed do have pricing power. This is why they've actually managed to have such a strong set of numbers that the cost inflation hasn't necessarily been an issue for them in that respect. But there continues to be, and we touched on this a little bit with Ruben earlier, there continues to be supply chain issues to some extent for Broadcom, and it's all centered around their customers, and they're trying to really mitigate the issues because obviously we're dealing with this global chip shortage, if you like, and they're trying to ensure and maintain the fact that they don't necessarily send out their product to their end users who are clamoring for demand only for it not to be utilized because of their extensive backlog. They're basically suggesting that flows all the way through potentially into the middle of 2023. They've got like a 15-week lead time to actually get their product out to customers at the same time. So all of this just builds on top of the already shortage that we do have when it does come to semis. But there was a lot of other stuff in relating to their performance that wasn't necessarily about the beat, not necessarily about the dividend or the buybacks that they are going to be providing to investors, because they're basically also suggesting that now is the time for them to be investing far more heavily than they were previously. They're expecting their Q1 OPEX to be higher, Q2 OPEX to be higher. And basically what Hock was saying is that they want to start investing in R&D significantly now, and particularly because it's with a mind to 2023, 2024, and they still expect that demand to remain strong for their products, but they want to have new offerings. They want to out-invest all of their competitors. They want to ensure that their offerings are going to be at the top tier moving forward, and that's obviously also being reflected in, I suppose, the strong performance they've been seeing as well, Sri.
Yeah, and some stunning cash flow as well, free cash flow. So if it does mean they've got the war chest for acquisitions, then what's the follow-up to the buyout of CA and Symantec's enterprise security business? What's next on the horizon then?
This is where it gets very interesting as well, because, you know, they don't invest in semis anymore. We had Stacey Ragson on from Bernstein with our colleagues over in the US on Closing Bell. He's basically saying all they're eyeing is software companies. And he actually suggested in terms of the buybacks being given and the prospect of M&A, because usually they'd have half M&A, half dividend split. But he's happy with the buybacks coming, but he's also incredibly happy with them investing in M&A because they're really, really good at it, was his words basically. And I actually had a chance to ask Ruben, because we didn't have time in the interview, what his picks were for that M&A prospectivity. I suppose I just invented a word. He said Micro Focus is one that has come up quite a bit. There was obviously that they did spend a lot of time looking at SAS Institute. This is a company that's not listed. And he actually mentioned two other potential private equity owned businesses like BMC or Click. I'm not sure how to say that, Sri, that they could be potentially eyeing as well. But across the board, the analysts think that it's going to be software. If they are going to dive back into M&A, Hock did say that he hasn't ruled out a deal for 2022, but it's just not going to be in the semi space because they're basically overexposed in that respect. And it does obviously bring up the issue, Sri, that if they were to buy up a semi company, if antitrust starts to factor into it.
Well, don't want to be a wet blanket, but Hock Tan also flagged and has been flagging decelerating smartphone growth as well, hasn't he? And I wonder if that's a reason to be cautious, or whether he's just managing expectations. Just wanted to put it out there. Wet blanket, I know. Will, thank you very much indeed for that. Right, shares of Oracle solidly in the green after hours following beats for revenue and earnings in its second quarter. Julia Boston breaks down the numbers.
Oracle shares shooting higher on better than expected top and bottom line results. The company's biggest division, Cloud Services, grew its revenue 6%, and the company authorized a $10 billion increase in share repurchases. The stock spiked further during the earnings call after CEO Safra Catz said that revenue growth will accelerate. She guided to 6% to 8% fiscal third quarter revenue growth in common currency. She also guided to a fiscal third quarter earnings range that was ahead of the midpoint of analyst expectations. She said that the full year revenue for the fiscal year will finish solidly in the mid-single digit growth. Catz saying that they expect cloud revenue to accelerate further and exit the fiscal year in the mid 20% range, potentially higher. She said that cloud is a more profitable business than their on-premise services, and that therefore their margins will be better than pre-pandemic levels. And she explained this success as being because Oracle has a highly differentiated strategy from their competitors. She said they're the only company that's able to offer the combination of applications and infrastructure. Julia Boorstin, CNBC Business News, Los Angeles.
Coming up next, as the future looks almost certain to include high interest rates, we'll ask our next guest where the investing opportunities lie next year. Nomura's Asia Pac equity strategist Chetan Seth joins us in a few minutes. And as we tail into a break, we'll leave you with a look at the early winners and the losers in Tokyo, about 10 minutes into trade. We're right back.
It's so easy to sell on.
Welcome back. Asian markets are inheriting some softness on Wall Street overnight as we move closer towards the inflation numbers. November CPI drops later on stateside, expected to be hot. That has implications for the Fed, of course, and the taper tightening timeline, and whether it'll underscore the hawkish pivot. With that, Nikkei 225 off just marginally by about 80 points. Cost speed down by almost 1%. That's the loss leader at the moment. And the S&P ASX 200 benchmark in Sydney down by 26 points. So cautious, but losses relatively contained. Right, so where do we go from here in terms of positioning allocation in Asian markets in 2022? Let's bring in Chetan Seth, Asia Pacific Equity Strategist at Nomura, joins us live from here in Singapore. Chetan, always good to see you. You're expecting double-digit returns in 2022. How are you so constructive? Hi, Chetan, can you hear me okay?
Yes, I can hear you now. Sorry, I lost you. So yes,
No worries.
We are quite constructive for 2022. As we said, 18% returns, but you have to put this number in a bit of a perspective, right? If we are right with our assessment that we move 18% higher, we would still be around 4 to 5% below the peak that we saw for Asia equities in February of this year. The fact of the matter is that we've seen a pretty significant derating in valuation multiples, specifically in China, because of all sorts of issues, whether it's credit concerns, whether it's clamped down on property sector, whether it's clamped down on some of these education, internet, e-commerce sectors. So that's where 18% is coming from, and obviously that call is predominantly dependent on our view that probably you will see China outperform in the coming year in 2022. I would also highlight here is that while we have a constructive full year view, we are also expecting some bit of volatility going into the first quarter of 2022.
What makes you think China is going to outperform in 2022 when you have these macroeconomic headwinds blowing so hard?
So I think this was largely a story of 2021. So we had pretty weak macro. There were obviously lots of regulatory issues we faced for Chinese stocks in particular. But going forward, the house view we have is that most likely you will see a bottoming out of GDP growth in China in first quarter of 2022. We are already seeing some evidence that policy on the margin is getting easier. If you go back and look at what generally moves the stock markets in China, whether it's domestic A shares or H shares, policy settings are quite important. So all this while policy was tightened, but now there are tentative signs that policy is getting easier. And as I said, Chinese stocks have derated from around 18.5 times to now around 12.5, 13 times for 16% earnings CAGR for next 2 years. Now that earnings will probably come down a bit more, but that to me sounds like pretty attractive risk reward.
Are you also basing that off expectations that the property developers and the stress that we've seen in high yield, we've seen the worst of it and the sector is going to stabilize?
I think we can safely say that the sector will eventually stabilize. Whether are we at the extreme bottom? I cannot say that. But I think, the issues around Evergrande has been well flagged, well known. There was yesterday a formal default that was reported yesterday. But if you look at the reaction in stock market, or let's say even currency, there wasn't much reaction. So you could say that eventually the worst will get behind us. Whether we are at the worst point already, don't know.
Elevated volatility, you say, will favor defensives into Q1 2022. Chetan, are you basing that on the hawkish Fed pivot and how we're going to manage that out here in risk assets in Asia?
That is correct. So I think the inflation number in US is quite important today. As a house, we are expecting that number will probably come higher than the consensus expectations. Remember, the consensus expectations is already expecting for a big core CPI number today. Now, if that's true, I think you could see some bit of repricing in financial markets. The view that Fed may have to turn more hawkish will probably gain pace. And if that's the case, you could see some bit of weakness in stocks. One of the things we've shown in our report is that if you go and look at some of the previous rate hike cycles, whether it's basically keeping Fed as your base, what typically happens, Sri, is that stocks tend to derate, in terms of valuation multiples, 6 to 9 months ahead of the first Fed rate hike cycle, first Fed rate hike. Our view is September is the first Fed rate hike. And if you just tie in together this with the view that China probably bottoms in 1Q, it seems to us that probably as we go into 1Q, there will be volatility. But beyond that, as things stabilize, US inflation softens, China data gets better, policy gets easier, some of the rate hike expectations get priced out, I think it will be a better backdrop for stocks.
India is emerging out of the pandemic, and there are hopes for a benign Omicron outcome. And I know the RBI is paying close attention to that and the implications for growth domestically. Can you walk us through why you're neutral India?
So most of this year, we were actually overweight on India. We upgraded the market back in Feb 2021 when we were a bit worried about exuberance in North Asia, specifically China, Korea. We actually downgraded India equities like a month ago. And one of the major reasons for our downgrade was valuations, right? On top of valuations, if you look at where our neutral call currently is coming for India is that I think inflation will probably turn out to be more stickier. As a house, we are expecting 100 bips of policy hikes in 2022. If that's true, you could potentially see RBI the most hawkish bank in Asia. So, higher policy rates, valuation support not there, some bit of risk around the Omicron variant. I know RBI is basically saying benign. It just feels that you want to be a bit neutral on stocks. Remember, Indian equities are now trading around 16 to 17% higher than the pre-pandemic valuation multiples. So if you compare this with other Asian markets, the valuation multiples today across Asia are the highest. in India relative to pre-pandemic levels. So we want to be neutral. Medium term, I do like the story, and we hope that we can find a better entry point to get constructive once again on India equities.
Chetan, on that note, we have to leave it there. So always good to catch up with you. Thank you very much indeed for those insights. Chetan Seth there from Nomura. Right, shares of Brazilian digital bank Nubank surging on its first day of trade after raising nearly $3 billion in its US IPO. After the break, we'll hear from the company's CEO, David Velez, about the fintech's path to profitability and how it plans to outperform the competition in Latin America.
Every patient that walks in
Welcome back. Shares of Brazilian digital bank Nubank surging in its US market debut. CEO David Velez joined our US colleagues ahead of the fintech's market debut to discuss LATAM's market potential and the competition.
We were growing very fast up to the pandemic, but people still had some questions about digital banking. I think the concept of saving your money in a digital bank, in a bank without branches, was scary for still a lot of people. They wanted still to go to a banking branch, talk to a banking manager. The pandemic, in a way, forced that behavior change among the most of the population because branches were closed. And so it wasn't even an option. And people start trying us, and they realized that it was a better option. We charge no fees, better customer experience, all in your smartphone. And suddenly we start seeing people in their 60s, in their 70s, in their 80s, people across the entire Brazil, all different municipalities in the north, in the south, using us. And when they started to use the product, they never went back. It was clearly a superior product. They liked our experience, and that has really accelerated kind of the growth. We now see that growth accelerating for us and are very excited to have a platform for effectively all Brazilians and Mexicans and Colombians, where we are as well.
Right. David, your customer acquisition cost right now is quite low. $5 a customer, I think, by the latest numbers that I saw. Is that going to change over time? I mean, you're looking at a lot of customers who are just coming in organically, and that's great. But at some point, I imagine as you grow, there will be an upper limit at which you're going to have to start to pay to try to bring more customers in.
Yeah, I think it's like a couple of things are happening at the same time. On the one end, there might be a little bit more competition, but on the other end, there is just much more supply of customers. Customers are now seeing this as the real option for banking. And so all these trends are playing at the same time. Net for us, we have not seen any change at all in our CAC, even after getting to almost 48 million customers, which would put us at one of the largest financial institutions in Latin America in terms of number of customers. So it is possible that at some point that happens, but we're also adding more products, adding more verticals, and ultimately having a better value proposition.
You mentioned competition, and there are sort of two fronts coming at you. Others that are trying to effectively ape what you're doing, meaning digital-only banks that are trying to compete with you, and the traditional banks, the legacy players who are desperate to try to both keep their customers, if not grow.
Yeah, no, that's right. So on both ends, there's competition. Ultimately, though, most of the customers are still in the big banks, and they end up having most of the 80 to 90% of the concentration of the system. But listen, the market is so large, and there is so much opportunity to make it bigger, because still there's over 200 million people in Latin America that have no access to banking. They're still putting their cash inside their mattress. So ultimately, over the next 5-10 years, that market should expand significantly, and there is a lot of space for a lot of people to grow and take share, and ultimately make a much more interesting market for everybody.
The business, as we said, is growing like a weed, yet losses persist. $99 million loss for the first 9 months, ended through September. Speak to the path to profitability and what that looks like.
Sure. So we were actually profitable already in our core bank in Brazil. We started generating cash in 2018. So we're one of the few big startups that I know of that in year 4 they were cash flow positive and generating real profits in their core market. We obviously see a huge opportunity ahead over the next 10, 20 years, and we want to reinvest all those profits back into growth. So a lot of those profits and the capital we're raising in the IPO are going for new markets in Mexico and Colombia, where we will continue to prioritize growth. There is a lot of customers to serve, a lot of products to launch, and we ultimately think that we should continue to be focused on growth, obviously while looking at very disciplined investments across the entire company.
In other stories, Meta, formerly Facebook, has launched a pilot program in the US, allowing its cryptocurrency wallet, Novi, to send and receive money through WhatsApp. The social media giant making assurances it will not change the messaging app's text and call privacy settings even before its rebrand to Meta. Facebook had been working on the wallet app for several months, but it scaled back its global plans for a digital currency called Diem, citing regulatory concerns. General Motors has struck a deal with American companies MP Materials and Vacuum Schmelz for its rare earth magnet needs. The company will use the materials sourced in the US for electric vehicle manufacturing. Shares of GM were down on the news, but MP ended the day in the green. The deal marks the first time the vehicle manufacturer has approached American companies for its rare earth magnet needs, amid a push from the Biden administration to reduce reliance on China. Coming up, airlines feeling a slump after the Omicron variant of COVID-19 hit travel plans, but Booking.com says travelers will eventually want more, not less, from their trips. Friday morning on Squawk Box, let's take a look at the markets, and they are a little bit soggy actually after that lead in that we got from Wall Street. So the markets a little bit nervous actually just ahead of the CPI number for the month of November. But is it really going to tell us anything that we already know about inflation running hot and the hawkish pivot at the Fed? But anyway, the markets seemingly set to absorb a hot CPI number. Nikkei 225 off by 125 points. The Kospi is the loss leader, down by almost 1%. S&P ASX 200 off by just 24 points. In the meantime, Hong Kong and the China markets join us in just under an hour's time. We'll continue, of course, to watch developments among the Chinese property giants Evergrande and Kaiser, which were placed on restricted default by Fitch after missing payments. The companies themselves have not yet declared default, though. The PBOC Governor Yi Gang, though, promised to protect Evergrande shareholders and creditors.
This is a market event. It should be handled in a market-oriented way based on law. The rights and the interest of creditors and shareholders will be fully respected in accordance with their legal seniorities.
Switching gears now, although the Omicron virus mutation has dampened people's travel plans, Booking.com says it's optimistic that travelers will continue to want more, not less, from trips in the future, while recognizing that the road to recovery for travel will be a bumpy one. According to Booking.com, travelers have embraced the unpredictable. The company says people want reassurances that they won't lose money and the ability to cancel and reschedule during these uncertain times, don't we all? Right, let's bring in Laura Holsworth now, MD Asia Pacific at Booking.com. She joins us live from here in Singapore. Laura, great to see you. First of all, let's get this out of the way first. Is Omicron changing travel trends in the short term in any discernible way?
I assure you. I think it is certainly having an impact, but we see it much more as a bump. We are very cautiously optimistic as you mentioned, we very much see that there is pent-up demand for travel. I think right now it has caused more of a concern in people's confidence to travel. The corridors in Asia have not slowed down, have not stopped, apart from we've seen some restrictions coming into Japan. But no, we see right now it's a cautionary area. And of course, any new variant is a cause for concern until proven otherwise. But we still see the demand is there. And as we come up to the peak travel season, we are also still seeing that travel is there and is happening.
No, absolutely. I think you're spot on there. As long as those travel lanes stay open, that's the critical thing, isn't it? Now, you mentioned pent-up demand, Laura. All this COVID burnout is going to be released now that travel is opening up. So what are bookings telling you about that demand this holiday season?
You know, what we see very clearly is where the opportunity is where people are going. In the past, you may have just taken your trip entirely dependent on where you wanted to go, where you needed to be, where your family was. Now it is a lot more opportunistic based on corridors that are open, avenues that are available to you. So if you think about Singapore, we now have the 18 VTLs open, and our bookings are very clear for November. Germany, Malaysia, Switzerland, France, the UK all topped our bookings. So again, it is where people can go, they are. And again, that goes back to our view that the demand is there and people will take it as soon as the opportunity is available to them.
And just for this region, Laura, do you have any insight or what are forward bookings telling you about the Chinese travel market as Lunar New Year approaches? Is the year of the water tiger waiting to pounce?
Well, as we see for China, they're keeping their borders very much closed for now. There is no indication when they will open. And so we are seeing heavy amount of domestic bookings for China. The internal domestic market has not slowed with China, apart from when they have cases, they do make severe lockdowns. And that takes a short bump again in the road of the recovery. But domestic travel in China is very much there. But we are not seeing, obviously, the outbound that we would normally, or the inbound into China at this stage. So, and we're waiting to see, I think, with the rest.
No, I think that's such a critical component of the global market, isn't it? The outbound Chinese traveler. it's not going to come back anytime soon, Laura. I mean, what's your outlook there? Because it's such a critical component of the broader market.
It is, but I think we've seen, it's been going on now for quite some time, and I think we've seen so much domestic travel in all countries that the reliance on inbound has also shifted. But as we can see from the corridors that do open, travelers do take them, but very much travelers are traveling domestically. I think that comes with also an abundance of caution for their own safety, where they feel comfortable, but obviously also it's opportunistic of what's available to them. So I think countries that were typically reliant on China travelers would still obviously like them to be coming in, but at this stage are getting a lot of demand from their own domestic markets.
Laura, how would you characterize the pricing environment looking into 2022?
What, sorry, Sheree, the pricing?
The pricing environment, yes, for travel, whether it's hospitality or whether it's airlines.
Yeah, I think we're seeing a shift. I mean, there's a lot more friction in travel these days, whether it is testing, quarantines, particularly a lot of frequent testing. This obviously increases the price of travel and causes additional friction that we've always been trying to remove. I think we will see that hopefully simplify and also the costs start to reduce. But I think that there's very much a desire for travel, even in our travel predictions. You mentioned one earlier that we see that travelers want to be cautious of their spending, but also are very keen to take trips that they can. So we see this desire to say yes to every opportunity, but they want the reassurance that they will not lose money. So flexibility is critical. And we at Booking.com are obviously trying to support that with our platform to make sure that our customers are getting what they need, but also our hotel partners are getting their ability to rebuild their businesses.
And Laura, just can we end by giving us a line on the outlook for corporate and business travel, which has been hollowed out to a large degree because of this pandemic and the rise of video conferencing? Is it poised for any kind of tentative recovery?
I think definitely. It will be slower than leisure. People are taking the opportunity to go back to visit travel, things that they've missed, visit family, and things that they've missed. So leisure definitely is leading the way in recovery. But I do feel very optimistic that business travel will also recover a slightly slower rate, and maybe not the trips that we would have seen other side of the world for one meeting. Those days may be a little behind us, but I'm very optimistic that companies still need to get together. Companies still need to see their customers, their partners, and we are seeing that in our bookings. And also, even just on a trip I recently took, I sat next to a gentleman coming into Singapore from Germany for a 2-day trip. Because he was taking his first opportunity to get back together with his customers. So that also gave me a lot of optimism.
Absolutely, and optimism, of course, for the MICE sector here and the conference sector here in Singapore, which is a big plank of the services economy. Laura, we'll leave it there. Thank you very much indeed for those insights. Laura Holdsworth, Managing Director, Asia Pacific of Booking.com. Right, coming up next, an exclusive interview with the European Commissioner for Competition, Margrethe Vestager, talking about where she's currently focused on in the antitrust battle with big tech. That conversation coming up next.
Why are so many
Right, so early hours, but let's take a look at US futures for its worth. It looks as though it's going to be a somewhat softer, cautious start just ahead of US CPI. Month of November, core number is going to be critical. We're expecting some hotter inflation numbers, but to all intents and purposes, the market already knows that. And depending on just how hot those numbers are, it will have some implications perhaps for the Fed and the FOMC next week, which is critical. Right, kicking off trade in Asia on the back of declines on Wall Street. As we said, it was a softer session led lower by the Nasdaq, down by 1.7%, and traders staying on the sidelines as attention turns to inflation data due out later today that's likely to give us more clues on just how fast the Fed will taper and how soon they could hike interest rates. In the meantime, the results of the latest All America survey giving a snapshot of Americans' sentiment about the economy right now. Steve Leisman has the details.
Americans head into the holiday season downbeat on the economy, but upbeat on spending. 41% of Americans believe the economy will get worse in the next year. It's a modest improvement from last quarter, but still far from normal levels of around 30% and down from a year ago. The number is driven by highly partisan split, with 67% of Republicans pessimistic compared to just 16% of Democrats. Now, those negative views come as inflation has rocketed to the top of the list of concerns among the public. The survey of 800 Americans nationwide finding 43% saying higher prices is one of their biggest concerns. That compares to 38% who say it's the coronavirus. And views on the stock market remain pessimistic at just 33% saying it's a good time to invest. Well, despite those negative economic views, Americans plan to spend 13% more this year on holiday gifts, or the most in 3 years, topping $1,000, with some saying they'll spend more because of higher earnings and others because of higher prices. So the survey showed strong expectations for wage growth. So it may be that when it comes to spending for the holidays, an optimistic earnings outlook beats out pessimistic economic views.
Right, other stories we are following today. Amazon shares slipping overnight after getting hit with a $1.3 billion fine from Italy's antitrust regulator. The e-commerce giant is accused of favoring sellers that used its warehousing and delivery services and ordered to rectify the situation. Amazon called the fine and remedial order unjustified and disproportionate. It's also facing similar accusations from the EU antitrust regulator. Meanwhile, the European Commission is taking on the online gig economy. Yesterday, it announced draft rules to give employee benefits to drivers for online delivery apps. A lobby group that includes Uber, Deliveroo, and Delivery Hero say the proposed rules will lead to job losses, but labour unions are largely in favour of the move, as it entitles employees to paid holidays and pension rights on top of a minimum wage. Uber avoided similar reclassification efforts in the United States last year. That's just the latest in the EU's efforts to clamp down on big tech. Last month, the EU's General Court ruled that the European Commission was right to fine Google for an antitrust deal back in 2017. Google can appeal that decision and take it to the highest court in the region, or pay up the $2.8 billion fee. Overnight, CNBC spoke to Margrethe Vestager about that win and where else she set her sights.
For us, it is, of course, important when the courts side with us in our assessment in a case, and here the General Court sided with us almost completely. Now, of course, it is up to Google to decide if they want to appeal to the European Court of Justice. So that, of course, remains to be seen. But it is a good thing, and of course, when you realize it, because it has been quite some time since we took that decision. That was back in 2017.
I think you have two other outstanding charges and fines for Google. Does this allow you to? Does it empower you to really double down?
Well, the other cases, they are very different. The AdSense case is having its own logic. The Android case being also a very different case. The first Google shopping case was about self-preferencing. The Google Android case is about the exclusivity, disabling the ability for others who provide search or browse us actually to have a presence, sort of out of the box presence. So they're all very different. And I know and appreciate that the court is very precise in looking at each case on the specifics, on the evidence that we provide, on the reasoning that we provide. I think that is very good. And that, of course, is also essential for us because we treat each case as a specific case.
So another case I wanted to bring up, which was the recent charges against Apple for allegedly distorting competition in its app store for music streamers. A lot of people, Commissioner Vestager, weren't surprised that you sided with Spotify on this one as one of Europe's largest and most successful companies. How do you respond to that charge on this one?
Well, actually, we have more than a Spotify case. We also have a general case about how does the App Store work when there is competition between an Apple service and other services. So this is not specific to Spotify. This is, I think, more a general feature. You see some of the same having been discussed in the Epics case. And here, while you have also, I think, a US company and a US company discussing terms and conditions with one another, I think it's really, really important that when we have open markets and everyone is welcome to do business in the US, in Europe, that we do not make it a question about where you're headquartered, because then I think we will miss a very, very important point when it comes to the openness of market and the fact that a contestable open market, 20 years ago is also what allowed the tech giants to grow up to indeed be very successful companies.
Still ahead on the programme, we'll talk to Fitch Ratings about who's performing ahead of the competition in terms of ESG investing. That interview coming up next.
What's on your holiday?
Welcome back. From the rise of EVs to record levels of green bonds issued this year, the world is seemingly embracing all things ESG. But which sectors and countries are falling behind the curve, and who's on the right track? Let's bring in Neka Chikeobi now, Director for Sustainable Finance at Fitch Ratings. She joins us live from Hong Kong. Neka, thank you very much indeed for joining us. So funding the transition to net zero, let's start there. How big is the emerging market funding gap, and how can green bond issuance solve that problem?
Hi, good morning. So how big is the gap? The gap is significant. So at COP26, a group of countries came together to reinvigorate a pledge that was made at the COP15 summit in Copenhagen several years earlier, that developed countries would provide $100 billion of financing for the emerging markets, specifically focused on climate adaptation. And adaptation is the kind of part of climate change that we're starting to experience already. So as opposed to mitigation, where we're trying to reduce the amount of greenhouse gas emissions from activities like heating and transportation, adaptation is really about how is the infrastructure we have, the economic systems we have going to cope with the rising temperatures and associated physical changes. So the commitment to meet that goal by 2022 has been renewed at COP26. But the problem is that the $100 billion is actually not fulfilling the entire gap. So estimates from various organizations range from $150 to $300 billion per year necessary to help deal with the adaptation challenges that are facing emerging markets. If we're talking about Asia alone, we estimate that that's around $25 billion per year is necessary. So even if that $100 billion target is met, it is not actually the full amount of financing that's going to be necessary. Now, when we think about the role of the sustainable bond market, it is incredibly important. First of all, a lot of the issues that we're dealing with are well beyond the scope of a specific company or entity. So the sovereign activity within the sustainable bond market is very important.
Neka, let me just pick up on that with specific reference in this region to Indonesia and India. They are both EMs with major coal industries. How do they manage this transition, which can be very, very challenging if it's not done right? And can issuance help smooth the way?
Right. So this is a really important part. And I think in our region, this is also the element of just transition, where we talk about the socioeconomic effects of environmental change. Obviously, we understand that climate change is an existential threat to our way of life. If it's too hot for us to be outside, if the precipitation changes to the point that crops can't grow, that's quite an urgent need. But at the same time, we do have to consider the fact that these are markets where access to electricity means access to an improved livelihood for people. So if they have coal-fired power, that enables them to engage in the economy in a way that they wouldn't be able to without it. As far as India has concerned, they have come out and actually started to make a few soft commitments as far as hitting a peak coal target, which is an important step. At the same time, what's interesting is that Indian issuers, particularly in the renewable energy space, are very active if we look at the APAC green bond market. And there are a lot of sort of pure play renewable energy companies or infrastructure SPVs issuing out of India, especially in the solar power space. So I think when we consider the size of the economies and also the size of the electricity demand, it can be very easy to be pessimistic and to say, well, these countries are still planning to rely on coal for the next 20 or 30 years, they're not doing enough. But if we think a more holistic perspective of who has been generating greenhouse gases over the past 150 years, the reality is that Europe probably has the largest overall cumulative contribution in the world. And so we need to give some of these countries a little bit more time to adapt their economies in a way that allows for the people to not be left behind for the sake of reaching a greenhouse gas emissions target.
Absolutely. Inclusion is just paramount here in this conversation. Neka, it's very clear, isn't it, that the sustainable bond market is coming of age, but globally, we are in search of a credible set of standards and a framework to ensure investors don't get greenwashed, which is the term right now. Are we there yet?
We are not there yet, but this year there have been a lot of really interesting developments that are helping us move in that direction. So at the COP26 summit, they announced the formation of the International Sustainability Standards Board, the ISSB, which is essentially a sister organization to the IFRS. The goal is for this to be an international standard for sustainability reporting. So in the same way that when we read an annual report and a company is reporting EBITDA, it means the same thing from every company. It's not something that we have to think about and figure out, well, does it really mean this or does it really mean that?
Yes.
The problem is in sustainability reporting is that we don't have a common language. And in fact, not only is there not a common language, there's not even a common template. It's very typical to see sustainability reporting that is very narrative oriented without numbers and without metrics, which as far as an investor is concerned is perhaps interesting, but makes it very difficult when you're thinking about a valuation perspective. So the ISSB is quite an important step in trying to get metrics-oriented reporting.
Herein lies the challenge. Neka, thank you very much indeed for talking us through these issues. Neka Chikeobi there of Fitch Ratings. That's it from us in this edition of Squawk Box. Keep it here on CNBC as we bring you the rest of the market opens. Street Signs is up next.
We're committed to
From CNBC studio at the Singapore Exchange, this is Street Signs.
Good morning, everybody. You're watching Street Signs. I'm Sri Jagaraja. Let's bring you across the headlines this Friday morning. Markets taking a breather as Wall Street snaps a three-day winning streak with all eyes on key US inflation data tonight. Also adding to the caution, Fitch downgrading Evergrande and Kaiser to default status after the property developers missed payment deadlines on their offshore bonds. And the Senate clears a key hurdle to raise the debt ceiling that would avert a government default. Right, let's take a look at these markets. North Asia is softer. That's in line with the wobble that we saw on Wall Street overnight. So the market's getting a little bit jittery, actually, ahead of November CPI, which drops stateside later on today. But you can argue that the market has already made up its mind on inflation, hasn't it? It's already looking quite hot and sticky. And it's an issue for the Fed as well. It looks as though they are going to embark on a hawkish pivot, but we will see with next week's FOMC. Right, we've got Southeast Asia opening up as well, including Taiwan too. Taiwan, Malaysia and Singapore just coming online. Let's take a look at the markets there. Straits Times on our front doorstep is down just by a very marginal 0.2%. We've got the TAIEX down as well by about 80 points. As we said, it was a negative lead from Wall Street. Oil prices as well are looking like this and are settling lower overnight on fears of China's economy stalling. And as Fitch became the first ratings agency to downgrade Evergrande and Kaiser to restricted default status. Mainland markets will come online in just half an hour. Futures looking like this. Sam Vadas joins us with more. And you've got one eye on the currency as well, Sam, yes?
Yeah, we do indeed, Shri. But I'm just sticking with that theme of Evergrande. I mean, certainly this is a milestone in that episode, being labelled a defaulter for the very first time now. Fitch downgrading both Evergrande and Kaiser, as Shri mentioned there, after missing their payment obligations. This is a so-called restricted default, which means a company has experienced a default but hasn't started the next step, like a bankruptcy filing or anything like that. It's important to highlight, as we've been saying all week, that neither company has actually officially announced a default here. Fitch says Evergrande hasn't responded or confirmed on its debt obligations. Just a recap of that, of course, Evergrande failed to make coupon payments worth $82.5 million. This was due last month. That 30-day grace period has now come and gone. So there is some assumption this hasn't been paid, but Chinese authorities not too worried about this. We heard the PBOC coming out earlier saying Evergrande's problem was mainly caused by its own mismanagement and its breakneck expansion, certainly over the decades, adding that risk caused in the short term will not have an impact in things on the long term. The PBOC governor certainly reiterated this while promising actually to protect Evergrande's shareholders and creditors. Take a listen to what he had to say.
This is a market event. It should be handled in a market-oriented way based on law. The rights and the interest of creditors and shareholders will be fully respected in accordance with their legal seniorities.
So as you can hear there, the expectation is that this situation will largely be managed over on the mainland. We have seen, of course, policymakers taking measures to soften or cushion the blow in recent weeks, certainly with the announcement of that second RRR cut for the year earlier this week. The government even playing a role here, sending a team over to the over to the company Evergrande as well to help manage and resolve risks, with the aim now of really trying to help the real estate sector, broadly speaking, to prevent any sort of contagion in the broader market. Regulators have also said they'll encourage the banks to provide more support to the industry. So certainly some encouraging comments, you could say, from Chinese authorities, Sri.
We're not done. The hits keep coming, don't they? Financial Times reporting that the US has put Chinese AI company SenseTime on a blacklist. You're going to love the timing here, right? Just as the company sets its price for its Hong Kong IPO today.
Yeah, not great timing at all. I mean, it was just tying these loose ends for this Hong Kong IPO. It was set to price this today. Those shares will actually start trading on December the 17th. These FT sources are now saying the AI company has not been made aware that it would be putting on this blacklist, and those that working on finalising the IPO certainly were caught off guard or by surprise by this. Now, the US Treasury reportedly putting SenseTime on this list. It's called Chinese Military Industrial Complex Companies, which means American investors won't be able to actually buy into the IPO. That comes after President Biden actually signed an executive order earlier in the year, essentially banning Americans from being able to invest in these companies that actually finance find themselves on these lists over their alleged ties to the Chinese military. SenseTime is one of the leaders in facial recognition technology. Of course, there has been a lot of concerns in the West about this perhaps being used for sort of nefarious reasons. It is widely used in China. A call reportedly took place last night between the company and some of its advisors to work out what the implications of being put on a blacklist will mean for this IPO. As I said, it's expected to raise $767 million from this. The company was planning to sell 1.5 billion shares, a price range of 385 to 399 Hong Kong dollars a pop. It is expected, as I say, to set the final price today, and it will be using this cash raised to pour into things, in terms of its AI development, in terms of this technology. So still waiting to see, Shri, how much of an implication this blacklisting will have on that IPO. I suppose they're actually talking about this, but it's not the first time actually SenseTime's been put on a blacklist over in the US.
We'll see if investors feel that this is a test case for SenseTime, whether it can shrug off the politics, if you will.
Yeah.
Sam, excellent. Thank you very much indeed for that. Right, let's bring it back to the markets. US stocks snapping a 3-day winning streak led by tech losses. This, even as we got weekly jobless claims falling to their lowest level in over 5 decades. Investors now turning their attention, of course, to US November CPI data due tonight and what that could mean for the Fed meeting next week. Let's take a look at Treasuries just ahead of the inflation numbers. Got the 10-year yielding 1.4836. And finally, let's take a look at some of those tech names. Large cap tech, of course, under pressure across the board. Amazon, in particular, has something of a regulatory target on its back, down by over 1% in the US session on Thursday. However, one tech stock that is doing well after hours, Broadcom, after its earnings beat, up by over 6% there, as you can see. And there was a lot of positive takeaways from this report. Will Caloris has been tracking this all morning. Will.
Yeah, you can't really complain about those upward guidance revisions when it does come to Broadcom at all. And the markets certainly weren't complaining if the after-hours action is anything to go by. They're basically suggesting that in Q1, they're expecting revenue to come up by around about 14%. Same goes for the dividend. The dividend's actually on a quarterly basis across the rest of 2022. So they're pegging that expectation at around about $4.10 a share, up from the $3.60 that it was at throughout the course of last year. And across the board, top line, bottom line, and even in the operational performance, it was a remarkable set of numbers. And that basically has been a lot of the chatter that has come from analysts in the wake of these numbers. But there are, I suppose, also some interesting things to look at when you do look at some of the underlying details about their operations. Basically, what Hock Tan was suggesting in the call is that they're actually, in their semis business, excluding the wireless component of that, expecting 28% year-on-year growth coming in FY22, but wireless to be flat or perhaps single digits. So when you collateralize that together, their semis are expected to grow 17%. This is in terms of sales and revenue year-on-year. So that brings their total revenue growth. That's bringing it back to that 14% that they are expecting in Q1. And that's where that indeed lands. And another thing that was interesting in terms of all of the numbers during the call is the fact that they're not providing, perhaps as usual, FY22 guidance, but someone did the numbers over at BOFA Securities. And basically what they suggested is if you take the $6 to $7 billion in dividends that they are going to be looking to pay out, if you take that $10 billion of cashbacks or buybacks that they are going to be engaging in throughout FY22, throw in the FCF ratio, and you basically have an assumption that we are going to see $30 billion or low to mid $30 billion in sales. They pegged it around about 27 billion this time around. But Hock Tan wouldn't be drawn in on that assumption. He actually laughed it off pretty funnily, Sri. And basically what he told the analyst is that he's going to bow down to his numbers and he's just going to leave it at that. But it basically gave the suggestion that we are looking at around about 30 to 35 billion US dollars, which would be a significant lift from even this year's numbers in terms of sales for Broadcom as well.
Yeah, chip shortages, Will. How is Broadcom navigating that particular issue? And is it showing up in terms of compressed margins?
See, it's not turning up in the margins because whatever they can produce, they're shipping out. The issue really comes because their margins, I should say, are absolutely spectacular, and they're expecting that to continue. Even if you just look at their EBITDA margin, it was sitting at around about 61.5%, and that was at a record. But in terms of the supply chain issues that they're having, it's more about their customers, because obviously everybody is trying to get their hands on semis. Basically, Hock Tan was saying that especially when it comes to enterprise customers, the demand is absolutely ridiculous at the moment. They're all trying, and it's an incredibly hot market for them right now. Obviously, as you can imagine, with the 5G rollouts, a lot of businesses are doing, as well as the Internet of Things, they're all really clamoring for those semis. But the problem being is they're trying to now manage those customers and ensuring that when they are making these orders, when people are looking to get their chips, considering the fact that there's a 15-week lead-in time, considering their backlog is as heavy as it is all the way through to 2023, that they're doing so because they're going to use them immediately. The thing that they don't want, the thing that Hock Tan said he didn't want, Sri, is for things to be sitting on shelves when you've got people all around the globe, automotive industries, everyone who uses smartphones, for example, needing these semis to go into their products immediately.
Well, excellent. Thank you very much indeed for that. Right, let's get more on the US markets and the outlook there. Given all the challenges with inflation and the Fed next week, let's bring in Lisa Erickson, Senior Vice President and Co-Head of the Public Markets Group at US Bank with assets under management of $282 billion, joins us from Minneapolis, Minnesota. Lisa, lovely to see you. Before we get into the macro stuff and the Fed and inflation, in terms of sectors, do you want to be positioned in big tech in 2022, despite the overvaluation issues and the regulatory challenges?
Well, thanks for having me here today. And I would say in terms of tech, we actually are continue to be very positive on the sector. But if we look at the landscape right now, we actually think there's a great broad opportunity set for investment across sectors. And we would therefore advocate actually being interested both in some of the cyclical oriented sectors, including energy, as well as the more secular growth names like like tech or like healthcare. And the reason why is if you really look again at the economic environment, you see a situation where we've got this nice combination of reopening activity and yet some of the cemented pandemic behavior that has come with increased online use and so on. And so again, really offering a broad opportunity set sector-wise.
All right, thanks for that, Lisa. And just in terms of the broader market outlook, there is a perception that Omicron, the market seems to have overcome those risks for now. But can the market do the same with inflation and the Fed's hawkish pivot? Or are we in for a period of repricing and a reset here?
Well, to your point, inflation is something that we're all going to need to really keep a very close eye on. Our base case is that we are going to see some elevated prints here in the next CPI report. But as we look forward to 2022, our expectation actually is that you'll see some of that price pressure begin to subside. And there's a couple of reasons for that. The first is that if you just think about year-over-year comparisons, we've actually had a quite tough run. But that makes it actually harder for prices relatively to continue to increase at the same pace in 2022. So that's one reason that helps us to believe that and again, as some hopefully the reopening activity continues and the supply constraints come off, that things even out in terms of inflation.
Lisa, I've got to say, there is some dissonance in the bond markets, right, with real rates negative. What is that telling you about the growth cycle and the policy path, and where does that leave the case for rate-sensitive sectors like energy and financials?
Well, to your point, real rates are obviously one of the most key indicators that you can look at because it really reflects the underlying belief of investors and where growth is headed. And to your point, the story that they're really telling us right now is that we're going to see some moderation in the growth story. Again, we see the markets as potentially being a little bit pessimistic in that regard, but it is a very important indicator. And so we are keeping our eyes on it. As we look into 2022, we are expecting a more positive environment for growth. But again, there are some risks coming up here like inflation, like with how monetary policy is handled. And so again, we're going to be watching the data very carefully to assess the path forward.
Understood. And Lisa, how are you approaching markets outside the US, and how does China's economic slowdown stand to affect the investment case for the multinationals like Caterpillar, Apple, Boeing that have such skin in the game there?
Regionally, we really are favoring the US right now over international markets, both developed and emerging. And the reason why is when you look at the fundamental case, what you see is a relatively strong case for the US when you look across a range of indicators relative to what you would see, again, in countries that are part of IFA or in the emerging markets where, again, some of the numbers are higher at an absolute level, but again, slowing. So to your point, China is going to be a key flashpoint for us to continue to monitor. The good news is here in the last few days, we began to see some more policy support coming out of China. So again, hopefully that will help the economic situation.
Banks are certainly reinstating the dividends, and stock buybacks are returning. We saw that with Broadcom. Income investors are being rewarded. Is that going to continue to stay the case in 2022, Lisa? And where do income investors then need to be positioned and focused next year?
Well, again, we really see the opportunity for some of these more interest rate sensitive sectors potentially to be a little bit more challenged as the Fed moves to relieving some of that very supportive policy they've had in a monetary sense to help the markets. So again, right now we think a very balanced position makes sense, but we're going to want to watch that direction of how hot monetary policy may become to see where, again, some of the more interest rate sensitive sectors like banks may perform going into the new year.
Lisa, thank you very much indeed for that. Appreciate your time. Lisa Erickson there from US Bank. Right, we are getting the yuan midpoint, and this is just after the changes and the adjustments in the FX RRR aimed to really slow down the appreciation in the currency. This is where we stand at the moment for the offshore rate, dollar China, 638.78, and the PBOC has set the yuan midpoint at 637.02 versus 637.78 against the last close. Coming up on the program, the US expanding its booster shots to 16 and 17-year-olds as they try to stem the spread of the Omicron variant. We'll bring you the latest on those developments coming up next.
Tune in for Tech Check.
Welcome back to Street Science. The US is racing to give booster shots, with regulators now expanding the program to include 16 and 17-year-olds. NBC's Tom Costello has more.
CDC approval just 2 weeks till Christmas means 2.6 million teens will be eligible to dramatically boost their COVID protection before gathering with family and friends over the holidays. Pfizer's booster now authorized for fully vaccinated 16 and 17-year-olds at least 6 months after their second dose. While those initial vaccine doses offer a strong defense against the Delta variant, Pfizer says its research shows the booster is essential to mounting a strong defense against the fast-spreading Omicron variant. So far, younger kids are not eligible for the booster.
I would think that at least for the next several months, that the kids will be okay, because in general, they do better than adults when it comes to immune responses.
Children under 18 make up 22% of all COVID cases. Meanwhile, at hospitals nationwide, many frontline doctors and nurses say it feels like the worst days of the pandemic once again. ICUs filled with unvaccinated COVID patients struggling to breathe. From a nurse in Arkansas,
I'm tired of it. Us nurses, other coworkers, respiratory therapists, all the medical team, we are tired.
To doctors in Colorado.
Another day, another shift with no beds here in Colorado.
And Indiana.
Our number of COVID patients doubled over the weekend. Our ICU is full.
Heather Danik, a critical care nurse at UW Swedish American Hospital in Rockford, Illinois.
We have young people, we have old people. I'm easily taking care of people my age and definitely younger than me.
The situation so serious in the Northeast, the governors of New York, New Hampshire, and Maine are sending National Guard troops to help in the hospitals.
Our hospitals are being stretched thin. Healthcare is jeopardized for those who need it. And our healthcare workers, heroic as they are more exhausted than ever before. We're at a tipping point.
December 2021 feeling a lot like December 2020.
Including Dr. Paul Offit on the FDA's advisory panel for vaccines. He doesn't think teenagers need boosters. He doesn't think that they're going to get that sick right now from COVID or the mutations. He's more concerned really about heart inflammation with teenage boys than he is really about COVID. But again, we have full approval now from the FDA and the CDC.
Japanese markets are shaping up like this. The Nikkei 225 down by over 200 points, and we've got the dollar yen changing hands at 113.35. The heavyweights are looking like this and are dragging down the index. Fast retailing and SoftBank off and looking weaker, although Fanuc is just holding on there in positive territory. SoftBank shares standing like this in Tokyo Trade, off just marginally. The FT reporting the tech conglomerate has offloaded over $500 million worth of WeWork debt at a discount rate to lure investors. SoftBank had provided those funds to WeWork to help the company tide over its liquidity crisis over a year ago. Meanwhile, SBI denying Nikkei reports that the firm is planning to apply for a bank holding firm by year end. The Nikkei had said the move was in bid to buy over a majority stake in Shinsei Bank. Shares are up on Shinsei Bank. SBI Holdings up, I think a pretty good day actually, up by 1%. And Hitachi in France as Alstom will deliver the trains for Britain's high-speed 2 rail project in a deal worth $2.6 billion. The deal makes Hitachi the first Japanese company to deliver high-speed trains to Europe. The trains will run between London and Birmingham at a whopping 360 kilometers an hour and promises to be the fastest in Europe. Speed is above some of Japan's famous Shinkansen bullet trains. Shares of Hitachi up by 1.8%. In South Korea, the Kospi is, last time I checked, underwater and still is, down by 0.6%. And it's another day of over 7,000 COVID-19 daily infections, bringing the total cases reported in South Korea past 500,000. The country now speeding up its booster inoculation program for adults, saying it can be given 3 months after the primary vaccination. Heavyweights on the Kospi are looking like this, and all of them are having a pretty rough day, some of them down by over 2%. Coming up next, Hong Kong and mainland China markets will come online in just a few minutes. We will bring you the opening trades when we return. Right, the Hong Kong markets are just coming online. The Hang Seng is looking like this at the early open, down in line with the regional mood, off by about 0.6%, although starting to narrow the scope of losses somewhat. We got the Hang Seng Tech Index softer after the softer lead and the negative leadership that we got from the Nasdaq. So we got the Hang Seng Tech Index off by almost knocking on 1% there. 8 shares also having a fairly rough day, down by about 50 points. Big tech names in particular listed in the Hong Kong market are looking like this. Rough day for Alibaba at the get-go, down by 1.8% there. On the property front, Fitch downgraded Evergrande and Kaiser to default. Evergrande shares are looking like this in early Hong Kong trading, down by 0.6%. Kaiser remains suspended, so you're not seeing any quotes there. Right, let's get Sam Vadas for more on that and as the mainland markets come online.
Yeah, and the mainland market's no exception, Sri, to what we're seeing out there in the rest of the region as well. We are seeing the Shenzhen composite opening lower, down around 0.5% at the get-go. So certainly a reversal of those gains we've seen now for mainland Chinese shares for 3 straight sessions. Certainly that data out yesterday when it came to the inflation side of things looked encouraging for investors on top of that recent monetary policy support. Certainly there had been some expectation now that policymakers would have now more room to sort of boost this slowing economic growth that we have seen, particularly after the price moderation we saw in the factory inflation, and also as that core inflation does remain weak, much lower than other advanced economies around the world. But as I say, the mainland Chinese shares losing a bit of steam today. The currency is in focus, of course. So right now we have got that US dollar Chinese yuan, that spot rate changing hands at 6.38. It does come after the central bank decided to raise the FX RRR from 7% to 9%. So now forcing the banks to set aside more of this foreign exchange in reserves. This will take effect on December the 15th, the same as that RRR cut. This is the second time this year we've actually seen the PBOC doing this. The first time was back in May. There had been some expectation that we could see authorities actually stepping in to rein in the recent strengthening of the yuan. So this seems to be really how many are interpreting this move by the PBOC now, as perhaps they look a little bit uncomfortable with this rapid rise we have seen over the last few months or so. Although it did apparently catch some traders by surprise. Some of them had expected that the authorities were looking more comfortable about this and perhaps had a higher toleration of this strengthening yuan. But it does seem to be also about really shaking these speculators out of the tree now. This comes after the yuan has, of course, risen more than 2% against the greenback since around July. Those trade-weighted terms, it has hit its highest since around 2015. And we do know that has taken a bit of a hit to those exports. We saw that in the latest trade data for the month of November. Exports really have been driving economic growth over the last year or so. So perhaps authorities are a little bit concerned that one of the bright spots may be impacted by this. So this is widely, Sri, being seen as trying to really slow things down here, as the strengthening yuan may not be so good for the Chinese economy at the moment.
Sam, thank you very much indeed for that. Let's pursue this conversation in a bit more detail with Logan Wright, Director, China Markets Research at Rhodium Group, joins us from Hong Kong. Logan, thanks for your time. So the Politburo's stance was very clear. They trotted out the word stability, financial stability and social stability on multiple times. Does that give you any confidence that the leadership has this property stress under control?
I wouldn't say, thanks, Sri, very nice to be with you. I wouldn't say it's quite confidence-inspiring yet, but the conditions are definitely emerging for a more constructive outlook for the Chinese property sector, for the economy as a whole, and for implications for risk assets. As you know, it's really a necessary condition, the Politburo statement, that they acknowledge the slowdown, in addition to acknowledging the property sector's linkage to the economic slowdown. They responded clearly with policy, including the reserve requirement cut, the relending rate. And so now I think a lot of the focus in markets is going to be on the Central Economic Work Conference over the next few days, and whether we're going to see additional concrete steps to stabilize both the property sector and the economy as a whole. What's really the pledge alone is insufficient. What really matters in the next couple of months or quarters is going to be whether there's two conditions that are really necessary for this constructive outlook to build. One is a stabilization in property sales. You can't have property sales continue to be declined by 20, 30%. That's going to add to financial pressure on developers. And it's difficult to offset that with policy because property sales are just so large as a proportion of the overall economy, 15.7 trillion yuan over the last 12 months. It's about $2.5 trillion. You can't really offset a decline in that very easily. And the second is credit growth. You need to see credit growth stabilize. If you're controlling credit to the property sector and to local governments, you need to find credit through the private sector. And that means lower interest rates. So we're really watching for transmission of lower interest rates through the LPR rate coming up on the 20th, and for continued moves to try to reduce banks' funding costs and reduce borrowing costs to the real economy.
How critical is common prosperity here, Logan? And does it essentially mean that the property developers are going to be mandated by the state or enlisted effectively to do national service and build out more affordable housing?
I think it's important, but it doesn't necessarily mean exactly those sorts of mandates. In terms of the state-owned developers being tasked to take up these sorts of obligations. I think a lot of that pressure will come on local governments. The big problem is that there's not enough funding right now to really specify exactly how you're going to ensure that the pre-sold houses are actually completed. So we'll be really watching for that financial support. As I mentioned, it's insufficient. What common prosperity is not really policy, so to speak. It's kind of a higher level set of objectives, and many different policies can fall within that purview. So I think it will guide things at a high level, but it doesn't necessarily translate into specific outcomes for those property developers at lower levels. The state, there aren't that many shock absorbers here unless you get property sales and credit stronger, because state-owned developers just aren't large enough as a proportion of of the sector.
In basketball terminology, there's a full court press, though, isn't there? They've got the provincial government of Guangdong, the regulators, PBOC, all stepping in now. Is this intervention the beginning of a managed restructuring of Evergrande and the other stressed property developers? And should this give investors hope that there is light at the end of the tunnel?
Well, like I said, I think that there's going to be a lot more focus on trying to contain the downside. I'm not sure that we have a lot more confidence in the upside per se, that there's really enough. Because right now property sales are still declining. What matters is, does the signal from the Politburo do additional policy steps? Do they stabilize financing conditions for private developers? And if that happens, then you have a little more space to operate. Does that stabilize conditions among property investors? Are they prepared, therefore, to step in, and re-enter the market, believing that prices will rise? Unless you have those satisfied, I don't think that we can really have confidence yet. Like I said, it's sort of a necessary condition that they're taking these aggressive policy, that you're seeing this sort of drumbeat of policy this week. But so far, what's really important is to follow the money. And the money in order to complete this construction, obviously Evergrande, Kaisa have considerable short-term payables. We haven't seen that yet.
Logan, just finally, onto the currency. China raised the Forex triple R. They're clearly not comfortable with the level of the dollar-China rate and what that does to exports. But this is really a function of the strong current account position, capital inflows as well. So aren't they really swimming against the tide here, or are they trying to target a particular level, maybe 650 in dollar China?
I don't think we're targeting a particular level. I think the concern that the PBOC has evinced is that they don't have many options to combat the flows, just as you say. So they're trying to escalate market communication to reduce the possibility of sustained speculative one-way bets on the currency. And that's what they've tried to communicate. And that's what they've used this adjustment in FX reserve requirements to do. in the past, is to make those kinds of, is to escalate that communication strategy. The concern here is really that if you look at what's happening in Chinese savings rates, they're rising, investment rates are falling. That's boosting the current account. The capital account is still in surplus. And so as a result, you have, there's very little onshore dollar demand for foreign exchange. How can you combat that pressure if you're the PBOC and you don't want to see one-way expectations build first in one direction and then potentially in the other direction? That's the dilemma they're struggling with. It's harder but this really does just sort of reflect a rise in the communication strategy, which has in the past at least capped the gains, if not reversed expectations.
Yes. Yeah, the PBOC are certainly communicating more and talking about their intent. Logan, we'll leave it there. So great conversation. Thank you very much for your time today. Logan Wright there from Rhodium Group. Coming up on the programme, Italy slaps Amazon with one of the EU's biggest fines on US tech over anti-competitive behaviour. What could this mean for other tech companies? We'll hear from the EU's antitrust chief coming up next.
Tune in for Tech Chat.
After clamping down on the tech sector, the European Commission has now turned its sights to the online gig economy. Yesterday, it announced draft rules to give employee benefits to drivers for online delivery apps. A lobby group, including Uber, Deliveroo and Delivery Hero, say the proposed rules will lead to job losses. But labour unions are largely in favour of the move, as it entitles employees to paid holidays and pension rights on top of a minimum wage. These apps avoided similar reclassification efforts in the United States last year. And Amazon shares taking a hit overnight after getting hit with a $1.3 billion fine from Italy's antitrust regulator. The e-commerce giant is accused of favouring sellers that used its warehousing and delivery services, and ordered to rectify the situation. Amazon called the fine and remedial order unjustified and disproportionate. It's also facing similar accusations from the European Union antitrust regulator. Commissioner Margrethe Vestager spoke to CNBC about those issues.
Well, of course, we've been comparing notes with the Italian competition authorities. They have a very specific case for the Italian market. And when we opened one of our Amazon cases, of course, we made a carve out in order for them to continue what they are already doing.
So they didn't steal your thunder here.
Well, it's not about stealing thunder. It's about making sure that the market is open and contestable. And I think a case like this one contributes exactly to this purpose.
Amazon, no surprise to you, I'm sure, is going to appeal the case. They say it's unfair. They say it's a disproportionate fine. And they also say in the statement, I just want to read you a part of it because it resonated. Large companies are not dominant just because they are large. And the presumption that success can only be the result of anti-competitive behavior is simply wrong. How do you respond to that?
I think it's unrelated to the case and the assessment of the Italian authorities. Of course, it is a valid point that being successful doesn't mean you've done something wrong. And being big is not a symptom that you will be doing something wrong. So I think it's important to have these discussions. But when it comes, for instance, to retail, there is a difference between brick and mortar retail and online marketplaces. I think everyone can see that also intuitively, and that, of course, is part of the foundation also for the cases of the European Commission.
So do you think Amazon is acting anti-competitively by giving unfair treatment to its third-party sellers that use its own services, its shipping services? Do you agree with that?
Well, we are looking into a similar issue, but we have no conclusions yet, so that I don't know. We're also looking into the issue of Amazon enabling the data from the small merchants of the Amazon marketplace to be available for Amazon retail. And by doing that, giving them a huge competitive advantage. So we have a data case just as well as a case about how to get into the buy box. Does that depend on whether you use Amazon fulfillment or not?
Coming up on the programme, US President Joe Biden rallying world leaders in the first of its kind summit for democracy as he seeks to return American leadership to the global stage. Will the effort pay off? We'll discuss coming up next.
The pandemic brought
Welcome back to Street Signs. China lashes out after Australia, Britain and the United States decide not to send government delegations to the Winter Olympics in Beijing, citing China's human rights abuses in Xinjiang and elsewhere. Beijing has denied those allegations and warns these countries will, quote, pay a price.
What I want to tell you is that the United States, Britain, Australia, and Canada are facing a loss of moral authority and credibility by using the Olympics platform for political manipulation. Their self-isolation will inevitably pay the price for their mistaken acts.
The boycott stops short of not sending athletes to the Games and comes amid cooling relations between the countries. Russian President Vladimir Putin is the only leader of a major country who has publicly accepted Beijing's invitation. Meanwhile, in Europe, tensions continue to run high over the Russia-Ukraine border. Ukraine saying Russia has rejected new ceasefire proposals. The Kremlin, meanwhile, comparing the crisis to the most dangerous point of the Cold War. Russia is awaiting an invitation from the US to join possible NATO talks on the issue. President Biden, in a call with Ukraine's president, pledged the US unwavering commitment to Ukraine's sovereignty. All this comes as President Joe Biden hosted over 100 world leaders in a first-of-its-kind summit for democracy, which Russia and China were not a part of. Biden calling on countries to bolster democracy in the face of rising authoritarianism.
We stand at an inflection point in our history, in my view. The choices we make, in my view, in this moment, are going to fundamentally determine the direction our world is going to take in the coming decades. Will we allow the backward slide of rights and democracy to continue unchecked? Or will we, together, have a vision and the vision, not just a vision, the vision and courage to once more lead the march of human progress and human freedom forward?
No countries were mentioned by name, but as we highlighted, China and Russia were not part of the guest list. Taiwan, though, was invited. So what does this all mean for global geopolitics and geostrategy? Let's bring in Ariel Cohen now, non-resident senior fellow at Atlantic Council, joins us from Washington, D.C. Ariel, always good to see you, sir. What did this summit for democracy realistically achieve, in your opinion?
Well, it's rallying the troops. We are, as President Biden correctly said, at an inflection point in the sense of the competition between the democratic West and the democratic world, broadly defined. I mean, he brought here the Philippines and India and Japan and South Korea. That's not the West. This is the East, but it's democratic. For the first time, he brought in Taiwan, which technically the Chinese will argue is a violation of prior agreements between President Nixon and Mao Zedong back in 1971. And we are treating Taiwan as a quasi-state or de facto state. So there is a backdrop of the competition with China, but I was listening carefully. President Joe Biden sounded almost Reagan-esque. He reminded me of President Reagan, maybe without the charisma and the soaring rhetoric of Ronald Reagan. But the issue is today, as it was 40 plus years ago, how the West will proceed from here on, how we'll not just survive, but thrive as democracy, as a democratic alliance over 100 countries, some of them not stellar performers in the democratic space.
Ariel, but the US and the Biden presidency has a real perception problem, doesn't it? They're rallying the troops behind a leader of the Western liberal order that is severely in doubt after the debacle of Afghanistan.
Not only that, I would start with the Trump presidency. The big questions in Europe and elsewhere about the health of our democracy arose with President Donald Trump. And probably the epitome of that was the other debacle here in Washington on the 6th of January of this year. So we need to get our democratic house in order while we are preaching, but we have to preach without being preachy. We have to lead by example without lecturing. People really don't like when America lectures them about how to manage their affairs. America is not empire. An empire should not be an empire and should not behave like one. We leave this to the Chinas and the Russians and the rest of the world does not appreciate the wagging finger and the stick that great powers wield. So it's a challenge of balance. It's a challenge of perceptions. There's a lot of perception management in this, and I hope and pray we'll succeed.
Ariel, the question is whether the Biden administration can, as you'd like to say over there in the US, walk and chew gum at the same time on the foreign policy front, which is so crowded, whether it's Iran, China, and now there are questions as to whether President Biden can de-escalate the situation in Ukraine. How big a test is Ukraine on President Biden's leadership?
It's pretty big because I was born in Ukraine, and I've been to Russia before COVID many times, and there is a whole party of war, if you wish. It's the generals, it's the military-industrial complex, the ideologues of the Russian Empire. They would like to go march into Ukraine and grab the east and the south. The east, Kharkiv and Kyiv, the capital, they call it the mother of Russian cities, and then in the south, Kherson, Odessa, Mykolaiv, all the way to the Ukrainian border. Can they do it? Yes. Will they pay the cost? Yes. Is the cost too high? Right now, it looks like yes. If we keep the Western alliance together, if the Russians understand that the SWIFT, the banking transactional system, will be disconnected like we did with Iran, if we impose sectoral sanctions on Russian oil and gas, and the Germans will shut down the Nord Stream 2 pipeline, then Putin will think twice before marching into Ukraine.
US boots on the ground, that's a different story entirely though, isn't it, Ariel? I wish we could pursue that conversation with you. We're just out of time. Thank you very much indeed, sir. Ariel Cohen there, Atlantic Council. Right, we'll bring you a lot more in the second hour of Street Signs. Matt Taylor joins us with what's coming up. Hey, Matt.
Hi there, Sri. Morning to you. Morning, everyone. We've got plenty more coming up on the next hour. We'll be talking more about China and its reform path going forward. We've got a really interesting guest coming up, Isabel Weber. She's just authored a book on how China escaped shock therapy. What does she make of Xi Jinping's common prosperity and all of the potential pitfalls? We're going to be discussing that and plenty more, plus all the market action this Friday when Street Signs returns for you right after this break. are watching the second hour of Street Signs here on CNBC. I'm Matthew Taylor in Singapore, and these are the top stories that we're watching for you on this hour of the show. Well, markets stumble as investors turn cautious ahead of the US CPI print due out later on tonight, Asia time. Adding to the caution, Fitch becoming the first ratings agency to declare Evergrande and Kaiser in default after both missed offshore bond payments. The yuan eases after the PBOC sets a weaker than expected midpoint in its latest move to clip the currency's recent surge.
Live from CNBC studio at the Singapore Exchange, this is Street Signs.
Happy Friday, everyone. Asian markets right now are tracking weaker after we did see Wall Street snap its recent run overnight. We did have the Dow flat by the close of trade, but the Nasdaq was down sharply, and that's being reflected in some of the tech-heavy Asian averages that you are seeing today. Hong Kong, will get more on that in a moment, down by about 1/3 of 1%, but we are seeing the TAIEX weaker by around about 1/2 of 1%. One green patch today, the Malaysian market up by about 0.6 of 1%. Elsewhere, we are seeing weakness in the Japanese market as well, lower by around about 1/2 of 1%. Again, these tech-heavy markets, the Kospi, weaker by about 0.4 of 1%. Australia, New Zealand are tracking lower as well. But let's hone in on the China market. The Shanghai Composite also trading down by about 0.4 of 1%. 30 minutes into the trading session, a busy day there. Of course, our top story, Fitch cutting Evergrande and Kaiser to default, and the Chinese currency also seeing some bigger moves earlier on as well. Sam Vardas has all of this covered for us and joins us now with all of the details. Sam, of course, when it comes to Evergrande and Kaiser, we're really waiting for the inevitable to happen on that one.
Yeah, that's right, Matt. And it's important to note that neither of those companies have actually come out confirming that they have actually seen a default. But we have now, as Matt said there, seen Fitch downgrading both Evergrande and Kaiser after missing payment deadlines on their offshore bonds. This is called a restricted default, meaning the company has experienced a default but hasn't started the next step, like a bankruptcy filing. So Fitch says Evergrande hasn't responded to its request for a confirmation on its debt obligations. Of course, just for a recap, it did fail to make coupon payments are worth $82.5 million. This was due last month. That 30-day grace period has now come and gone. So there has been some assumption now that this has not been paid. Authorities don't seem too worried about this. We did have the PBOC, of course, coming out earlier in the week saying Evergrande's problem was mainly caused by its own mismanagement and its breakneck expansion over the years, adding that risk caused in the short term will not undermine the market in the long run. The PBOC governor reiterating this while promising certainly to protect Evergrande's shareholders and creditors. And if you take a look at some of the real estate stocks over on the mainland today, the index that tracks those sitting down around 0.2 of 1% at the moment. So the damage not too bad, perhaps off the back of this expectation that this situation will be managed over on the mainland. But switching gears to the story about the Chinese currency, certainly in focus today. Right now we have the US dollar Chinese yuan changing hands at 6.370. Certainly we have seen that spot rate trading at the weakest level this morning in a few weeks after the PBOC did set that midpoint weaker than expected. It comes after the central bank did actually raise the foreign currency RRR from 7% to 9%. So now forcing the banks and these financial institutions in China to hold more foreign exchange in reserves. This move will start on December the 15th, on Wednesday, the same day as that RRR cut comes into effect. This is the second time this year they've raised the FX RRR. The last time they did this in May. No surprises, really. There had been some expectations that we may actually see authorities now stepping in to rein in the strengthening yuan as they perhaps look a little bit uncomfortable with this rapid rise we've seen in recent months, Matt.
Yeah, move there from what have we been at the last few days, around 6.35, then up to 6.37. Sam, thank you very much for that. We'll check in with you a little bit later on. In the meantime, let's go to Robert Tipp now, the Chief Investment Strategist and Head of Global Bonds at PGIM Fixed Income, joining us now from Newark in New Jersey. Great to see you there. And I want to kick off when it comes to the Asian corporate bond space, given all of the troubles that we are seeing with the likes of Evergrande and Kaiser as well. Is the Chinese property space and, of course, particularly the offshore bonds related to that space, just too risky to hold right now in light of everything that's going on in the sector?
Right. Well, they're clearly distressed, so for higher quality fixed income funds, our view for some time always is that you need to do your own research. And so the ratings agencies are not something externally outside of China that you can rely on. And it's certainly the case in China. We don't want to rely on them. So for higher quality portfolios, we're more comfortable with the government bonds, the policy banks, and the panda issuers. This is one area where China, for all of its strengths, though, the bonds trade tight. Generally speaking, the bonds are expensive for the underlying credit quality, except in these cases where things begin to come unhinged. So, obviously a very speculative situation there.
Okay, if you want to broaden out to Asia in a little bit more detail before we go stateside, if you are looking to get into the fixed income bond space in Asia, you're talking about government bonds, whereabouts specifically? And if you want to dip into the corporate side of the equation as well, what kind of sectors do you look at so things aren't, of course, as speculative as we've seen, because with the Chinese property space?
Right. Well, at this point in time, for higher quality accounts, there are a lot of opportunities with much steeper yield curves, higher yields, generally outside of Asia. Asia right now is a bastion of low inflation and low interest rates. And so the government bond markets are generally not that attractive. The currency, obviously, the yuan has been very stable to firmer. And so for unhedged investments, that's made Chinese government bonds a high quality, appealing asset with a high yield for a high quality market. But generally speaking, the bigger opportunities, I think, in terms of hedge carry right now are outside of Asia.
Okay, well, let's go to the States then and talk about the situation there, because we are awaiting that key inflation report due out later tonight. For us, Asia time, we're expecting to see another hot number when it comes to the November print, 0.7% on month, but on year, something like 6.7%. Some suggestions it could be beyond 7%. How is that going to change the calculus at the Fed, if it will at all? And how do you trade around, of course, what's going on with rate expectations, the taper stateside, from a fixed income point of view?
Right. Well, let's look at 3 time horizons. On a very short time horizon, we did see a stalling of energy prices. And so, that would strike me as a reason over this period in the short term why you may see a lower print than expected. That may take some of the heat off the market in the very, very short term. I think over the next 1, 2, 3 years, though, that's going to be your transitory period of where you have this condition where demand is very strong because of fiscal stimulus. It's very strong because of job growth with a general trend of reopening, but supply is impaired. It's impaired by the idiosyncrasies of COVID and other things that have cropped up on the energy side and elsewhere that have restricted supply. So I think you're going to see that be a driver of relatively high inflation over the next 1, 2, 3 years. And on a more pernicious basis, real estate inflation. There's been, a change of preference of where there's higher demand for housing, and almost on a global basis, we're seeing very strong demand for housing, and that is going to feed through in rent inflation. So I think that this is going to keep the Fed responding to, one, their long-term desire to control inflation, and as a risk management exercise to clear the decks to be able to raise rates if they need to. But they're also, I think, feeling the heat of the politics, which have unusually changed towards fighting inflation. I mean, we really haven't seen that in the States for over 40 years.
Right. On the 10-year there, we're sitting just sub the 150 level, 149.05 there. In terms of that timeline for Fed and the normalization of policy, what's the trajectory then when it comes to yields across the US Treasury space?
Yeah, I think for the back end of the curve, we've seen the highs of the cycle. I think we saw them back in March. I think the markets at that point were facing a big fear of incredibly high growth, and central banks around the world that were not concerned about inflation. They were only concerned with bringing growth back and getting back to maximum employment. Once in the States, and this has happened all around the world, the central banks began to respond. And in the States, it was subtle. It was in the dots. The dots, the expected path of the Fed funds rate dislodged from zero. And from that point on, the back end of the Treasury curve has been pretty firm, starting at the longest end. So I think, your 175 area was probably the highs for the 10-year note. The front end of the curve is going to be more responsive to how fast people expect the Fed to raise rates. I think, though, that 3 to 7 year treasuries, we may be, if we get some moderation on the growth and inflation side, we may be hitting the highs of the cycle for those intermediate yields at this point as well, however.
Okay. Final question before we let you go. You spoke about chasing yield. There are better opportunities outside of Asia. We spoke about the States. What about in Europe and the UK, given that we are seeing a high inflation story in both Europe and the UK, but the Bank of England are certainly about to pull the trigger on rates. It could come as early as this month, depending on who you're speaking to. Does the gilt market look attractive?
So I would set sterling market aside. That is a place where the central bank may respond. They have really strong growth, and they've had higher inflation numbers. But most DM economies, the US, Europe, Australia, have had these secular forces keeping inflation pretty limited. And so for those markets like the US and the European market, as well as many other DM markets, I think that after this 1, 2, 3 year period passes, there's a reversion back to the moderate environment that we had 2019 and before. And I think that's what the bond market is looking at. And that's going to keep these long-term rates relatively anchored. So I think that investors that are staying invested in these DM markets, investing in the higher yielding spread sectors, whether it be dollar denominated high yield or IG corporates or structured product or even EM hard currency, are likely to have the best returns rather than those that pull back and go into cash or very short duration or governments only. I think they're going to miss the fact that this expansion is going to continue and spreads are going to remain relatively firm.
Robert, have to leave it there. Thank you very much for your insights. Robert Tipp there from PGIM Fixed Income. Well, coming up next on the show, Broadcom shares going from strength to strength after the Bell stateside. We'll get into that earnings report up next.
I'm Dr. Lakeisha Simmons.
Welcome back to Street Signs this Friday. Let's give you a look at shares of Broadcom surging in extended trade as the chip maker reports an earnings beat and announces an aggressive $10 billion buyback plan. The stock up by more than 6%. Will Kalouris has been following the story and joins us now with the details. Hi, Will.
Good morning, Matt. Yeah, Broadcom absolutely dominated when it does come to this Q4 result period. It also acts as their full year 21 in terms of those beats. They came in thick and fast in terms of their revenue for the period, in terms of their free cash flow. That was up by 6% in Q4. In terms of their adjusted EBITDA, that was actually up by 18% in Q4 to $4.54 billion. But where you are seeing that jump in the share price today is due to their forward guidance. So for Q1, they're actually expecting their revenue to pick up by 14%. For the entirety of FY22, they're expecting their dividend to be 14% higher than it was last year. So that's now at $4.10 a share, as opposed to the $3.60 that they were paying out for the entirety of FY21. And then at the same time, that $10 billion US dollar share buyback that you did mention. Now, all of this is possible due to the fact that they didn't engage in any M&A like they normally do. They're, generally speaking, incredibly acquisitive. They like having their roll-ups, particularly when it previously did come to semis, but now more so when it does come to the software side. But that isn't to say that they're ruling that out, that prospect out entirely. So here's a little bit of what the CEO Hock Tan had to say about just that earlier on. Listen in.
We have piled up a ton of cash, and that has actually the gross debt has actually declined somewhat, and while our cash position is building up, and while we may still do a deal in 22, it's just that we will still be generating a lot more cash in 22. So when you add up this whole thing, it's just a very logical conclusion for us to not just sit on the cash, hoard it, in some ways you might call it, but just return it to you guys.
And it's a big amount of cash, Matt, $67 billion in terms of dividends, plus that $10 billion that we have been mentioning when it does come to the buybacks as well.
Yeah, and there's also a fair amount sitting in the coffers as well. The CEO saying that they might make another acquisition. What's the potential target?
Yeah, this is what's really interesting. We heard earlier this morning from Stacey Ragson. He was joined our US colleagues over on Closing Bell. He basically thinks it has to be software. Listening to what he had to say about that.
They're not buying semi companies anymore. They're buying software companies. And that may have been part of the reason, in my opinion, that they made that chip. But they've been building out their acquisition strategy around rolling up sticky, mission-critical enterprise software businesses.
And another guest that we actually had on earlier today from West Park Capital, Ruben Roy, basically what he was suggesting, this was after his appearance on the show, is that there are 4 companies that he has identified that he thinks that they could be kicking the tires on. And all of this was centered around a recent New York City Investor Day that Broadcom held and the discussions that he was having there. So those names in particular are Click, SAS Institute. Both of them are actually data analytics firms. They're not listed though, they're private equity. BMC is an enterprise software company that potentially that Broadcom could be looking at, and also Micro Focus, which is a British IT firm. And these are the 4 that have been identified. So it's going to be incredibly interesting to see whether or not a deal can get done. Obviously, like we have been mentioning, they are sitting on an incredible amount of cash. They're expecting their FCF to come in at around about $13 billion for next year. So the opportunity is there, even despite the fact that, like I said, Matt, they're paying out that $17 billion back to their shareholders.
All right, space to watch. Well, thank you very much for that. Well, let's stay stateside and go over to Oracle shares, also doing very well in extended trade, surging 10% after an upbeat earnings report card. CNBC's Julia Boston has those details.
Oracle shares shooting higher on better than expected top and bottom line results. The company's biggest division, Cloud Services, grew its revenue 6%, and the company authorized a $10 billion increase in share repurchases. The stock spiked further during the earnings call after CEO Safra Catz said that revenue growth will accelerate. She guided to 6% to 8% fiscal third quarter revenue growth in common currency. She also guided to a fiscal third quarter earnings range that was ahead of the midpoint of analysts' expectations. She said that the full year revenue for the fiscal year will finish solidly in the mid-single digit growth. Catz saying that they expect cloud revenue to accelerate further and exit the fiscal year in the mid 20% range, potentially higher. She said that cloud is a more profitable business than their on-premise services and that therefore their margins will be better than pre-pandemic levels. And she explained this success as being because Oracle has a highly differentiated strategy from their competitors. She said they're the only company that's able to offer the combination of applications and infrastructure. Julie Borston, CNBC Business News, Los Angeles.
We're off for a short break. Plenty more coming up for you right after this.
A touch of
Welcome back. Let's give you a check-in on how the Hong Kong market is faring this Friday. We do have a little bit of weakness coming through. The Hang Seng Index lower by 48 points, or about 1/5%. Interestingly, though, we are seeing the tech index gain there, despite the fact that we did have the NASDAQ as the rank underperformer on Wall Street overnight. We are seeing some weakness coming through in some of the tech-heavy markets across the Asia-Pacific, but the Hang Seng Tech Index, though, holding up today. Heavyweights in Hong Kong tracking like this. We do have Tencent firmer by about 1/10%. Some weakness, though, when it comes to the financials, insurers, AIA, HSBC tracking lower. Chinese tech names trading like this. We've got the likes of Tencent, Meituan and JD.com all in the money today. Well, the US has reportedly put Chinese AI firm SenseTime on its blacklist, and the timing couldn't be worse. Sam Vardis is back with us to tell us why couldn't the timing be any worse.
Not a good time for SenseTime, you could say there, but it comes as the company is really like tying loose ends at the moment with its Hong Kong IPO. It is setting that pricing today. Those shares will start trading on December the 17th, but the FT sources have said the AI company had not been made aware that it was going to be put on this blacklist, and those that were working on finalising this IPO were actually caught off guard, a little bit by surprise there. What the US Treasury is doing is putting this company on a blacklist reportedly. What it's called is Chinese Military Industrial Complex Companies. It means those American investors cannot actually buy into that IPO. And that came after President Biden just a few months ago signed that executive order, effectively banning Americans from being able to trade in these companies that have found themselves on this blacklist over their alleged ties to the Chinese military. Now, SenseTime is one of the leaders in facial recognition technology. Of course, this is widely used in China, but there have been some concerns, certainly as far away as the US, as to exactly how some of that that technology is used. A call reportedly took place last night between the company and also their advisors to work out what the implications of being put on this blacklist would actually mean for the IPO. That's expected to raise $767 million. The company was planning to sell 1.5 billion shares with a price range of 385 to 399 Hong Kong dollars a pop. It is expected, as I say, to set that final price for that IPO today. It says it's planning to use the cash raised to pour into research and development of its AI technology. So you wonder whether it will be sort of a test case now for these companies looking to IPO in the face of some of this US pressure. But it's not the first blacklisting since time seen. It's already been put on a blacklist among a number of Chinese companies over in 2019, which banned them from buying products from the US without government approval. But it's yet to be seen, Matt, as I say, what implications this blacklisting will have for that IPO on December the 17th.
Makes sense. Sam, thank you very much for that. I thought you'd like that one. Let's go over to the Japanese markets now, shaping up like this in the Friday trading session. We are under pressure. The Nikkei 225 lower by about 0.4%. We are seeing a little bit more strength coming back through into the dollar-yen rate at 113.48. The heavyweights tracking like this at this particular moment in time. Fanuc, the only one moving to the upside. SoftBank shares are in focus. The FT reporting the tech conglomerate has offloaded over $500 million worth of WeWork debt at a discount rate to lure investors. SoftBank had provided those funds to WeWork to help the company tide over its liquidity crisis over a year ago. Meanwhile, SBI denying Nikkei reports that the firm is planning to apply for a bank holding firm by the end of the year. The Nikkei had said the move was in a bid to buy over a majority stake in Shinsei Bank. Shares in both of those companies moving higher. Well, let's go over to the Australian market. We are also seeing a bit of weakness coming through there for the S&P ASX 200, in line with regional counterparts, off by around about 0.5%. The Aussie dollar 71.53. Fortescue stock in focus. A big shake-up at the top. The company announcing that CEO Elizabeth Gaines will be stepping down as the miner expands its green energy push. Elizabeth Gaines has been CEO for the last 4 years and will remain with the company as a non-executive director. Sticking with the energy transition theme, and Australia's energy market operator saying the country will not need coal-fired power by 2043 as electricity demand soars. In a draft plan, it says that would require $8.6 billion in network investments to meet the need. Coal producers are sharply on the back foot in Australia today. Coming up next on the show, inflation and COVID not getting in the way of holiday shopping stateside, with Americans set to spend the most this Christmas season in about 3 years. What does it say about the state of the economy? More on that after the break.
Halftime report.
Welcome back. Let's give you a check-in on the cryptocurrency space, pulling back once again overnight. Bitcoin sliding below the $50,000 mark as risk appetite wanes, struggling to hold on to that very short rebound that we did see after last weekend's big declines. Right now, we've got Bitcoin sitting at 48,500 level. Let's get your check-in on the US futures picture as well, because investors watching for inflation data due stateside later on tonight for us Asia time. But amid the ongoing inflation worries and renewed economic concerns surrounding the COVID resurgence, Americans are still ready to spend this holiday period, as CNBC's Steve Leisman finds out in the CNBC All-America Economic Survey.
Downbeat on the economy, but upbeat on spending. The CNBC All-America Economic Survey finds Christmas cheer not making its way into Americans' views on the economy, but Americans still planning to hit the malls and spend online just the same. 41% of Americans believe the economy will get worse in the next year. That's a modest improvement from last quarter, but still far from normal levels of around 30% and down from a year ago. The number driven by a highly partisan split, with 67% of Republicans pessimistic on the outlook compared to just 16% of Democrats. Those negative views come as inflation has rocketed to the top of the list of concerns among the public. The survey of 800 Americans nationwide found 43% saying higher prices is one of their biggest concerns. That compares to 38% who pick the coronavirus. Immigration, crime, and climate change are the other main worries. Despite those negative economic views, Americans plan to spend 13% more this year on holiday gifts, or the most in 3 years, topping $1,000, with some saying they'll spend more because of higher earnings, others because of higher prices. One positive, 37% expect their wages to rise, and by a strong average of 5%. It's the highest wage expectation since the pandemic began. But expectations are muted for equities. Just 40% of those with $50,000 or more in the market say now is a good time to invest in stocks. That's well off the long-run average for this usually optimistic group of 55%. 36% saying it's a bad time, considerably more pessimistic than usual. With growth and the job market both relatively strong, inflation and the virus look to be the big factors influencing the public's mood. And while consumers look ready to do their part for the holiday season, negative views could affect spending in the months ahead. Steve Leisman, CNBC Business News.
Let's give you a look at how the FX majors are shaping up right now. Of course, we have that inflation data due out stateside later on. We've got the dollar index sitting at 96.185. We're seeing a bit of strength elsewhere. Aussie dollar 71.54. The Japanese yen weakening slightly, 113.49 there. And let's give you a look at cable holding at the 132.29 level right now. The Chinese yuan, this has been interesting. We've seen a weakening in the yuan right now. If you take a look at the spot rate, 636.82, offshore 637.29. We did have a weakening when it came to the midpoint setting a little bit earlier on, plus some other intervention out there in the currency, which has been sitting around 3-year highs. Let's get more and bring in Mayank Mishra now, global macro strategist at Standard Chartered Bank, joining us now from Singapore. Let's start off on the Chinese yuan. Were you surprised? Have you been surprised by the strength, and are you now surprised that we are seeing efforts to try and weaken the currency?
Sure. Thanks, Matt. Thank you for having me. I think on the Chinese yuan, frankly, it's not a surprise that policymakers are trying to contain the pace and extent of CNY strength, given that if you look at trade-weighted CNY basket, then it is sitting close to multi-year highs. We believe that the fundamentals remain very supportive for CNY. We know that the trade surplus is running at a record pace. At the same time, the border closures have shrunk the service account deficit. So we believe that given the positive current account dynamics as well as capital inflows, the CNY is likely to remain supported. We are not forecasting big gains from here. We are forecasting dollar CNY at 630 in Q1 next year. Likely to remain supported, stable around these levels.
Okay, 630 though, if you look at where we sit right now at 636, that's still a significant strengthening though for the currency from where we sit now.
Yeah, that is attributable to very strong fundamentals as I highlighted earlier. So we think that, that the currency is likely to continue to trade with a strengthening bias. But gains may be contained from here on, given, as I said, the overvaluation on the trade-weighted basket. So maybe there's not a lot of appetite for significant currency strength from here, but likely to trade with a strengthening bias.
Okay, let's go to the States now, because that inflation data is key. Everyone will be watching that when it crosses tonight for us, our time zone there. Are you expecting to see another hot print? The expectations, if you look at the year-on-year number, are around 6.7, 6.8%. There are some calls that we're going to see a number greater than 7%. What's your expectation? What is it going to mean for the Fed timeline? And then what is that also going to mean for where we sit on dollar index trading just a whisker above the 96 level right now?
Sure. No, so the inflation print obviously is key. Our forecast for today's print is in line with consensus pretty much. We are looking at headline around 6.8. I think the risk is skewed in terms of market reaction. Risk would be skewed towards a higher print. A higher print may lead to more volatility, especially if we cross that 7 figure. I think as far as the Fed pricing is concerned, I think Fed pricing for next couple of years is already looking pretty full here, with almost 3 hikes priced for next year, same for 2023. I think given that the Fed is, expected to announce accelerated tapering in December, there's still some uncertainty, around how the inflation narrative will shape up, what exactly will be the pace of tapering and subsequent hikes. There's still some uncertainty on the horizon, which is likely to keep dollar supported in the short term over the next couple of quarters, let's say. We still believe that, dollar is likely to weaken over the course of 2022, especially, maybe after Q2, when inflation starts to abate and, we get more clarity on the Fed policy trajectory. We believe that, some of the strength that we have seen in the dollar recently is likely to fade. But for now, we are focusing more on relative value trades. We have some positive stories in the likes of Aussie dollar, Korean won. Those are the currencies which we are placing our bullish bets on and funding it against the low yielders, instead of taking outright bets on the dollar for now.
Okay, unpack that for us in a little bit more detail. As we do see the US dollar strength fade over 2022, what do you think will be the beneficiaries there? Is it some of the names that you just mentioned, like the Aussie dollar, for instance?
Sure. So some of the currencies like the Aussie dollar or the Canadian dollar, right, they have very strong positive stories of their own. So they are likely to lead gains, especially, given that, again, these currencies continue to look undervalued versus their terms of trade. And their own central banks are moving towards policy normalization as well. In some instances, actually are expected to lead the Fed in policy normalization. So even rate differentials are positive for these currencies. So in the G10 space, again, Aussie and CAD are top picks. We have trades on against the low yielders there, against yen or against a broad G3 funding basket for CAD. In Asia, actually, if we look at the region, then again, some of the commodity exporters, the likes of Malaysian ringgit or Indonesian rupiah, we believe that, again, the fundamentals there are more supportive, and hence they are likely to lead gains when the broad dollar weakens.
Final question for you, a bit closer to where we are. You're bullish on the Singapore dollar going forward. Why?
So it's interesting that the Singapore dollar has paired some of the gains recently. So on our model, the Sing near, the SGD near is now around 60 basis points above mid, and which looks cheap to us given that the economy is reopening well. The MAS is already progressing with policy normalization. We expect them to normalize policy further in April. By increasing the slope of the near band further, and that suggests room for more upside on the near for us. So again, for Singapore dollar, we are long the currency versus a G3 funding basket in our trading portfolio.
Okay, we have to leave it there. Thank you very much for joining us. Mayank Mishra there from Standard Chartered Bank. Thanks for joining us. Well, coming up next on Street Signs, we'll talk about China's big reform drive. Beijing's undertaken some far-reaching ones in the past year. So more to come. We'll ask one expert who's just written a book about this very thing. That's coming up after the break.
Do you need a boost in...
Welcome back. Well, China's leaders outlining economic plans for 2022 this week. The Politburo saying that it will keep economic operations within a reasonable range next year after the central bank's second RRR cut this year. Beijing says it will continue implementing proactive fiscal policy and prudent monetary policy next year if needed, and emphasize stability in the property markets. The meeting comes as the government continues with its common prosperity push. Well, Isabella Weber is the assistant professor of economics at the University of Massachusetts Amherst. She's also the author of the book, How China Escaped Shock Therapy, the Market Reform Debate. And she is joining us now. A pleasure to see you there. Thank you very much for joining us. Let's talk about the book, How China Avoided Shock Therapy. Explain to us exactly what you mean by that, because from someone looking at the Chinese economy and, of course, a number of the regulatory moves over the last few years, you'd think that things are actually fairly shocking, but there might be a bit different meaning to the title of your book. So tell us exactly what you mean.
Thanks so much for having me on the show. Yes, shock therapy has a very specific meaning in this context. It's referring to one specific policy package which was coined in the context of the transitions from planned economies to market economies. It was, in fact, the kind of policy package that was implemented in many Eastern European countries and in Russia. The key components of this shock therapy program were price liberalization, privatization, trade liberalization, and all of that aided with macroeconomic austerity. So it's really a specific set of policies that, however, follows a certain kind of policy logic, which is that the free market is really the best possible economic model that an economy can desire to have.
Okay, well, with the rise of the Chinese economy and the exponential growth that we've seen, particularly over the last decades, has China succeeded and been, of course, a standout when it comes to moving from what you said there, from a planned economy into a markets-based economy?
Yeah, there can be no little doubt that China has pursued a very unique path, and that if we take growth, economic growth, GDP growth as the key indicator, that China has been extraordinarily successful in the way in which it has transitioned to a market economy. Now, that unique path involved, instead of trying to destroy the planned economy to make space for the market to emerge spontaneously, pretty much like Phoenix from the ashes, to use the institutions of the planned economy to create, shape, and steer markets. So as such, it's an economy that is a market economy, but where the state has played a constitutive role.
Right. Would you contend that that success is perhaps waning a little bit right now? If we, for instance, look at one of our top stories that we've been following today with respect to the Chinese property space and the fallout that we're seeing from the likes of Evergrande, where it played by global market rules and now looks as though we're going to see the property space in potentially a fair bit of trouble.
Well, what we are seeing right now is really a readjustment of the Chinese economy. I think it would be premature to predict that this would result in a collapse of the Chinese economy. It is certainly a guided deflating of a very important sector, the real estate sector, and it is a critical moment at which we are right now, and remains to be seen what happens as we are moving forward. But it's also quite clear that the Chinese government has put a lot of containment measures in place, trying to ring fence the China Evergrande case and to avoid ripple effects throughout the economy. So yes, 2021 is a year of readjustment, and in fact, it's a year of a creation of the announcement of the creation of a new kind of economic model in China. However, I think it would be premature to predict that this would result in an end to growth or anything like that, and for the Chinese economy as a whole.
Okay, let's talk about, of course, the common prosperity theme that we know that Beijing is looking to implement and is a driving force when it comes to its economic policy. You only have to look at what's been happening with stark regulatory overhang in the likes of the tech sector. And of course, this has raised the spectre of sovereign risk when it comes to, particularly from an investment point of view, people looking at some of these companies and suggesting, you know what, I'm not going to invest in them because there are just too many unknowns when it comes to the regulatory impost that's being imposed on a number of these big tech names. How does that marry with, of course, the growth and, of course, the evolving Chinese economy that you're an expert on and have been talking about?
Yeah, so if we go back to the 1980s, which is the first decade of reforms, which is the crossroads of reform where the kind of path that China has been on is being set, we can see that the discussion then was all about some getting rich first. But there's not only an emphasis on some getting rich, but there's also an emphasis on some getting rich first, which means that others should be becoming rich later. Now, this is basically the logic of common prosperity. So in the 80s, there was a commitment that the enormous growth that was that at the time was attempted to be unleashed would involve growing inequality, but that this inequality eventually should be steered against, and that eventually the logic of simply growing the cake should switch to a logic of a distribution of a growing cake. And this is precisely the kind of moment that we are in. And this is not coincidental that this is happening in 2021. After all, this is the year of the 100th anniversary of the party. So this is something that has in many ways been in the making for a very long time.
Just finally, quickly before we let you go as well, of course, when it comes to what we're seeing with the reform and regulation in the tech space, it's because there is some suggestion that a number of these tech names are simply too big and wield too much power and social influence. Is this going to be a theme that continues for some time, do you think?
So I think we have to remember that while China has deeply marketized, the logic has been to use markets as a tool in pursuit of larger political goals, first and foremost, development. This means that there is a constant balancing act of the power of private firms and the state. And this balancing act is particularly critical in essential sectors such as the tech sector. And as this sector has been becoming more and more important for the economy as a whole, it has also become more important as part of this balancing act. So I do not think that this balancing act is over at all. We will continue to see such a rearrangement of the relationship between private and state actors in the Chinese economy. How this will look like exactly really remains to be seen, but we have these big slogans out that indicate the direction, and namely common prosperity is one of the most important ones in this context.
Isabella, we appreciate your insights. Thank you very much for that, Isabella Weber there of the University of Massachusetts Amherst. Well, coming up next on the show, shares of Brazilian digital bank Nubank soaring in its first day of trade after the Buffett-backed company, the most valuable financial group in Latin America. We'll bring you those details when Street Signs returns.
Men over 40.
Well, shares of Brazilian digital bank Nubank surging in its New York debut. The Warren Buffett-backed company reaching a market cap of almost $50 billion by the end of the first day's trade, making it one of this year's largest IPOs. The CEO, David Velez, spoke with our US colleagues to discuss the potential of the Latin American market.
We were growing very fast up to a pandemic, but people still had some questions about digital banking. I think the concept of saving your money in a digital bank, in a bank without branches, was scary for still a lot of people. They wanted still to go to a banking branch, talk to a banking manager. The pandemic, in a way, forced that behavior change among the most of the population because branches were closed. And so it wasn't even an option. And people start trying us and they realized that it was a better option. We charge no fees, better customer experience, all in your smartphone. And suddenly we start seeing people in their 60s, in their 70s, in their 80s, people across the entire Brazil, all different municipalities in the north, in the south, using us. And when they started to use the product, they never went back. It was clearly a superior product. They liked our experience, and that has really accelerated kind of the growth. We now see that growth accelerating for us and are very excited to have a platform for effectively all Brazilians and Mexicans and Colombians where we are as well.
Right. David, your customer acquisition cost right now is quite low. $5 a customer, I think, by the latest numbers that I saw. Is that going to change over time? I mean, you're looking at a lot of customers who are just coming in organically, and that's great. But at some point, I imagine as you grow, there will be an upper limit at which you're going to have to start to pay to try to bring more customers in.
Yeah, I think it's like a couple of things are happening at the same time. On the one end, there might be a little bit more competition, but on the other end, there is just much more supply of customers. Customers are now seeing this as the real option for banking. And so all these trends are playing at the same time. Net for us, we have not seen any change at all in our CAC. Even after getting to almost 48 million customers, we would put us at one of the largest financial institutions in Latin America in terms of number of customers. So it is possible that at some point that happens, but we're also adding more products, adding more verticals, and ultimately having a better value proposition.
You mentioned competition, and there are sort of two fronts coming at you. Others that are trying to effectively ape what you're doing, meaning digital-only banks that are trying to compete with you, and the traditional banks, the legacy players who are desperate to try to both keep their customers, if not grow.
Yeah, no, that's right. So on both ends, there's competition. Ultimately, though, most of the customers are still in the big banks, and they end up having most of the 80 to 90% of the concentration of the system. But listen, the market is so large, and there is so much opportunity to make it bigger, because still there's over 200 million people in Latin America that have no access to banking. They're still putting their cash inside their mattress. So ultimately, over the next 5-10 years, that market should expand significantly, and there is a lot of space for a lot of people to grow and take share, and ultimately make a much more interesting market for everybody.
And we are watching for another market debut today, but this time over in Germany. Daimler Truck is set to list in Frankfurt today. The spin-off breaks up Daimler's passenger cars and commercial vehicle structures, which were under the same roof for over a century. The world's largest commercial vehicle maker has big plans for the near future, looking to sell 60% electric vehicles by the end of the decade. And our colleagues in Europe will be speaking to the chiefs of Daimler Truck and Daimler and Mercedes-Benz later on today. In the next hour of Street Science, Bank of America upbeat on Southeast Asia's 2022 growth outlook, expecting to see firmer growth in the region. We unpack that with the Bank of America's ASEAN economist later on in the show. Plus, we'll discuss the Asian startup scene with Sequoia India's managing director as it picks the first cohort of its mentorship program to promote women entrepreneurs in the region. That and more coming up after the break.
We're committed to
Welcome to the third and final hour of Street Signs here on CNBC this Friday. I'm Matthew Taylor in Singapore. These are the top stories that we're watching on the show today. Caution is the name of the game this Friday. Markets slipping ahead of key US inflation data. Evergrande shares are lower. Fitch declaring the indebted mainland developer and Kaiser in default. And Broadcom shares surge in extended trade after the chip maker delivers an upbeat outlook and announces a hefty $10 billion share buyback.
Live from CNBC studio at the Singapore Exchange, this is Street Signs.
Let's give you a look at how the Asian markets are faring this Friday. It is a mostly weaker picture after we did see an unconvincing performance on Wall Street in the overnight trading session. However, we are seeing some patches of green. The New Zealand market are just turning higher. We've got a gain there of around about 0.1%, way down the other end. I'm not going to walk all the way down there for you. The Malaysian market also trading to the upside, but broadly we are seeing negativity. Japan off by about 0.4%. Some of the tech-heavy markets are tracking weaker after we did see the Nasdaq sell down sharply in the overnight session on Wall Street. The Dow was flat, but we did see the Nasdaq sharply lower. The Thailand market closed today for a holiday as well. Let's go to the Greater China markets. We do have the mainland weaker by about 0.5%, and the Hang Seng Index lower by about 0.5%. We continue to track the fallout from Evergrande and Kaiser, of course, the woes gripping the property space in China. And Sam Vardis is here to give us an update on what we know with respect to finally officially a default for these companies.
Yeah, and a bit of a milestone, you could say, in that Evergrande episode, being called the defaulter for the very first time, with Fitch now downgrading both Evergrande and Kaiser after missing their debt obligations. This is a so-called restricted default, meaning that the company has experienced a default but hasn't started the next step, like any sort of bankruptcy filing. Fitch says that Evergrande hadn't responded to its request for confirmation about its payment obligations. Just as a recap, Evergrande did fail to make those coupon payments on that $82.5 million. This was due last month, and the 30-day grace period now coming and going. So there was that assumption that it hadn't made that payment. Authorities, it's important to point out, not too worried about this, it seems. We had the PBOC certainly reiterating, promising that they would protect Evergrande's shareholders and creditors. And so while we are seeing shares in Evergrande down today, we are seeing some weakness also when it comes to those real estate stocks sitting down around 1% lower as well. Off the back of this, but certainly there are some expectations that this situation will largely be managed. But we're also focusing on the Chinese currency today, because we have seen that spot rate certainly trading at its weakest level in a few weeks now, after the PBOC did set that midpoint weaker than expected. Right now, the US dollar Chinese yuan changing hands at 6.367 there, so firming up a bit from earlier this morning, but certainly has fallen from that more than 3-year high that we saw earlier in the week, that came off the back of the central bank actually raising the FX RRR from 7 to 9%. So the banks must set aside more now in their foreign exchange reserves. This will take effect from the December the 15th. They have done this before, Matt, earlier in the year over in May, but clearly it didn't work, and they are becoming increasingly uncomfortable with this rapid rise that we've seen in recent weeks.
Sam, thank you very much for that. Well, let's give you a quick check-in on the Hong Kong market now. The broader Hang Seng Index is weaker by around about 0.5%. We are now seeing the tech index tracking lower. I was talking about the performance that we saw with respect to the Nasdaq in the overnight trading session. It was off by about 1.7% versus an unchanged performance by the Dow, and that's pressuring some of the tech names across the Asia Pacific trading day. And you can see, with the exception of JD.com, we do have a number of those Chinese tech stocks listed in Hong Kong moving to the downside. Sylvia Shang is global multi-asset strategist at JP Morgan Asset Management, joining us from Hong Kong. Thanks very much for being there. Happy Friday to you. You're still pro-risk as we move into 2022, in particular overweight equities. Why?
So basically, it's really supported by our constructive macro outlook. If we look into 2022, we think global growth is likely to remain above trend. Well, on the policy side, we are seeing both monetary and fiscal policy moving away from maximum accommodation, but we would characterize the policy environment as less loose, but not tight. So the supportive macro environment really supports our pro-risk tilt in our portfolios. So we are still long equities, and we also like credit, although we think the room to the upside probably is more limited in credit compared to equities, given spread levels at the moment. And we have a modest underweight to duration. We think as the economy recovers further, there is room for yield to go up from current levels.
Okay, as we move into 2022 though, and we do start to see a normalization of policy, we of course get those key inflation numbers out of the United States tonight, potentially could hasten the path of the Federal Reserve when it comes to tapering and the potential liftoff of policy into 2022. Do you still stay as aggressive going into 2022 and particularly the back end of 2022 when we start to see, of course, this normalization of policy?
So actually, when we look back in history and look at the equity market's performance around the times where the Fed start to hike rates, especially the episode where the Fed actually hiked earlier than expected, for example, in 94, 2004, and 2015. Actually, those times, equity markets, especially DM equity markets, is actually held up relatively okay. They may have a bit of a pullback in the first 1 to 3 months, but after that, we do see positive performance. It's actually EM equities that tend to struggle a bit more with those instances. So overall, we don't think it should be a big concern for the overall equity markets. The Fed usually hike when the growth backdrop is strong, but maybe more of a relative value consideration where we could see a bit more headwinds on EM equities.
Okay, so preference there remains for DM developing markets based on the case you just outlined there. When you look across the Asia Pacific, is there a beneficiary of all of this when it comes to the DM space that you'd want to be invested in? And when you say you're overweight equities, any particular markets in Asia that you remain overweight in and particularly bullish in as we move into 2022?
So actually, one market that we prefer at the moment in the APAC is really Japan. So we think that from a growth perspective, there is more room for Japan to rebound, given they had been through many rounds of lockdowns and very strict restrictions because of the virus situation. And we think now improvement in the virus situation and continued improvement in vaccination rate probably pave the way for a stronger consumer consumption rebound going forward. We have already seen some signs of strength in the sentiment indicators, whether it's the Tankan indicator and also some of the consumer sentiment that is improving. So we think that growth rebound is likely to be stronger in Japan. That will likely to feed into stronger earnings momentum. And also valuation is not expensive either in Japan. It has been one of the laggards in DM markets. So that's why we do have a preference for Japan in Asia.
Is there a developed market then in Asia that you don't like, that you'd be avoiding, and it doesn't form part of your overweight equity thesis?
So I guess it's not like we don't like, maybe we're just a bit more cautious on some of the other markets in Asia. So actually on DM side, apart from Japan, we're probably more neutral on the other markets. But within Asia, we're just slightly more cautious on the EM Asia markets, given that we think China's growth momentum probably will remain relatively sluggish in the near term. And also one thing actually we're waiting for is for more stronger signal of policy easing coming out of China. We think that could be one catalyst for the EM Asia complex to perform a bit more stronger.
Okay, let's finish up then on the Chinese equity market then. We've been talking, of course, a lot today about what we're seeing when it comes to the currency there. Do you have an outlook? Are there any implications if we do continue to see either a stronger or weaker yuan on the Chinese equity position, given that we have, of course, seen the Chinese yuan sitting around a 3-year high for the last week or so. And of course, there have been some moves to try and dampen that strength in the last 24 hours or so.
So actually, our outlook for the Chinese yuan is really one of resilience. We think it will continue to remain relatively supported by a few factors. Firstly, from the strong trade surplus we have seen this year. And also, we continue to see very strong portfolio inflows to the bond and equity market. So we think that will continue to be a support. Obviously, looking into next year, the appreciation pressure is likely to be slightly less, given that we have that divergence in terms of policy cycle. China is shifting to a modest easing stance while the Fed is starting to tighten. And also on the export side, we do think we could see some moderation there after a very strong performance this year, given the normalization of some of the other markets in terms of supply chain. And also because of the stronger yuan, probably is going to start to become a bit of a headwind in terms of export competitiveness. So from that perspective, maybe a stronger yuan still going forward, but less appreciation pressure compared to this year.
Okay, Sylvia Shang of JP Morgan Asset Management, thank you very much for joining us on the show today. Well, coming up next, we're going to go back to, of course, one of the big earnings report cards out stateside, Broadcom delivering a strong report card, and the chip giant is looking at a future beyond semiconductors. More on that story next.
Nuts.com.
Welcome back. Well, Broadcom shares up sharply in extended trade stateside after that earnings beat. Let's get back out to Will, who's been tracking all of the developments when it comes to this earnings report card. Hey again, Will.
Hello again, Matt. Yeah, it was an absolutely bumper result for Broadcom. They saw some significant beats on estimates, both on the top and the bottom line. Just to run you through some of the numbers, we saw their Q4 adjusted EBITDA coming in around about $4.54 billion. That was up by 18.8%. For the full year, it was actually up by 21.4%. Their margins remained absolutely phenomenal for the period. And more importantly, they expect that to remain sticky moving forward into Q1 at the very least. So they're looking at around about an EBITDA margin of around about 60%. Now, there were a number of analysts on the call trying to goad their president and CEO Hock Tan about any kind of further guidance. And one of them actually from BOFA Securities did a little bit of the math, and we were talking about some of that math earlier on when it comes to the dividend being between 6 and 7 billion, the buybacks obviously being around about 10 billion US dollars. And basically, if you do the FCF ratio and apply all of that together, it does suggest that in FY 2022. They're going to be expecting sales of between 30 and 35 billion. Just to frame that into what we did see this time around, it was actually at around about that 27 billion US dollar mark. So that is a significant improvement. And obviously all of this is coming as the chip demand is absolutely astronomical at the same time. And you know, they've had supply chain issues. We were mentioning that in an earlier hour. They're really trying to work with their customers to ensure that they're not ordering things that they don't necessarily need. But so much of what Broadcom does obviously is centered around the semiconductors, but you've also got to start factoring in that the top 5 customers in their semis business comprise around about 30% of their revenues. So if anything was to go wrong, then that does result in a big issue for Broadcom. But what they're trying to do now, Matt, is really try and push their software side of their business. It was 25 or 26% of their revenue this time around, and that is their big growth driver moving forward.
Yeah, and it has been, as you say, diversifying into this software space. Any indication on more definitive future plans there?
Yeah, that's what's actually going to be really interesting, because everybody knows they bought CA a couple of years ago. They also bought Symantec. So there really is this, I suppose, inherent push by Broadcom to be looking at these opportunities, because a lot of people were expecting that perhaps some M&A was going to get announced today or some prospect of M&A, but instead they chose to go down the buyback route. Normally speaking, what Broadcom would be doing is splitting it half and half. So half would be going to their dividend, half would be going to the M&A front. But even if you look at some of the software numbers in terms of, even if they don't buy something now, you know, Hock-Tan said there is the potential to buy something next year. He's not ruling out the prospect of M&A. What is important when you do a comparison between the software and the semis business, it's something I alluded to just in that previous little bit then, is the fact that when you've got the semis business and it's so condensed within a limited amount of customers, it is inhibitive. But when you look at their enterprise software business, they've actually got some pretty good numbers, and it's based on a lot of customers. So just running through some of those numbers, 74% of their revenue from their software business, their enterprise software business, actually was 600 plus accounts. 129% renewal rate. So it's not only that people are maintaining their accounts with Broadcom, they're actually upvaluing. They're buying more from Broadcom, buying more services. So this is something that is exponentially going to grow, and it is only helped by the fact that they are only eyeing software and they're looking to roll up and then increase their earnings potential on that front. If you look at their ARR, that was at 5.2 billion. That was up by 5%. They've got a backlog of around about 40 billion when it does come to pipeline work. When it comes to their enterprise resource software, their average contract duration actually jumped from 2.6 years to 2.9 years. So all of these signs are really pointing to them being able to really build out this enterprise software business. And the good thing for them about that, Matt, is it's not as, I suppose, dependent on the fact that if you look at semis as a commodity, there's always going to be the risk that potentially with all of these companies building out all of these supply moving forward, Intel, Nvidia, everyone's trying to build out more supply. With a software customer, they're generally sticky, they're not going to go anywhere, and there's always that recurring revenue as well.
Yeah, absolutely. Well, thank you very much for that. Let's go to some breaking news that we are just getting in right now on one of our main stories that we're watching. And this relates to China's Sense Time, of course, being placed on a US blacklist report. China's Sense Time now says that it is discussing the fate of its $767 million Hong Kong IPO with the exchange after the US blacklist report. And this is according to sources only at this stage, being quoted on the Reuters news agency. Well, let's move on to some other stories that we are watching. Workers at a Starbucks store in Buffalo, New York, voting to form a union, making it the first in over 8,000 US locations to unionize. Employees will now begin to negotiate a contract for better wages, benefits, and working conditions. Experts say the Starbucks results may encourage union activity at other companies, and it comes amid a US labor shortage that has already led to higher wages at most large retail and restaurant chains. Starbucks shares closing lower by just shy of 1%. Meanwhile, over at Google, executives there saying that they have no plans to raise pays amid rising inflation, and the hike in salaries will be based on performance, and the company is trying to keep its pay competitive. The United States is currently bracing for inflation to climb to, of course, the highest level in 40 years. Well, let's go to some upgrades and downgrades. Morgan Stanley has made Apple its top pick for 2022. The bank has an overweight rating on the stock, raising its price target from $164 to $200. Morgan Stanley is cautious on the IT hardware sector as a whole, but expects Apple to benefit from a flight to quality. It also sees iPhone supply and the App Store surprising to the upside in the near term, moving its December quarter estimates higher. Elsewhere, Barclays is upgrading Twilio to overweight, but maintaining its price target of $375 a share. The analyst sees valuations are more reasonable compared to its peers. It's encouraged by the company's guidance for 30% organic growth over the next 3 years, as well as its newly formed customer engagement platform. Coming up next, Britain and Singapore agree on a landmark digital trade deal. We'll hear from the UK's APAC Trade Commissioner about the significance when Street Signs returns after this.
Why are millions of
Welcome back. Well, Singapore signing 3 deals on digital trade and cybersecurity with the United Kingdom in a bid to cut costs and slash red tape and make it easier for both countries to trade with each other. It's being touted as the first digitally focused trade pact signed by a European nation. The trading relationship between the countries is estimated to have hit $21 billion last year. Well, speaking to CNBC earlier, the UK Trade Commissioner for APAC, Natalie Black, saying that the deal will set the golden standard for the rest of the world.
This digital trade deal is the world's most comprehensive to date, and as you say, with the first European partner to sign this kind of deal. In fact, it goes further than the digital measures in the CPTPP, and I hope sets the tone for the kinds of trading relationships that we want to have around the world, that recognises the opportunities of the digital economy and how the economy is evolving.
Natalie, I believe you said in November that the UK's bid to join the CPTPP should be completed by the end of 2022. Does that time frame still stand?
It does. We are working incredibly hard to meet the high expectations of the CPTPP deal, and we're very grateful to all signatories who have been so supportive. But we take this opportunity really seriously. It's the heart of our trade strategy in this part of the world. And we are confident that we will be able to sign up by the end of next year.
Brilliant. Getting back to the DEA, UK-Singapore trade was worth £16 billion in 2020. If the Singapore DEA takes that relationship to the next level, then what can you tell us in terms of headline trade growth in the years to come?
Well, a significant proportion of that relationship is focused on services. And services in particular will benefit from this deal, particularly financial services. But as you know, with these kinds of deals, it's all about the implementation. So we have this fantastic announcement today. We are very proud that this is the world's most comprehensive digital trade deal, but we're also really focused on making sure that it works for all the different types of businesses that trade between the UK and Singapore. So whether that's SMEs, whether that's big corporates, or if that's big startups. And already we have a great track record of British businesses doing really well, not only in Singapore, but in fact across the whole region. And just this week, Revolut, one of our unicorns, announced that it secured a banking license in Singapore. And of course, we're very keen to see many more follow them.
Natalie, was the path towards a trade deal like Singapore DEA smoother, or was it tougher sledding in a post-Brexit environment? And does it provide anything of a blueprint for future digital economy trade deals moving forward?
Well, I think you have to look at our track record for the last couple of years, particularly in Asia Pacific. We've had a real concerted effort to build up partnerships in this part of the world. We have a new trade deal with Japan. We'll be celebrating the 1-year anniversary of that shortly. We have signed and agreed in principle new deals with Australia and New Zealand. Australia, in fact, is the very first deal that we have negotiated completely from scratch. And as I mentioned previously, we have aspirations around CPTPP. So we have a lot of ambition, and we are also delivering on that ambition. And so what we need to make sure is that now we have these deals in place, we are realizing the benefits, not only for British companies, but for the companies of all our partners in the region.
Well, coming up next on the show, from pandemic to endemic, Bank of America are out with its 2022 outlook for ASEAN economies. Which countries are likely to do better and why? We'll discuss that coming up when Street Signs returns after this. Well, let's give you a look at how the Japanese markets are shaping up right now. Of course, just back from the lunch break, and we do have the Nikkei 225 weaker by around about 0.5%. We're sitting at 28,574. The broader topic's doing a bit better with a decline there of about 0.4%. Dollar yen at 113.54. Some of the heavyweight stocks tracking like this. We are seeing fast retailing moving slightly higher. Chip makers, though, are amongst the laggards in the Japanese market today. Across the space there, you can see we've got Advantis weaker. In fact, we are seeing some gains, though, for the likes of Hitachi, Toshiba and Mitsubishi Electric. SoftBank shares tracking weaker. If we give you a look at what that stock's doing, off by 0.5%. The FT reporting the tech conglomerate has offloaded over $500 million worth of WeWork debt at a discount rate to lure investors. SoftBank had provided those funds to WeWork to help the company tide over its liquidity crisis over a year ago. And Hitachi shares one of the top gainers on the topics after a $2.6 billion deal with France's Alstom to build high-speed trains in the UK. The shares are higher by 2.5%. Watch the other company's stock trade in France when the European trading session gets up in a few hours from now. Well, checking on how Southeast Asian markets are doing today, we do have a negative picture and the Thailand market is closed for a holiday. But so far this year, the Thai market has outperformed its peers, with Singapore and Indonesia coming in second and third place. And Malaysian markets, the only one in the red, down by over 7% this year. Bank of America expects Southeast Asia to move from a pandemic to endemic strategy that will lift domestic growth. It forecasts the region will tack on 5.5% in terms of growth in the coming year. Well, let's bring in Mohammed Faiz Naguta, ASEAN economist at the Bank of America, joining us from Singapore. Great to see you there. Thank you very much for joining us. Okay, 5.5% growth over 2022. That's a step up from the just over 3% growth that we've witnessed in 2022. What's going to drive it? Because as we move into 2022, a number of the factors that have crimped growth in 2021 are going to remain.
Thanks, Matt. Yeah, I think there are a number of reasons why we think growth can move up next year. But let me start with the not so good news first. The external backdrop, when you look at the global economy is going to be slowing next year, at least growth-wise. And you're going to see, basically, we think the improvements in China will also be at a relatively slow pace. So the export sector, which has done really well this year, is not expected to continue to go at that kind of pace. We expect some moderation when it comes to the export sector. But on the other hand, and this is the reason why we think growth can still outperform this year, is because of what's happening in the domestic side of the economies. We think the ASEAN economies are in a much better position to deal with COVID. And that's why the title is From Pandemic to Endemic. We have high vaccination rates in places like Singapore, Malaysia, and Thailand. And even for the laggards, the vaccination rates are rising quite fast. We've got medical treatments. And more importantly, also the public health authorities have shifted their strategy away from a pandemic mindset to dealing with COVID as an endemic disease. And that means the restrictions, the hurdle rate for restrictions and nationwide lockdowns, we think will be very high. And that is going to propel private consumption, and domestic demand is going to uplift growth. And therefore, we think that the growth can come in even higher than what we have seen this year. One final point is on the commodity side as well. So we think energy prices, commodity prices of coal and palm oil will also remain elevated. And that's going to help countries like Malaysia and Indonesia at the margin too.
Okay, we'll get to some of those moves from, of course, pandemic to endemic in a moment. But I just want to talk, if we can, about what's happening with the supply chain, the recovery there, and how that is going to impact Southeast Asia. Because as we continue to see this supply chain bottleneck, tight supply chain, we're likely going to see the inflationary pressures remain for a while longer as a result of that. So how are these countries, number of them across Southeast Asia, going to deal and mitigate this high inflation story, particularly when it comes to things like food prices and the like, that could put a lid or keep a lid on domestic consumption?
It's a great question. I think for broad context first, if you look at globally, Asia and ASEAN have actually, the rise in inflation that we have seen is actually much more benign. We are not seeing the kind of high single-digit or double-digit inflation that's quite common across the world in the emerging markets. So Asia has done relatively well. We have had supply disruptions, but the demand surge has not been so robust yet to create the kind of price pressures. Moving into next year, as you said, demand is going to be improving. So there's going to be upward pressure on inflation, but it's coming from a relatively comfortable place. All across these markets, we think there's going to be an increase in underlying inflation, which is what we call basically inflation without food and energy. And that's really got to do with the improvements in demand. But on the other hand, we also expect oil prices to move higher. So that's also going to put inflationary pressures on certain economies such as Singapore, Thailand, and the Philippines. So for the region as a whole, we are calling for inflation to reach a 10-year high of 2.7% next year, which is up from 2.2% this year. But again, it's a 10-year high, but in the context of the global economy, 2.7% inflation is a very benign and comfortable place. So we think, policymakers will not need to respond to this in an undue or under pressure kind of manner, with the exception of certain countries where they have to keep an eye. And I think we live in one, Singapore. We have had inflation that's been creeping up higher. We have had high rental inflation, high pump prices, as well as electricity prices are going to go up. So policymakers here, I think, will be the ones who are most watchful of inflationary pressures relative to the rest of the region.
Okay, let's switch to essentially what the title of your report suggests, from pandemic to endemic. And we know that Southeast Asia has a large tourism, highly exposed to the tourism sector in Southeast Asia. How much of an issue is that for the recovery? Is that what's going to underpin the performance? And when you look across Southeast Asia, and we were just highlighting the fact that we've seen strong performance by the Thailand market when it comes to the equity performance, is Thailand going to lead this recovery if we're talking about 5.5% ASEAN growth as we move into 2022 or for the year of 2022?
So within that reopening and shift from pandemic to endemic, most of our optimism comes from domestic consumption. So we think it's really the domestic reopening and restrictions and people being able to dine out and consume services again. That underpins most of our optimism for next year. We are relatively conservative when it comes to the tourism reopening. Just take Thailand as an example. Thailand's pre-COVID tourism numbers used to be high 30, close to 40 million tourists per year. We are forecasting tourism arrivals next year to be at 6 million. So it's 15% of the pre-COVID levels. And most of that we think will happen only in the second half of the year. So we are relatively more conservative when it comes to the tourism recovery, even in places like Singapore, which has already reopened a lot of vaccinated travel lanes. It's not that easy to go in and out for leisure travel, for example. So, and then last but not least, don't forget that there is new variants, Omicron, going around. And while the news hasn't been all that terrible so far, it could have an outsized effect on the tourism sector, and it could delay the recovery in tourism by a couple of months or even quarters to say. So all in, still conservative when it comes to tourism. We still think that recovery in tourism is a multi-year story rather than a 2022 story.
Okay, good to know. Thank you very much for joining us on the show with those insights. Mohammed Fayez Naguta from the Bank of America. Well, coming up next on Street Signs, Sequoia India moves to address gender imbalances in the startup world through a new program to mentor women founders. We'll speak more with the managing director of Sequoia India when we come right back.
Thailand has built
Welcome back. Let's go over to the Indian market now. Paytm Payments Bank will now function as a scheduled payments bank after the central bank granted it a status upgrade. The niche bank can now participate in primary auctions, repo and reverse repos, but still cannot lend or issue credit cards on its own. Well, the startup scene in India continues to attract big money amid an accelerated shift to digitization during the pandemic. And there's now one VC fund focusing on women-led companies. Sequoia India has picked 15 companies led by 20 women founders from India, Pakistan, Singapore, Indonesia and Dubai for a $100,000 equity-free grant plus mentoring under the program called Sequoia Spark. Well, Rajan Anandan is the managing director of Sequoia India, joining us now from New Delhi. Great to see you there, and thank you very much for joining us. What inspired you to get behind this mentoring program, this mentorship programming, and explain it to us in a little bit more detail, if you can?
Yeah, thank you for having me this morning. So, if you look at the startup ecosystem across our region, right, Southeast Asia as well as India, as you know, we are very active investors across the entire region. Despite all the progress that we've made as an ecosystem over the last decade, there is a significant gender balance, right, when it comes to the startup ecosystem in our region, and it's true also across the world. So if you look at venture-funded startups, in India, only 12% of venture-funded startups have at least one female co-founder. In Southeast Asia, it's a little better, but still, only at 20%, right? So clearly, in our region, we need to have more than 12% in India and 20% in Southeast Asia of startups being founded by women. And what we're trying to do as a firm is to double down to encourage many more women to start up. So Spark is an initiative that we've had for several years. But what you're talking about is this week we launched the Spark, the Sequoia Capital Spark Fellowship Program. And what this is we picked 15 companies, as you just mentioned, 15 amazing companies, 20 incredible co-founders of these companies. And we're going to be working with them over a year's period. We've given them a $100,000 equity-free grant. And then we've actually matched each company with one of our senior investors who spend a significant amount of time with them. We've also got each of them buddied up with one of the seasoned founders, either from Southeast Asia or India, in our portfolio, who will also spend a lot of time with them. And then we're actually going to help them sort of through the year, on all the set of topics that are important to get a seed stage company up and running. So that's really what the Sparks Fellowship Program is. And we are incredibly excited. Of the 15 companies, we have 7 from Southeast Asia, we have 7 from India, and then we have 1 from the Middle East. And what's exciting here is they cut across the spectrum, right? From consumer internet, edtech, fintech, SaaS, and also we have a Web3 company, a crypto company that is co-founded by 2 incredible women from India. So it cuts across the spectrum. So that, in a nutshell, is what we've launched this week.
Right. Why do you think that representation, though, in the startup space when it comes to women is so low, is disproportionately low? You were going through some of the statistics there at the start of the discussion. Is it because lack of mentorship, so you're trying to address that through the program that you're doing, or is it the inability to access capital, to access venture capital funds to be able to really get the startup business off the ground?
So I think it's a great question. We've spent a lot of time trying to understand this. I'd say the single biggest gap that we see is actually mentoring, right? Deep mentoring. Female founders for different reasons don't have the same level of access and networks that let's say their counterparts do, right? And as a result we find are not able to get the same level of mentoring. And that's why we've decided to focus the Spark Fellowship entirely on mentoring, right? We do give a $100,000 sort of equity fee grant, but that's really meant to be a small part of the capital that they need in the early stages sort of to get to the next set of milestones. So I'd say mentoring is a very significant gap, but capital is also a gap, right? You can look at the numbers and the numbers speak for themselves, 12% in India and 20% in Southeast Asia. We do think, by the way, the capital there is, we have in our region, we have an abundance of capital, right? So in India, we've had over $30 billion of startup funding year to date. In Southeast Asia, the number is about half of that, so call it between 14 and 15 billion year to date. So we don't have a shortage of capital. And quite frankly, when we find the right set of entrepreneurs, right, we are able to invest. So if you look at the last cohort of Surge is Sequoia Capital India's seed stage platform where we provide capital and sort of a 15-week program. We had 10 female founders in our last cohort, right? So a third of our companies were actually founded by women, and in total we had 10 female founders in a cohort of 23. So we do think it's both of these, both mentoring as well as capital, and we're trying to really double down here on mentoring, which is where we think the most significant gap is.
Right. Let's talk about the startup space a little bit more broadly from a VC point of view. You mentioned a wide variety of companies with respect to what you're doing with the Spark program. But from Sequoia India's point of view, as an investor into new startups, what's hot right now? What are you really looking at and can't go past when it comes to targeting startups to invest in or back? We've been talking a lot about the transition in India to a digital economy and the rapid rate of digitization that we're seeing there. Is that where a lot of the smart money's going right now?
No, look, it's not just in India, right? As you know, we invest across India and Southeast Asia as well as South Asia. We are quite active now even in countries like Bangladesh. I would say, look, our region. When I say our region, it's sort of India, South Asia, and Southeast Asia has moved beyond innovation in only one or two sectors to innovation across the board, right? There was a period of time, whether you look at Indonesia or India or Singapore or Vietnam, we had one major sort of sphere of innovation, right? We saw a lot of e-commerce companies. Then we went through a period where we saw a lot of mobility companies, sort of Grab, Gojek, things like that. Then we went through sort of a period of fintech. But what we are seeing today, whether you pick India or Indonesia or Vietnam, or pick your favorite country in Southeast Asia or South Asia, is we're seeing innovation across many, many different segments, right? So it's become very broad-based. And in many ways, I think this decade, we're going to see innovation everywhere, right? In every sector, from fintech to edtech to digital health to agtech, right? So we made our first investment in Indian agriculture about 3 years ago, and today we have a very, very exciting portfolio of companies that are addressing various aspects of agriculture. Let's say in India, right? So today, it's not really concentrated in one space per se, right? We're seeing innovation across the board, but I'd say sort of the new space that has emerged very, very rapidly in 2021 is Web3, right? So you can think of it as crypto, but the sort of the expanded way we think about it is Web3. And as a firm, Sequoia Capital India, we have made 19 Web3 investments in just the last 6 months. So if you ask me, I think you're sitting in Singapore. You look at Singapore's very quickly becoming sort of a global hub for Web3 startups, right? We're seeing a significant amount of activity across Southeast Asia, particularly in Singapore and Vietnam when it comes to Web3.
Yeah, absolutely. Well, we appreciate you joining us on the show today. Thank you very much, Rajan Anandan there of Sequoia India. Thanks very much. Well, let's go over to the Indian markets now, just joining the trading day, the final trading session of the week. And we've got the Nifty 50 tracking weaker by around about 0.2%, 17,487, a decline there of 29 points. And the dollar rupee sitting at 75.61. Plenty more coming up for you on the other side of the break.
All around the
Well, if you haven't had your morning cup of coffee yet, well, you better get to it because I think it's almost lunchtime, actually. But the next time that you do, you may be served by a robot. Karen Gilchrist has been looking into one Singapore startup that's turned to robot baristas amid a labour crunch. I'm fascinated. Karen, tell us more about that.
Yeah, good morning, Matt. I don't know how you feel about having your morning brew served by a robot, but that is the new reality for commuters across Japan as of this week. After one of the country's major rail operators, JR East, has signed a deal to roll out Ella at two of its largest stations in Tokyo. This is Tokyo Station and Yokohama. Now, what is Ella, you might question? Ella is a fully autonomous robot barista who can brew up your cup of joe at 4 times the pace of her human counterpart. Now, this is the debut product from Crown Digital, which is an Internet of Things startup based here in Singapore that's trying to resolve some of the challenges in the food and beverage industry. Now, what's interesting here is this company was founded by a former wealth manager, Keith Tan, back in 2015. But initially, his vision was really to just roll out a chain of human-operated coffee shops. But faced with rising rents and the labour shortages in the F&B market, he decided to have a look to technology. So let's see his story.
Meet Ella, Singapore's first fully autonomous robot barista. Ella can whip up a fresh cup of joe at 4 times the rate of her human counterparts and will soon be available to subway passengers across the city-state.
And her creator? Well, he spent years in the finance industry before deciding to take a coffee break.
I was 35 years old in finance, and I thought, it's my chance. I have got to do something, build something for myself.
But it wasn't long after he got his joint off the ground that he began to discover the challenges of the food and beverage industry.
It's really hard to hire and retain staff for the F&B industry, especially in Singapore. Right? And I thought, I've just invested in this company. It's going to grow. It's going to grow more than that. So then I decided it's time to really look into technology.
With that, the idea for what is today Crown Digital was born. An Internet of Things startup aiming to address the difficulties within food and beverage.
Ella is the company's debut product. It came to life in 2018 after years of experimentation.
Encased in a transparent kiosk measuring 5 square meters, Ella's autonomous arm, which is produced by robotics company Techman Robot, operates around the clock and can serve up to 200 cups of coffee per hour. The ingredients, fresh milk and beans, only need to be topped up every 360 servings. This is monitored through an app, which alerts delivery drivers.
Our delivery drivers are following the apps, so the job scope will be sent to them through the mobile app. They know exactly when to top up, and when they do, our command center will be updated.
The command center can also detect and resolve spillages or machine faults remotely through inbuilt systems.
We are running multiple AI workloads that's monitoring different aspects of the production.
Ella is designed for high-density grab-and-go environments like airports, transport hubs, and offices, where speed is paramount.
There's opportunities where you just want speed, consistency, and ease of ordering, and that's where robotics can really come in.
That's really the aim of this partnership with JR East, which is piloting Ella up until late February with scope for rollout further across Japan. But you won't have to travel all that way to get your taste of Ella. She will be available at MRT subway stations across Singapore from later next year, so you can give it a taste, Matt.
Absolutely, Karen. And you asked me if I would mind receiving my coffee from a robot. Had some pretty robotic customer service in Singapore, so I'll give anything a go. Karen, thank you very much for that. And that does wrap up this edition of Street Signs this Friday. I'm Matthew Taylor in Singapore. The news with Shepard Smith is coming up next. Stay tuned to CNBC.
Speak first on top.
At the dawn of the 80s, it was exploding with opportunity.
Boom times. That's what the numbers signal today. An economy that's on a roll in this country.
A place to seek money, power, fame. Amid the glitz and greed, 5 titans seized their moment. But by the end of the decade, that moment had passed. And we'd put greed behind us for good. Or had we?
The President of the United States!
A hotshot developer was dodging questions about soaring debt.
Trump, the cash crunch.
And scandalous behavior.
Well, she's a fantastic woman, but I won't say anymore.
But the tabloids that helped make him were about to take him down.
You have a lot of very dishonest reporters, in my opinion.
A hard-charging prosecutor had become a candidate for mayor.
The word impossible is just not in my vocabulary.
But some in the city were growing tired of his crusades.
The people of our town don't want a prosecutor, they want a mayor.
A celebrity Don was back on trial, feeding a media frenzy.
The Gotti trial is the hottest show off Broadway.
And when the verdict was read,
the Teflon is gone, the Don is covered with Velcro.
Hundreds of Gotti supporters, outraged by that sentence, tried to storm the Brooklyn courthouse.
And while the former king of Wall Street was finally headed for jail, the Queen of Mean was mounting a last-ditch effort to remain a free woman.
Not guilty, not guilty. I am innocent.
You know, these are rats.
That was it. I'm going to take you out. You're going to take me out. This isn't going to end well.
I've never seen anybody so heartbroken in my life. She was devastated.
There was almost a daily feeling of how crazy this is.
These larger-than-life figures would forever change our idea of success.
My new game is Trump, the game.
And excess.
42 million.
And though at the end of the 80s we may have delighted in their downfall,
these are card-carrying, crashing egotists.
our celebration of their values was just beginning.
But you have said that if you ran for president, you'd win.
I think I'd have a very good chance.
Strong, smart, has done very well for himself for an ex-Chippendale dancer. A man who 5 minutes after he got here tried to buy our studio. So, who is this famous billionaire?
He was the man with the Midas touch, builder of golden towers, high-rolling casino operator, best-selling author, myth maker of epic proportions.
How rich are you, just basically, right now?
Well, it depends on which magazine you read.
I mean, how much you got in your wallet?
He was also sitting on a mountain of debt and an explosive personal secret. But with every breathless news report, his legend only grew, until it really did seem like his potential was limitless.
He had his buildings, he had his hotels. He presented himself, as he does now, as a man who was incredibly financially successful. Privately, his businesses were having more trouble than he would let on.
He was a guy who thought he was invincible from a business standpoint and also from a personal standpoint.
And he gets the idea in his head that he should be running everything.
Trump has said, quite seriously, that he's a good enough bargainer to negotiate a nuclear disarmament treaty with the Russians.
Donald first publicly talked about being president in 1987. He knew all he had to do was keep pressing ahead, and he would have a shot at it.
You have said that if you ran for president, you'd win.
I think I'd have a very good chance. I mean, I like to win.
Roger Stone, a longtime political operative, called him a prime piece of political horseflesh. It was his idea for Trump to go to Portsmouth, New Hampshire, where he gave a talk at a Rotary Club and created quite a stir.
This country is being taken such advantage of. We need strength. I mean, you think Gorbachev is tough. Think of this character, Khomeini. I mean, this son of a bitch is something like nobody's ever seen.
Trump wanted to create the notion that he was so
competent, that he was so great at what he did, that he could do the hardest, most important job in the world, and that's being president.
I love the country, but I think you're going to have probably George Bush as your next president. He's an excellent guy, an excellent man. He's a friend of mine, and I'm here for that reason.
And that was not a serious idea in the late 80s, but it planted a seed that this guy, a developer in New York, a celebrity, the author of The Art of the Deal, would be trafficking in political ideas. He was laying groundwork for what we would see decades later.
Good luck, everyone. Thank you all for being here.
Donald Trump had delusions of grandeur from the get-go. At the same time, big legitimate banks enabled Donald Trump. They kept giving him money.
Donald is already starting to file tax returns that would indicate he was losing money, not making money.
Is Donald Trump in financial trouble? Some in the financial community are looking for signs that Trump may be trying to raise cash because of a current or anticipated shortage caused by heavy debt.
But in the meantime, there was a constant flow of money from Wall Street and from investors. So when the opportunity came to grab a hold of the biggest, most luxurious casino in Atlantic City, the Taj Mahal, he took it.
Donald Trump today opened the doors to his billion-dollar gamble, his new Atlantic City casino, the Taj Mahal.
It had been under construction for several years. It was way over budget, but it was supposed to dominate the whole Atlantic City gambling scene.
The Taj Mahal stretches out over 17 acres along the boardwalk. There's glitz and glitter galore, $15 million worth of chandeliers and 1,200 luxury hotel rooms.
He buys it with entirely borrowed money, junk bond, $675 million at 14% interest. He's got over $250,000 a day bill just for interest on the bonds, and close to another $1 million a day to pay all the other bills of running the place, and of course paying out the few winners that were out there.
Trump executives insist they can make $1 million a day the experts say they'll need just to pay for the casino.
And that is something that had never happened at any casino anywhere in the world at that point. So it was not just ambitious, it was stupid.
I do have a risk. I do have a financial risk, but I have also a reputation risk, and that's very important to me.
From day one, there are hundreds of contractors and vendors who are delivering goods to him, and he's not paying them because he doesn't have the income to support all the borrowing he's done. And then the day came when Donald couldn't pay the monthly payments on his debt, and it's very clear that this is going to collapse.
There was almost a daily feeling of how crazy this is.
So $1 million a day, while it sounds like a lot of money for the building that we're talking about, should be very easily made.
We realized that Donald was uncontrollable.
Tune in for Tech Check.
1989. New York is a city overwhelmed by crime, crack, and corruption. The fear in our streets, parks, and subways all point to a city that is out of control.
He was the avenging U.S. attorney with an audacious crime-busting record, and he was now closer than ever to his ultimate goal of winning political office. With crime rates surging in 1989, no one seemed better suited to become New York City's next mayor.
From a policing perspective, it's a very violent era. This was a very constant topic of conversation, the level of violence in the city.
Giuliani ran as the law and order candidate, and New York needed more law and order.
As mayor, I will lead the battle to take our streets back, parks back, subways back from the criminals.
And saw this as an opportunity to clean up the city.
Giuliani remains a major threat to Koch's chances for a fourth term, assuming the mayor survives the Democratic primary, particularly the challenge from David Dinkins.
David Dinkins had risen through the ranks to become Manhattan Borough President, a somewhat powerful job.
During the primary, race relations were very tender. When Dinkins came in as someone who might be a healer.
I felt the rise of David Dinkins in the context of a series of racial events through the 80s. The Michael Stewart incident. There's the Eleanor Bumpers incident. The Howard Beach incident.
The victims were 3 black men whose car had broken down.
The crime problem, all too often in New York, is seen as a racial problem, but it's the incidents where blacks and whites interact that generate the headlines, that generate the tensions.
A Wall Street investment banker remains unconscious in very critical condition tonight after a brutal attack while she was jogging in Central Park.
The Central Park jogger case turned into one of the biggest rape cases we have ever seen in New York City. A young white woman was beaten badly, raped, and left for dead.
Today, police arrested 4 juveniles, ages 14 through 15, all charged with attempted murder and rape.
Black and Latino kids, whatever the police and the prosecutors said was accepted as fact.
The horrifying crime has sparked a new call for the death penalty. This one from billionaire developer Donald Trump.
Donald Trump takes out an ad in all the major newspapers calling for the death penalty before there's been a trial.
There's not a thing in the world wrong with hating in certain instances. And you have an instance here where you have killers roaming the street, preying on all of us.
He said what he said in that ad, and then he doubled down in a variety of other places. He gave license to think those things about those kids who didn't do it.
Amid this atmosphere of racial tension comes the murder of Yusuf Hawkins in Bensonhurst.
Police say 30 white teenagers armed with baseball bats and at least 1 gun attacked Hawkins and his 3 companions.
This confrontation leads to him being shot to death.
In the aftermath of the killing, racial tensions in Bensonhurst and New York City have mounted.
It rocks the city.
This is not Johannesburg. There are not racists in this community.
There's not racist community. We just don't like black people. People were feeling as if the city was reaching a point of ungovernability.
It's not enough for people to be angry. If you don't have somebody bringing change in policy and procedures, we'll never get ahead.
Koch was perceived more and more as a divisive figure, and that David Dinkins might be the solution to this.
In the minds of many, we weren't supposed to win, but nobody told us that.
After 12 years leading the city of New York, Ed Koch will no longer be mayor. Instead, David Dinkins, the president of the borough of Manhattan, is in a position to become the first black mayor of the nation's largest city.
You gave me your votes, and even more, in a tough time, you gave me your trust.
This year, Dinkins faces strong opposition from former U.S. Attorney Rudolph Giuliani.
On the day I become mayor, the old political system that is dragging the city down is out.
2 candidates were left to battle it out for the mayor's seat. One, a seasoned politician with a message of harmony and justice. The other, a righteous ex-lawman with a message of crime and punishment. Emphasis on the punishment.
Giuliani was a U.S. attorney coming in as the hardline guy. It's not about being the nice guy, it's about being the tough guy.
For a person who had mastered the New York media, Giuliani didn't have his message together. He had people making all these allegations relating to the character of Dinkins. It was clear that Giuliani would stoop to low levels to get elected.
Why does David Dinkins always wait until he gets caught? Rudy Giuliani, experience, integrity, and nobody owns him.
Rudy was a tough campaigner, but we were pretty good also.
I think the people of our town don't want a prosecutor, they want a mayor.
Well, wait a second. I think the people of this town want a mayor who has nothing to fear from a prosecutor.
I think it became an issue of who could really keep the city under control, and they both were running with different philosophies.
The people do not want a city divided against itself.
New York is a city overwhelmed by crime.
What can unite us is far stronger than the forces that can keep us apart.
Who can reduce crime better?
I know how he feels. I come from a background of people that have been excluded.
Who can get the drug problem under control better?
I propose to be mayor of all of the people.
Take our city back.
Mayor of all the people.
The word impossible is just not in my vocabulary.
We owe it to our children not to give up, give in, or turn back.
The biggest of all American cities has a black mayor, David Dinkins.
Dinkins beat Republican Rudolph Giuliani tonight.
David Dinkins' message of racial harmony was the key to that race. It wasn't the time for a prosecutor. It was the time for harmony.
In the end, it was sort of one of the closest mayoral elections in the history of New York.
It was close. You win by one vote. You're still the winner.
I've just spoken to Mayor-elect David Dinkins. No! Quiet!
Simply put, this was David Dinkins' time.
In the days ahead, I will meet with him and I will reach out to the many others across this city.
In many ways, Giuliani's run for mayor was an embarrassment. This was a person who had a very, very strong reputation.
After the loss to Dinkins, he says that the election was stolen from him because a lot of blacks and Puerto Ricans voted illegally in the outer boroughs. There's no evidence, but one of the defining characteristics of Rudy Giuliani is vindictiveness, is a desire to avenge any kind of defeat. And you can see that in 1989.
One of the fascinating things about the Giuliani story is that it was always hard to tell on any given day whether this was a good man or an evil man.
Through the lens of that time, you would have said he saw wrongdoing and was determined to punish it and halt it by any means necessary. I think you might look back and say maybe he's a man who really, in some ways, is no different than the people he prosecuted. He just had different tools in which to exercise his will to power.
In the totality of Giuliani's career, there was too much good and bad.
Why are so many people
What about all this news of more indictments? You think the government's going to frame you?
You guys and Giuliani should be in church.
Throughout the late 80s, New York's most notorious gangster had captivated the nation by strutting for cameras and skillfully dodging law enforcement. But in 1990, the feds had snagged him again. And this time, they had his own words to use against him.
Secret FBI tapes of reputed mob boss John Gotti reveal the dark and violent world of the Gambino crime family.
You tell this punk, me, John Gotti, I will sever your mother head.
Most of the discussions took place in an apartment 2 floors above Gotti's Ravenite Social Club in Little Italy, an apartment that Gotti had no idea was bugged by the FBI. Clearly, the man Gotti considers his closest ally, according to the tapes, is this man, Sammy the Bull Gravano.
About a year or so before we take them off the street, John Gotti made Sammy the underboss of the family. Sammy had the reputation of being a shooter and a killer. So he made sure that kind of stuff got done for John Gotti.
Right now, Gotti and Gravano were both behind bars together, awaiting trial, and Sammy Bull had listened to some of the tapes.
You know, these are rats. You know and I know that they know that you're taking the money to the table.
They got the tapes because they get to listen to the evidence that the government's going to present. And Sammy started hearing what John was saying in some of the conversations that he wasn't part of.
Gotti's bad-mouthing Gravano. Sammy's turning red. He just wants to burst.
Gotti was basically blaming him for all the murders that he was authorizing.
That was it. He and John were now on the outs, and, you know, I'm going to take you out, you're going to take me out, this isn't going to end well. And that's what, you know, put it in his head that he needed to find another way out.
He picks your finger. Ooh, the Godfather.
Since Joe Valace became the first sworn member of La Cosa Nostra to break the code of silence, only a small handful of low-level hoods have chosen to follow in violating that sacred code of omerta.
Well, the most significant rule in the mafia, the rule that enabled them to prevail and to succeed for as long as they did, was the rule of omerta, that is silence. You can't rat anyone out. If you're caught, you go do your time, you keep your mouth shut. Now, Sammy the Bull Gravano listened to the tapes. He knew that his goose was cooked.
Sammy Bull got the sense that he can get himself a good deal.
Sammy sent word that he wanted to speak to us. We had to go to the jail to take him out.
So they bring down Sammy, he gets in the car, we drive off to a safe house. I asked Sammy, says, tell us about the Castellano Blotti murder. Okay, so he just went from A to Z. I remember drawing a little map showing East 46th Street. I was here with John. Here are the shooters. He drew the whole thing.
He heard the tapes, said everything's accurate on it. I mean, you guys have his debt to rights. But, you know, he put me in those 5 murders, and I'm going to do life for it. He said, and you guys, I can trust you more than I can trust the mob. He says, I want to join Team America. John found out within that night where it got to him that Sammy had been pulled out, and he knew it was over. He just died inside.
Sammy the Bull Gravano has been transferred out of a federal prison and is reportedly talking to prosecutors.
John Gotti's closest ally, facing 50 years in prison, has joined the ranks of the Squealers.
The decision by Sammy Gravano to testify is certainly a big, big event. He knows where all the bodies are buried. Every news organization in the city was covering it. People inside, people outside the courthouse, people watching people who came. It was a huge thing.
In New York, the Gotti trial is the hottest show off Broadway, with spectators lining up as early as 2 in the morning, waiting hours for a chance to get inside the courtroom.
Mickey Rourke showed up. Anthony Quinn showed up.
This is one of the great dramas that's going on today.
A lot of people showed up to express their, concern and allegiance with poor John Gotti, who was being fingered by Sammy Gravano, the rat.
The trial of reputed mob leader John Gotti has begun in New York City.
When Sammy came out, you could have cut the air with a knife. I mean, the two of them stared each other down. I still think John probably felt sicker than Sammy.
If looks could kill, there were two people who would be falling down dead. He was a great witness. John Gotti barked, I bit. He owned up to the crimes he committed, and he fingered John Gotti for the murders that he authorized and running the crime family, in his image. He nailed him, to the cross.
Good morning, everybody. Mob boss John Gotti is facing life in prison after being convicted of all 13 counts against him. The jury concluded that he was responsible for murdering 5 associates in the Gambino crime family and was guilty of racketeering charges.
When the verdict came in, he just sat there. He tried to keep and stiff upper lip, but he knew that he was dead in the water, convicted, and going to go to jail for the rest of his life.
The Teflon is gone, the Don is covered with Velcro, and every charge in the indictment stuck.
Outside, hundreds of Gotti supporters, outraged by that sentence, tried to storm the Brooklyn courthouse.
The immediate reaction was a bunch of lunatics went down to the courthouse and started overturning cars. And people started screaming, "Free John Gotti."
John Gotti took power of the mob at the right time.
He was someone who was, out there when the media was looking for a godfather.
There was a kind of nostalgia aspect to John Gotti becoming this famous figure in the 80s. Mafiosi were regarded as high-stakes entertainment figures. They could kill each other, they could become famous, they wear fancy suits, and be on television all the time. And they're not gonna kill me. They're not gonna kill my children, so fine.
I think John was a product of what was going on in the 80s. The Page Six stuff was becoming big. Just being recognized on any platform was significant, and he fed into that. I mean, it consumed him.
I don't know what Gotti was thinking, because nobody ever gets away with it. Eventually, they're going to get caught unless they just die in their own beds. But I guess he enjoyed his run while he had it. All that acclaim and notoriety and attention. It was something that he craved.
Whatever power the mafia had, it's gone. The mafia would never be the same once John Gotti was put in charge and then once he goes away.
All this week it flirted with the 3,000 mark, but a recovering stock market comes too late to help some former moguls of the 80s. Many of the rich and famous now are not as rich, and some are infamous.
By 1990, the stock market may have recovered from the crash of '87, but the verdict was in. Greed was no longer good.
These are card-carrying, crashing egotists.
The heroes of the 1980s had become villains right before our eyes.
Another fallen mogul with a big ego, Ivan Boesky. He bribed people to give him inside information and made millions.
Ivan Boesky, he's not a guy who's going to be on a magazine cover ever again, but he did it. We're not doing it to him. He did it, and therefore should pay a price.
Boesky served his time, grew a beard, and was last seen testifying against a former friend in court.
Ivan Boesky or Dennis Levine or some of the other perpetrators, they were pariahs.
Ivan Boesky was a tragic figure, partly because he had talents. He was very disciplined. He worked very hard. But in the end, the lesson of New York in the 80s is greed wins out.
As fate set in and former masters of the universe were shamed by the city that once worshipped them, one wasn't giving up without a fight.
Harry and Leona Helmsley, one of the world's wealthiest couples, are charged tonight with cheating on their income taxes.
Accompanied by her husband, Harry, who wasn't well enough to stand trial, and pushing her way through a mob of photographers, Leona Helmsley arrived to learn her sentence.
Hang her by the toes.
I think she should be given the maximum.
Leona Helmsley was convicted of income tax evasion and aiding and assisting in the preparation of false tax returns. She was also found guilty for mail fraud relating to the New York State income tax returns.
Leona Helmsley won't go to prison right away. She left court with her husband free on bail to prepare an appeal.
I've done nothing wrong. I have done nothing wrong.
Leona Helmsley felt she was innocent.
I'm innocent.
And that she was indicted
Only because I'm Leona Helmsley.
that had she been a man in business, she clearly would have walked or been elected president. Once she was indicted, Leona Helmsley hired Gerald Pfeffer to defend her. He did not win the case. Of course, he went from being her hero to being some awful person, so she replaced him with Alan Dershowitz.
Our defense attorney, Alan Dershowitz, has promised to take her case all the way to the Supreme Court if necessary.
The joke is over. We're talking about putting a 71-year-old woman with an ailing husband in jail. Enough is enough.
We will file our brief in 3 weeks, and we will approve and assert
We will win.
total innocence.
At the urging of her new attorney, the Queen of Mean embarked on a media tour to rehabilitate her public image, or at least let them know how unfairly she'd been treated.
I got a $25 million bail. There's a man in Milwaukee that chops up people and eats them. Revolting story. He got $1 million bail. I've done nothing, and look what they have done to us. I'm not guilty, not guilty, not guilty. I am innocent.
Why she was going on television was to gain sympathy, but you have to first apologize, which she never did.
Leona blamed everybody for her own problems. She blamed the prosecutor, Rudolph Giuliani.
The government's out to get you, Leona.
Oh, yes. Mr. Giuliani, there's no question about it. I was a great stepping stone for him.
She blamed the ad company that developed the whole queen of the hotels. I think for those that were more steeped in Leonaism, it was a perfect expression. The queen of the mean, because she was such an unloving personality.
She was, in the perception of society, gratuitously cruel. She really defined the archetypal, paranoid bully, and that was her downfall.
She's 71. She's given millions to charity. Her husband's gravely ill, and she's on her way to prison.
She paid a $7 million fine. She was convicted to 4 years in jail and 250 hours of community service.
The judge has ordered her to begin serving her 4-year tax evasion sentence, ironically, on April 15th, tax day.
Everything we've heard about her is absolutely vile. From the testimony tidbits from her terrible trial. But her reign of terror is over, because Leon is going to, yes, any day she's going to. Leona's going to jail.
What's on your holiday?
I wonder what Trump's game is this time.
Mr. Trump, Mr. Trump, Mr. Trump, please.
My new game is Trump, the game.
Trump, the game. It's not whether you win or lose. It's whether you win.
Yes! I think you'll like it.
For years, the developer turned superstar had been tempting fate in matters both professional and personal. And now they were coming to a head. In Atlantic City, his casinos were teetering on the edge, while his marriage was on equally shaky ground.
By the late 80s, he wants more and more and more in terms of objects, totems of wealth, but he also wants somebody else.
We think that's her on the right, or at least Donald Trump brought a woman who looks a lot like Marla to a party thrown by Ted Turner in 1988.
He was stowing Marla Maples in his casinos, in his hotels. Eventually, this would all come to light.
The chatter is getting louder and louder and louder. And then the story broke.
One of the nation's most publicly married couples is heading for a very public divorce.
He was accused of consorting with an attractive young woman named Marla Maples. Lurid newspaper headlines made much of that.
There's really nothing more Trumpian than the way that their divorce played out. And it was all dished out and eaten up by the tabloids.
Marla Maples saying the best sex I ever had. If that was said about most human beings, they would not get out of bed that day. Donald Trump glorified it. He said, this is wonderful.
Well, she's a fantastic woman, but I won't say any more on the air. We're here to cover a boxing match.
I mean, Ivana was, I've never seen anybody so heartbroken in my life as she was. She was devastated.
Poor thing. Some people think this first celebrity divorce of the 90s is something serious being turned into a circus.
No matter who it is, separations are sad.
Ultimately, I think Ivana won. She was the sympathetic figure who had been wronged by her husband, who was bragging about his affair with another woman. It was not the best look for him. It was sort of the moment where he lost control of his ability to dictate what the narrative would be. And that irked him more than just about anything.
You have a lot of very dishonest reporters, in my opinion. And I mean dishonest. I'm not talking about they're slightly off. I mean they are totally dishonest, where they'll report things knowingly that they're wrong.
It is this demarcation point when we learn that Trump's going to get divorced, and Trump actually is probably not nearly as rich as we thought. Stuff starts to unravel pretty quickly for Trump in 1990.
He can't pay the interest payments on the Taj Mahal, his newest casino. The Trump shuttle collapses. He can't run the Plaza Hotel in New York that he grossly overpaid for.
Within months, this was not a viable enterprise.
Donald could even lose the dome of his new gambling casino, the Taj Mahal. He hasn't finished paying for it, and there's talk that the contractor might repossess it.
The Trump Organization, one of the glitziest companies in America, confirmed today that it is in meetings with bankers in an attempt to reorganize its vast debt.
Over 1,000 lawyers were working on this case. 1,000 lawyers trying to sort out Donald Trump's finances.
The New Jersey Casino Control Commission has unanimously approved Donald Trump's bailout plan. That plan allows him to use his 3 Atlantic City casinos as collateral for his $65 million loan.
He borrowed so brazenly that he was, in effect, too big to fail. The banks did not let him go down.
The banks can't afford to let him go broke. Katie, they would go broke. So they've got to let the Donald be the Donald.
After casino regulators approved Donald Trump's out-of-court corporate bankruptcy that he doesn't want to call bankruptcy, what does he do? He walks out in front of the cameras and goes, "This is a great day for Donald Trump. This is a huge victory."
We had a great victory. I'm happy as hell. Thank you very much.
Well, you know what it was? He didn't have to pay people back, and he walked away a wealthy man, leaving all this damage behind him.
His empire is saved, at least temporarily, but his public image ain't what it used to be.
After he was exposed, it was time for America not to take him as seriously as we once did in the 1980s.
There was a good reason to think by the early 90s that Donald Trump's time had passed. He's not the success he claims to be. It was over.
He was not in exile exactly, but considered to be a little bit closer to a clown. He was just a guy who was famous and had crazy hair.
Green Acres is the place to be. Farm living is the life for me. Mr. and Mrs. Donald Trump.
Donald Trump would show up sort of randomly in cameos in television shows, in movies. In one of the Home Alone sequels, all of a sudden there's Donald Trump.
Excuse me, where's the lobby?
Down the hall and to the left.
Thanks.
Anything to keep himself going.
You know, when people ask me, well, what are his virtues? Indefatigable. Relentless.
Here he was, last man standing. And that was the story that he told. And pretty soon, people forgot about all the problems.
The most important thing Donald Trump learned was not to change his ways. It was not to be more responsible with money. It was, I can't be killed. I'm too big to fail. In spite of all the excesses of the 80s, he survived in the 90s because of those excesses. What a takeaway.
This is not just a monument.
Those of us old enough to remember the 1970s, when we wander around New York today, we drive our children crazy. It used to be so dirty. It used to be so dangerous. It used to be decaying. And all of a sudden, it's as if Cinderella's fairy godmother came and eliminated crime and eliminated grime and made towers grow and made a city that looked like it was on its way to becoming the ash heap of history into the next great center of civilization. And yet, those things come with a cost. And New York City not only symbolizes all the great that occurred in the 1980s, but the underlying hangover from the 1980s.
In the 80s, the idea of the American dream was transported. It became an individual dream. It was about individual success and individual power. And we didn't, unfortunately, care enough about how they attained that success and how they attained that wealth.
The American dream actually is very deceiving.
The self-flattering idea of America is a place where you play by the rules and you're industrious, you'll do well. Well, here are all these people who became unreasonably, fabulously, financially successful by breaking the rules.
You will lie, you will cheat, you will steal, you will backstab, because doing it the right way takes too long.
Money. Who's got it? Is there an unelected elite that rules our town?
In the moment, it may seem as though it was just a temporary change, that America kind of lost its mind for a few years there in the 1980s, that all these people got their comeuppance, whether it's Ivan Boesky, who became a pariah, Donald Trump, whose company went bankrupt before, of course, reinventing himself, Leona Helmsley, who becomes a figure of total ridicule, John Gotti, who finally gets nailed, and Rudy Giuliani, who was ruthlessly ambitious, who lost his first mayoral race in 1989. What seemed like kind of a fleeting moment is, in fact, a defining moment, because the legacy of those years are what we are living with now, this obsession with wealth, with celebrity, this sort of turning away from the idea that, it's part of your job as a citizen to take care of other people.
Today, there's so much ink spilled about the Kardashians and Instagram influencers, how they have corrupted society, how these people don't deserve to be successful. It's all based on nothing and based on a lie. But what we're seeing today started in New York in the 80s by people who were also making up their own realities, exaggerating their own successes, greedy in a way that we had never seen before, and willing to do whatever it took in order to propagate these myths.
Wall Street, it's still fueled by the greed, by fear, by testosterone. And so we can sit here and talk about Ivan Boesky and Michael Milk, and young people beside the TV can say, who the heck are those guys? Well, they're the same guys that are working on Wall Street today. It's all the same. It's all the same, just different names.
And we had another huge round of insider trading scandals again in the 2000s. There's something about it, about the risk-free potential to make so much money that some people just find irresistible.
I think today we see the underbelly of it. We see that so much of it was about smoke and mirrors, was a house of cards. And I think that's been a real punch to the gut for a lot of people.
Hundreds of Occupy Wall Street protesters gathered. People spilling into the streets, their message underscored with star power.
There's so much anger, and so much alienation, and so much fear, and so much partisanship. That great disconnect of today is rooted in the 1980s. It's rooted in the high and the low. It's rooted in the great excess that also meant that we no longer judged ourselves by normal standards, by our neighbors' standards, but by celebrity standards, and came at the cost of our souls. So as we wander around New York City in the 21st century, we start seeing symbols of the American dream with an asterisk. The American dream
tarnished the American dream at what cost?
No, it isn't truth. Truth isn't truth.
I, Donald John Trump, do solemnly swear.
I ended up losing.
Hello and welcome to Capital Connection this Friday. I'm Matthew Taylor in Singapore. These are the top stories we're watching on the show today. Markets taking a bit of a breather as Wall Street snaps its three-day winning streak, with all eyes on key US inflation data due tonight Asia time. Also adding to the caution, Fitch downgrading Evergrande and Kaiser to default status after the property developers missed payment deadlines on offshore bonds. And an earnings beat, a dividend hike and a hefty $10 billion share buyback, all helping to lift Broadcom shares after the bell. Well, Asian markets right now looking a bit patchy to end out the trading week. We did see a split picture on Wall Street in the overnight trading session, where we did have the Dow essentially closing little change from where it started the trading session, but some big falls for the Nasdaq, and that is hitting some of the tech-heavy markets across the Asia Pacific. Take a look at the TAIEX. You can see off by about 0.5%. The South Korean market also declining by about 0.75%. The New Zealand market has closed for the day, one of the lone standouts to move to the upside. And the Australian market is just closing as we speak as well. The S&P ASX 200 lower by about 0.4%. The Hong Kong market is back from the lunch break looking like this. We do have the Hang Seng Index weaker in the order of about 0.5%, 118 points weaker. We are seeing some of the tech names there dragging on the overall index after that weakness that I was talking about with respect to the NASDAQ, the only gainer. And this has been a similar story throughout the course of the morning trading session. JD.com moving higher, but the rest moving lower, as you can see. Well, to our top story now, Fitch becoming the first ratings agency to cut Evergrande and Kaiser to default status. Sam Vardis is joining us now with those details and plenty more on the China market, but this was not unexpected in terms of what we're hearing when it comes to those missed offshore payments.
No, absolutely not. But Evergrande being called a defaulter for the very first time, certainly marking a milestone in this whole episode we've been covering for some time now. Fitch now downgrading, as Matt said, Evergrande and Kaiser over those missed debt obligations on their offshore bonds. This is a so-called restricted default, meaning that a company has experienced a default but hasn't started the next step of, any sort of bankruptcy filing. Fitch did say Evergrande has not responded to the request for confirmation on its debt obligations. But of course, it did miss that coupon payment of $82.5 million, which was due last month. That 30-day grace period has now come and gone, certainly pointing to the assumption that this has not been paid. The PBOC had said that Evergrande's problem was mainly caused by its own mismanagement, of course, and a breakneck expansion, adding that the risk caused in the short term won't have an impact on the long run. So the PBOC governor reiterated this today while promising to protect Evergrande's shareholders and creditors. And so we are seeing shares in Evergrande down around 0.6%, just out of the lunch break. We're also seeing those real estate stocks over on mainland China down some 1.5%, actually one of the underperformers in the mainland markets today. Matt, back to you.
We've also got some other news, Sam, with respect to SenseTime maybe reconsidering its Hong Kong IPO. Tell us why.
Yeah, we first learned about all of this, Matt, from an FT report actually saying that the US was now considering putting SenseTime on an investment blacklist today. This is over some concerns about alleged human rights abuses over in Xinjiang, and was actually apparently part of moves to mark Human Rights Day. But we've since seen Reuters coming out saying that the company is now discussing its fate of its IPO with the Hong Kong Stock Exchange, because, of course, the timing of this blacklisting was significant because it comes as the company is trying to tie loose ends on that IPO. It was to be setting a pricing today. Those shares are going to be starting trade over in December the 17th. FT sources had said that the AI company had not been made aware that it would be put on this blacklist, and that those working on finalizing the IPO had been taken by surprise by this. The US Treasury will reportedly put SenseTime on a blacklist. It's called Chinese Military Industrial Complex Companies, which then means Americans won't be able to actually trade into the IPO after Biden did sign that executive order earlier in the year, effectively banning Americans from being able to invest in these companies that find themselves on a US blacklist. SenseTime is one of the leaders, it's important to point out, in facial recognition technology, which is widely used over in China. But of course, Matt, there have been a lot of concerns about that, and particularly how it may be being used over in Xinjiang with those Uyghur Muslims.
Absolutely. Sam, thank you very much for that update. Well, let's go to the close on Wall Street, because the negative sentiment that we do have across the Asia Pacific coming from that session, US stocks snapping a 3-day winning streak. And as I mentioned, the Dow was basically unchanged, but we did see some hefty losses for the NASDAQ, off by 1.7%. Even as we got weekly jobless claims falling to the lowest level in over 5 decades, investors now turning their attention to the US November CPI data due tonight and what that could mean for the next Fed meeting, which is, of course, next week. US Treasury yields a little shakier ahead of that data point. We've got the 10-year tracking below the 150 level, 149.57. In terms of some of the big tech names on Wall Street, we did have a weaker session across the board, but there wasn't a whole lot in it, with the exception of Amazon, which was down by more than 1%. US futures tracking like this ahead of the Friday trading session on Wall Street, and we are negative, but only modestly negative. The implied open for the Dow weaker by some 54 points. Modest declines also for the SP 500 and the Nasdaq. The Senate clearing a key hurdle just hours ago to raise the debt limit, averting a government default. It's the first of two bills needed to raise the debt ceiling, with the second bill likely to pass with a simple majority. Well, let's go over to Olivia Dacia, Head of Applied Research APAC at Contigo, joining us from Singapore today. Thank you very much for being there and great to see you. Let's start off with the United States and, of course, the inflation picture that we will be getting out later tonight in the Asia time zone. It is expected to show another hot print, 0.7% month on month, about 6.7, 6.8% on the year-on-year read. What is your expectation? And if we do again get another hot print on inflation, we know the Fed has said that it's abandoning the term transitory to describe the inflation outlook. What is it going to mean for the timeline when it does come to the meeting next week, the Fed taper, and the eventual liftoff of rates?
So inflation has been obviously the hot button for investors all year. In fact, if we look at inflation and commodity prices together, they explain about half of the returns on the US market and about 58% of the returns in the European market. So we know that inflation is something that investors care deeply about. They've been told by central banks that this was transitory, and they believed it at first, but now, especially since August, the data readings have been very, very high. We're expecting again another 6% tonight, so that's again way higher than the 2% target. So the danger now for markets is that investors start to think that Feds and the ECB are behind the curve on that, because obviously if they are behind the curve and they cannot orchestrate a kind of a inflationary soft landing, they'll have to go for the hard landing option, which is something that markets obviously would like to avoid.
Okay, so with all of that in mind, how do you frame your investments as we move into 2022? Because you say that 2022 is going to be a year of volatility. There's going to be very little in the way of both fiscal and monetary support there for the markets.
That's right. So it's been quite interesting the last couple of years. So 2020 was a risk-on year, bullish and strategies outperformed, but in 2021, risk-averse strategies have outperformed because of this uncertainty about inflation, because of this uncertainty about the pandemic, and so on and so forth. And this is likely to go on in 2022 because on top of concerns about inflation and whether or not the central banks are ahead of the curves or behind the curves, you also have geopolitics that is starting to flare up as well, right? The relationship between the US and China is not getting any better. You have Belarus, you have Russia and Ukraine, you have France and the UK. So there are flare-ups everywhere. Iran pulled out of the nuclear talks. So geopolitics is also going to be there. What happens when uncertainty rises is that markets tend not to reward risk-taking when that happens. So we expect that for next year, a risk-off or a low-risk strategy will probably outperform.
Okay, a low-risk strategy to outperform. What about when it comes to one of our top stories today with respect to, of course, the Chinese property space? And now we've got essentially confirmation of this default from the likes of Evergrande and Kaiser as well. When you look at, for instance, the Chinese market, we know it's been bereft with the regulatory overhang in, for instance, the tech space over the course of 2021. Do you tread carefully in light of the situation that has evolved with the property market, the property sector in China?
Well, interestingly, for the high yield market, a lot of it is Chinese borrowers, and a lot of that is real estate or property borrowers. So there is a little bit of a risk for that market. And if we look at globally in the US dollar high yield market, that has outperformed in terms of total returns, the investment grade market. They've benefited greatly in the last 2 years of a shrinking of the credit spreads. And that is probably is something that's going to reverse next year, especially if we get more of these kinds of defaults where we're going to see credit spreads widen. On top of that, you will have interest rate risk, which will increase with the Fed changing their stance. So you could see an underperformance next year from the high yield segment, which would reverse the outperformance they've had in the last 2 years.
Olivia, we have to wrap it up there. Thank you very much for your insights and enjoy the rest of your Friday. Olivia Dacia there of Contigo. Well, coming up next on the show, Broadcom shares surging after the bell as the chipmaker sees a beat on earnings and announces a multi-billion-dollar buyback plan. Those details coming at you right after the break. Well, Broadcom shares could see a big pop on Wall Street tonight, Asia time, if the after-hours gains hold. The chipmaker reporting an earnings beat and a big share buyback. Will Kalouris is on the story for us and has the details. Hey, Will.
Good afternoon, Matt. Yeah, that's exactly right. Broadcom's numbers were absolutely sensational. They saw some significant growth and significant beats on the top and bottom line when it does come to the analyst expectations. So their adjusted EBITDA for Q4, $4.54 billion. That was up 18.8% year on year. And they saw growth across the board, not just in their semis division, but also importantly in their software division as well. But the big thing for investors, the big thing that did drive that aftermarket action was the fact that they also upped their dividend guidance for the full year by a further 14%. So now they're paying out $4.10 a share in each consecutive quarter. And at the same time, they also upped their revenue guidance to $7.6 billion for the first quarter. They didn't want to be drawn out when it did come to their full year 22 guidance when it does come to sales, but some of the math would suggest that it could be in the range of around about 30 to 35 billion at the same time. Now, all of this, we saw those incredible numbers. We heard the commentary from the CEO, Hock Tan, as well about his expectations when it does come to moving forward for Broadcom, their investment that they are looking at in terms of R&D. They're looking to spend big and really try and over-compete with their competitors at the moment. They said they want to over-invest. They want to really push the R&D budget in 2022, for 23 and 24. And the market seems to like everything that came out of this missive today from the company, because it's not just the aftermarket trading. We actually saw some significant re-rates. So Credit Suisse had them pegged at $620 a share. Now they're looking at $700. Wells Fargo from $565 to $635. Piper Sandler $550 to $680. Cohen $500 to $615. So there does seem to be this belief there, Matt, that they are set for even better things moving forward into FY22.
Will, thank you very much for that. Well, moving on, staying with tech though, Amazon shares taking a hit overnight after getting hit with a fine out of Italy. Let's tell you more about this particular story because It's the e-commerce giant's accused of favouring sellers that used its warehousing and delivery services and has been ordered to rectify the situation. Amazon called the fine and remedial order unjustified and disproportionate. It's also facing similar accusations from the EU antitrust regulator. Commissioner Marguerite Vestager spoke to CNBC about the issues.
Well, of course, we've been comparing notes with the Italian competition authorities. They have a very specific case for the Italian market. And when we opened one of our Amazon cases, of course, we made a carve out in order for them to continue what they were already doing.
So they didn't steal your thunder here.
Well, you know, it's not about stealing thunder. It's about making sure that the market is open and contestable. And I think a case like this one contributes exactly to this purpose.
Amazon, no surprise to you, I'm sure, is going to appeal the case. They say it's unfair. They say it's a disproportionate fine. And they also say in the statement, I just want to read you a part of it because it resonated. Large companies are not dominant just because they are large. And the presumption that success can only be the result of anti-competitive behavior is simply wrong. How do you respond to that?
Well, I think it's unrelated to the case and the assessment of the Italian authorities. Of course, it is a valid point that being successful doesn't mean you've done something wrong, and being big is not a symptom that you will be doing something wrong. So I think it's important to have these discussions, but. When it comes, for instance, to retail, there is a difference between brick and mortar retail and online marketplaces. I think everyone can see that also intuitively, and that, of course, is part of the foundation also for the cases of the European Commission.
So do you think Amazon is acting anti-competitively by giving unfair treatment to its third-party sellers that use its own services, its shipping services? Do you agree with that?
Well, we are looking into a similar issue, but we have no conclusions yet, so that I don't know. We're also looking into the issue of Amazon, enabling the data from the small merchants of the Amazon marketplace to be available for Amazon retail, and by doing that, giving them a huge competitive advantage. So we have a data case just as well as a case about how to get into the buy box. Does that depend on whether you use Amazon fulfillment or not?
Well, the European Commission continues to clamp down on the tech sector, turning its sights now to the online gig economy. It's announced draft rules to give employee benefits to drivers for online delivery apps. A lobby group that includes Uber, Deliveroo and Delivery Hero says the proposed rules will lead to job losses, but labour unions are largely in favour of the move as it entitles employees to paid holidays and pension rights on top of a minimum wage. Coming up next on the show, the US expanding its booster program to include 16 and 17-year-olds as it tries to stem the spread of the Omicron variant. Those details are right after the break.
Men everywhere.
Welcome back. The EU is expected to go ahead with a plan to limit the duration of COVID certificates. According to Reuters, the bloc is close to agreeing to limit the duration of COVID passes to 9 months for travel around the bloc. Some states still voicing their concerns that the limit could hold back travel. Separately, the EU executive is mulling compulsory PCR tests on travellers from outside of the Eurozone as concerns about the Omicron variant linger. Well, stateside now, and the CDC has given the green light for 16 and 17-year-olds to get Pfizer booster shots. The US is racing to get more people inoculated with a third dose amid concerns about the new variant and a possible surge in cases this winter. Over 50 million Americans have now received a booster shot. Well, let's bring in Paul Tumbia now, Professor of the Department of Medicine at the NUS Yongloo Lin School of Medicine, joining us from elsewhere in Singapore. Great to see you there. Thanks very much. It's now been several weeks since we've really heard about the Omicron variant, or the detection of the Omicron variant. Are we any closer yet to knowing exactly how virulent this strain is and how much of a threat it poses to the community?
Well, we still haven't seen any peer-reviewed publications about the virulence of the strain. But what is encouraging is we've seen a report from South Africa which gives a detailed clinical account of the cases of the Omicron variant in South Africa. And it has a good comparison with the same time during the Alpha, during the Beta, the Delta, and the original Wuhan strain cases. And what we've seen actually looks quite promising. It does appear to be more transmissible, but the fatality rate, the number of people requiring oxygen, and the number of people requiring ICU care does appear to be a little bit lower.
Yeah, we heard from vaccine companies this week saying that a third dose or a booster shot, this was commentary particularly coming from Pfizer and BioNTech, could neutralize the Omicron variant. So then should we be seeing governments really encouraging that third booster shot for those people that are eligible? And how quickly should people go about receiving that jab?
Well, we haven't seen the actual clinical data on this because what we've seen is laboratory data. And in the laboratory, individuals who've had a third booster shot, in the studies that Pfizer cites, seem to have some ability to neutralize the variant. Although the studies that have been done in other settings, including in South Africa, point out that 2 doses of the Pfizer vaccine actually are much less effective against the Omicron variant compared with Delta even.
What would the impact, because there's been a lot of conjecture about this, what would the impact be with respect to the pandemic overall of a variant coming out that is highly transmissible and highly contagious, but very mild when it comes to, of course, the symptoms and also the impact on one's health?
Well, I'm an optimist. And I think that we're finally, hopefully, getting close to what happens with every other pandemic virus. This dates way back to the Spanish flu in 1918. It killed 1 in 50 people all over the world. But over time, it mutated. It became more adapted to humans, became much more easily transmissible, but also much less fatal. The same thing happened in 2009 with influenza A, H1N1 2009. And that's kind of the way viruses behave. They come in, cause epidemics. Some of them cause pandemics, but eventually they become endemic. They spread all through the world. Because remember, they're parasites. They have no interest in killing their host. They just want to survive, spread, and just proliferate. So I'm hoping that maybe this is the sign that that's going to happen, but we need to see more data.
Right. And how long does it usually take from that period where a strain such as the one that you just described is detected, and then we get to that point where it becomes endemic and we don't have to necessarily worry too seriously about the impact of the virus?
Well, it varies. With the influenza viruses, which we know the most about because their pandemics have been the best characterized, it usually takes about 1.5 years to 2. So, in a way, if coronaviruses are going to behave like the influenza viruses in terms of their evolution, and that's a big if, because influenza viruses mutate at a much faster rate than coronaviruses, then it is possible that we're entering the time period at which the virus will slowly start to adapt to become more transmissible and less virulent. But there are a lot of unknowns in this.
Okay, we're almost out of time, but final question for you. So from what you were just saying, so from now it could be another year and a half before we get well and truly beyond this and we can look at the virus in the rear view mirror?
Well, actually, what I think is going to happen is in the next month or so, we're going to get really detailed clinical information from all over the world, and we'll know whether it's true, whether the initial data out of South Africa is going to turn out to be the case all over the world. And if this virus starts spreading like wildfire but not killing anyone, then I think it's going to be relatively easier for the WHO to declare the pandemic over. And of course, that's what I'm hoping will happen.
You're not the only one. I think everyone's hoping for that as well. Thank you very much, Dr. Paul Tambia there of the NUS Yong Lulin School of Medicine. Well, we are off for a short break right now. When we come back, updates from US President Biden's Summit for Democracy. But as we head into the break, here's a look at how the Middle East markets rounded out the trading week yesterday. We'll be back right after this. Welcome back to Capital Connection here on CNBC. These are some of the top stories we are watching for you this Friday. US President Joe Biden rallies world leaders in a first-of-a-kind summit for democracy, calling on countries to face down the rise of authoritarian forces. German Chancellor Olaf Scholz making his first official trip abroad today, calling on the French President Emmanuel Macron. In keeping with tradition, the bloc's two most powerful leaders will seek to find common ground on some of the most pressing issues. And Daimler Truck hits the Frankfurt Bourse today following its spin-off from the Daimler Group. Well, let's give you a look at how the oil price is faring right now this Friday. We did see some weakness coming through in the overnight trading session as we moved into the settlement period stateside. We did have Brent crude settling down by almost 2%, 74.42. WTI was off by 2%, 70.94. So we are seeing some ongoing weakness Asia side when it comes to these major contracts. In fact, we did see oil prices moving lower as the markets out there were rattled, at least in some part, due to, of course, the news that we got out of Fitch Ratings about the default status for the embattled Chinese property developers, those two, Evergrande and Kaiser. But moving on, in Israel and the US ramping up pressure on Iran as nuclear talks resumed on Thursday. The two countries threatening Tehran with possible economic or military consequences should talks fail. The West is accusing Iran of making sweeping new demands and going back on compromises. The US Defense Secretary Lloyd Austin, in meetings with his Israeli counterpart, says Iran's failed to bring constructive diplomatic engagement to the table. Meanwhile, over in Europe, tensions continue to run high over the Russia-Ukraine border. Ukraine saying Russia has rejected new ceasefire proposals. The Kremlin, meanwhile, comparing the crisis to the most dangerous point of the Cold War. Russia is awaiting an invitation from the US to join possible NATO talks on the issue. President Biden, in a call with Ukraine's president, pledging the US's unwavering commitment to Ukraine's sovereignty. Well, President Joe Biden hosting over 100 world leaders in a first-of-its-kind summit for democracy on Thursday, which Russia and China were not part of. Mr. Biden calling on countries to bolster democracy in the face of rising authoritarianism.
We stand at an inflection point in our history, in my view. The choices we make, in my view, in this moment, are going to fundamentally determine the direction our world is going to take in the coming decades. Will we allow the backward slide of rights and democracy to continue unchecked? Or will we, together, have a vision and the vision, not just a vision, and the vision and courage to once more lead the march of human progress and human freedom forward?
Well, let's bring in Stephen Feldstein now, Senior Fellow, Democracy, Conflict and Governance of the Carnegie Endowment for International Peace, joining us now from Washington, D.C. Thanks very much for joining us and staying up late to join us on the program today. What's the purpose of this summit?
Well, I think there are a few reasons why Biden organized the summit. But I think first and foremost, it's to symbolically show the importance of democracy at a moment when there's a lot of weakness and backsliding and concerns about whether the democratic enterprise is going to continue in a healthy direction. And so I think first and foremost, having together all these leaders and in the first year of Biden's term saying, look, democracy matters. Here's why. Let's stand together. Let's work on it. That's really been a primary objective, I think, for the president.
Will there be any tangible outcomes, do you think, as a result?
Well, earlier today, the Biden administration released a $400 million democracy package, and I think that's the start of a lot of commitments that countries are going to bring to defending democracy around the world. What we can expect actually is a year of action. So the democracy is a kickoff. The summit is a kickoff. And we'll have a year of action, and then there'll be a second summit next year in person where countries will say, here's what we did. So I think there is a lot on the agenda, and hopefully countries will deliver on the pledges that they are making today and tomorrow.
Right. When it comes to the main points of aggression, do you think that China will feature prominently, obviously not invited to these talks, along with Russia, especially in light of the build-up that we're seeing along the Ukraine-Russia border and the fears that are there for some kind of military incursion or conflict by Russia into Ukraine?
Well, certainly the backdrop and geopolitical challenge of China and Russia aren't far from the minds of world leaders. In fact, even in Biden's opening statement, he talked about this inflection point that democracy is facing. And part of the inflection point that he's referencing is the fact that especially when it comes to China, an emerging giant geopolitically, that there really is a threat and a challenge to democracy that he is hoping an alliance can help bolster and push back on. And so while China and Russia aren't directly referenced, in terms of the summit itself, the fact that they're not invited and the fact that they have very strongly and publicly pushed back and said, we should be part of this, we should be considered democracies as well, I think is an incredibly critical subtext for what's happening on the world stage.
Okay, we know that Taiwan was invited. That's clearly going to ruffle some feathers in Beijing.
Yeah, and they've been, very public in terms of their concern about Taiwan being invited and participating. And I think tomorrow, a senior official from Taiwan, Audrey Tang, will actually participate in a high-profile panel talking about digital democracy and the use of technology to advance democratic progress. So this is something to watch.
Okay, there are a wide number of nations that attended, some that have a good track record on democracy, some that don't. How do we make this a collaborative approach rather than the process of more than 100 countries coming together, resulting in just finger pointing and lecturing?
Right. Well, you're really touching upon a big criticism coming in. There's 110 countries that are invited, a Big Ten approach, and there are a number of countries, Pakistan, Iraq, the Philippines, Serbia, the Congo, that many people would claim are either not democratic or have serious backsliding problems. And so one of the issues is, can we get past that? Is that going to be something that divides the countries? Or will they say, look, let's work together and find progress when we can, recognizing that there are serious concerns that we have in certain countries, but let's have that not be the end result of a coming together to push forward progress and democracy. And I think that's what countries are aiming for. It's not to be divisive. It's to sort of say, what can we do together and to push forward.
Right. I guess there's also a fear on that front as well, that promises might be made by countries that have to do more, pledges might be made, but if there's no enforcement, the pledges that have been made will probably just move on without any kind of resolution, right?
Well, I hope not. And I think one of the real goals in this coming year of action will be to involve civil society at all different levels, to put pressure on these public commitments, to say, you said you would pass an anti-corruption law, or you would ensure media freedom, and you haven't followed through on that. So X or Y leader, that's not good enough. And that's the essence and the strength of a democracy, that the public does matter, that they vote, that they can protest. And so therefore, I think the hope is that these pledges will get some pressure from the outside.
Stephen, we have to leave it there. Thank you very much for joining us with your insights. It'll be interesting to see how this one plays out. Stephen Feldstein there of Carnegie Endowment for International Peace. Thank you very much for joining us. Well, coming up next on Capital Connection, the French President Emmanuel Macron outlines his plans for the EU presidency, calling for a more powerful and sovereign Europe. Those details next.
Why are so many
Welcome back. Time for your European opening calls this Friday. It looks as though we will see some moderation coming through for the European trading session when trade kicks off in just a few hours' time from now. We do have the London market called down by about 21 points, about 40 points coming off the German market, and 14 when it comes to the French market. Well, the French President Emmanuel Macron outlining his priorities for the EU as France gets ready to assume the upcoming EU presidency next year. Mr. Macron outlining his aim of a more powerful and fully sovereign Europe, prioritising innovation, job creation and sustainability. He's called on the EU to rethink its budget framework and deficit rules to help the bloc move out of the COVID crisis.
This model of growth and investment assumes suitable budget and financing rules, allowing to give priority to investments necessary to accompany the energy and digital transitions. For this, we will need to build a credible, simplified and transparent budget and financing framework, capable of contributing to this ambition of a stronger, fairer and more sustainable Europe.
He's also calling on an EU emergency response to control the bloc's external borders. The 6-month tenure overlaps the French presidential election. Mr. Macron facing criticism for not postponing the vote, but reassured the EU that he will lead the bloc until the very end. Well, the French leader also calling out the UK government when it comes to failing to honour its word on Brexit and fishing licences. Mr. Macron accusing Britain for being the cause of the strained relationship, which came under more pressure following the AUKUS deal that left France out in the cold. France says it's still waiting for the UK to approve licences for fishermen to fish in British waters. Macron will be welcoming the new German Chancellor Olaf Scholz to Paris for a meeting today. France is traditionally the first port of call for new German leaders. They'll have a lot to discuss, including the Russia-Ukraine crisis and the EU's response to COVID. Ahead of the meeting, Mr. Scholz said Germany must build fiscal reserves to prepare for the next crisis. Under Angela Merkel, Germany broke with tradition to back unprecedented joint debt raising with the bloc to fight the pandemic. The new Chancellor saying he wants a good relationship with France despite their opposing views on nuclear energy.
The positions which were developed to fight climate change in different countries differ across the world, and it's about creating a power which makes it possible to achieve the same goal with different approaches while creating something everyone can agree on. I believe that's possible, even if it's not easy. But after all, we want good cooperation.
In corporate news today, Volkswagen CEO Herbert Diess gets to keep his job, ending weeks of uncertainty about his future at the German automaker. There'll be some changes to his responsibilities, ceding the China business to incoming board member Ralph Brandstatter. He will also be leading a new division, Volkswagen passenger cars, starting from January 1st. Mr. Diess, though, will oversee the automaker's new software division that will be key in its electrification strategy. And we're also watching out for a market debut over in Germany today. Daimler Truck starts trade in Frankfurt today as an independent entity following its spin-off from the Daimler Group. The spin-off breaks up Daimler's passenger cars and commercial vehicle structures, which were under the same roof for over a century. The world's largest commercial vehicle maker has big plans for the near future, looking to sell 60% electric vehicles by the end of the decade. And our colleagues over in Europe will be speaking to the chiefs of Daimler Truck and Daimler Mercedes-Benz later on today. Well, elsewhere, Airbus is upping the ante in its row with Qatar Airways, seeking independent legal advice over skin flaws on its A350 planes. It's accusing the Gulf carrier of misrepresenting the issue as a safety problem, highlighting that European regulators have declared the plane safe to fly, despite some surface degradation, and that it's offered solutions to the carrier, but that it has declined the offer. Airbus saying Qatar's move is a threat to international safety protocols, while Qatar Airways says its brand is at stake, especially after it had to ground 20 of the jets with the FIFA World Cup less than a year away. Time for your CNBC Sports Update now with a preview of this weekend's Abu Dhabi Formula One Grand Prix. Champion leaders Lewis Hamilton and Max Verstappen going into the final race of the season tied on points for the first time since 1974. Our very own Dan Murphy sat down with Zach Brown, the CEO of McLaren Racing, to get his take on the season as well as the future of F1.
So if I start on the track, we've had our first win, which was a 1-2 in Italy. First win in 10 years, followed up shortly thereafter with a pole. We've had more podiums this year, more points per race. The only disappointment being, looks like we're going to slip to fourth in the championship. But, I think that's the nature of how competitive the sport is. Every other KPI that we set out for ourselves, we've hit or exceeded. And then off the track, we've brought on a lot of new corporate partners. And most recently with the Formula One fan survey, and voted the most popular team in Formula One with the most popular driver lineup. So we're quite pleased.
And I wanted to get your take on this race overall, because there is a little bit of history happening right now. Verstappen and Hamilton going to Abu Dhabi level on points for the first time since 1974. So if you were to flip a coin, which way do you think it goes?
I think you could flip a coin. Lewis certainly has the momentum right now, the last few races, and he has the experience. Red Bull was dominant here last year. So I think it's been a wonderful Formula One season, and I think you can literally flip a coin, and regardless of who ends up winning, what an unbelievable season Formula One has had.
Are you encouraged to see Formula One as a sport making more headway in the Middle East with this race in Saudi Arabia now?
Yeah, the Middle East is a big investor in motorsports. They've built some unbelievable facilities. It also has brought a lot of new corporate partners into the sport. So, when the region gets behind it, so do the companies. And we're seeing the same thing now in America. Austin's been very successful. Now we have Miami coming. A lot of our corporate partners that we've brought on recently are from North America. So anytime you see regions, whether it's the Middle East or America, I'd like to see us make a bigger impact in Asia next. If I look at the geography of the sport, we're in a great place in the Middle East. Europe's our home. America's growing rapidly, and I think we need to tackle Asia next.
Well, coming up next on the show, when the going gets tough, this tough Singapore entrepreneur got going, mixing technology with a morning cup of coffee. We'll tell you about the city-state's first robo-coffee barista. Sometimes like a robot when I have my first coffee, but we'll discuss this more coming up next.
There's never been a
Welcome back. Well, Singapore startup Crown Digital recently launching a robot barista as it deals with a labour crunch. Let's get out to our Make It reporter Karen Gilchrist joining us. With more now on how the company's founder traded in his suits for, wait for it, a different kind of grind. Karen.
Absolutely. Good afternoon, Matt. Now, perhaps you're feeling ready for an afternoon pickup. How about having it served by a robot? That is the new reality as of this week for commuters in Japan. After one of the country's leading rail operators, JR East, has signed a deal to roll out Ella in the capital at two of the main stations. This is Tokyo Station and Yokohama. Now, Ella is a fully automated coffee barista robot who is able to serve up your regular coffee at 4 times the rate of her human counterpart. This is the first product from, as you say, Crown Digital, a Singaporean Internet of Things startup aiming to change the food and beverage industry by providing technology-backed solutions. Now, this company was founded back in 2015 by Keith Tan, a former wealth manager who was initially trying to open up a chain of regular human-powered coffee shops, but soon found that he had lots of labor shortages and rising rents. So he set about finding a technologically backed solution. Let's take a look.
Meet Ella, Singapore's first fully autonomous robot barista. Ella can whip up a fresh cup of joe at 4 times the rate of her human counterparts and will soon be available to subway passengers across the city-state.
And her creator, well, he spent years in the finance industry before deciding to take a coffee break.
I was 35 years old in finance, and I thought, it's my chance. I have got to do something, build something for myself.
But it wasn't long after he got his joint off the ground that he began to discover the challenges of the food and beverage industry.
It's really hard to hire and retain staff for the F&B industry, especially in Singapore. And I thought, I've just invested in this company. It's going to grow more than that. So then I decided it's time to really look into technology.
With that, the idea for what is today Crown Digital was born. An Internet of Things startup aiming to address the difficulties within food and beverage.
Ella is the company's debut product. It came to life in 2018 after years of experimentation.
Encased in a transparent kiosk measuring 5 square meters, Ella's autonomous arm, which is produced by robotics company Techman Robot, operates around the clock and can serve up to 200 cups of coffee per hour. The ingredients, fresh milk and beans, only need to be topped up every 360 servings. This is monitored through an app, which alerts delivery drivers.
Our delivery drivers are following the apps, so the job scope will be sent to them through the mobile app. They know exactly when to top up, and when they do, our command center will be updated.
The command center can also detect and resolve spillages or machine faults remotely through inbuilt systems.
We are running multiple AI workloads that's monitoring different aspects of the production.
Ella is designed for high-density grab-and-go environments like airports, transport hubs, and offices, where speed is paramount.
There's opportunities where you just want speed, consistency, and ease of ordering, and that's where robotics can really come in.
That's really the aim here with this partnership with JR East, which will be being piloted until late February 2022, at which point it may be expanded further across Japan. But you won't have to go that far to get your afternoon pick-me-up. The company will be rolling out Ella across Singapore's subway network over the course of next year. Or perhaps if a cocktail is more your thing, Keith tells me that's what they're looking into next too.
Okay, how fast until those plans are up and running? And more broadly, what did he have to say about the company's growth plans in general?
Yeah, so he will be looking into different avenues, he told me. No specific timeline yet, but certainly there's scope for cocktails, for food, for ramen even if the Japan pilot is a success. So he's certainly going to be looking into different avenues. But I think one of the main focuses for next year, now that we've got a little bit more attention around the business, is Series A fundraising, which he's hoping to sort of set out to raise over the course of next year, with potential for an IPO in as soon as 2024. So let's see how that goes for this young founder and the company over the next couple of years.
Karen, thank you very much. I think it's been a busy week. There might be a lot of people that hoping there's a robot waiting with a nice drink rather than a coffee. Thank you very much for joining us on the show today. Karen Gilchrist there. And that does wrap up this edition of Capital Connection. I'm Matthew Taylor in Singapore. Squawk Box Europe is coming up for you right after the break. Stick with CNBC. Have a good weekend. We'll see you on Monday.
We're committed to
And welcome to Squawk Box. Here are your headlines today. US inflation is forecast to hit its highest level since the early 80s, and an expected 6.87% expected across, raising fears the Fed will be pushed to act faster. Asian equities take a leg down after US markets snap a three-day winning streak, with tech stocks leading the losses.
Very good morning, everybody. The US is expected to put Chinese AI firm SenseTime on its blacklist, forcing bankers to reassess what it means for the company's Hong Kong IPO, which is due to price today. And Daimler Truck sits on the starting blocks as it prepares to hit the open road and list in Frankfurt today. We have Daimler Truck executives Martin Dom and Ola Kalanas joining us later on in the morning. unless you've been living under a rock for most of this week around the financial markets, you will of course know that we have a big a big inflation number due out today in the United States. And of course, we've had several pieces of job-related information that, again, the markets are looking at for confirmation bias as far as this inflation print is concerned. So the anticipated number for US November CPI is 6.7%. The latest print will be due out at 14:30 Central European time. Now, if those forecasts are correct, it would mark a near 40-year inflation high, which would take us back all the way to 1982. Only a couple of years before that, of course, Fed Governor Paul Volcker raised prime interest rates to historic highs of over 20%. And as we know, that exacerbated the already ongoing recession in the United States and had implications globally. We did get a jobless number yesterday that also looked historic. US jobless claims hit a 52-year low in the week ending December the 4th, coming in at 184,000, which was below most expectations. However, continuing claims were surprisingly high at 1.99 million. That's nearly 90,000 above the Reuters forecast. But of course, those data points do nothing to disabuse the idea that the labor market is still recovering strongly in the United States, Karen.
And Jeff, it might be a quite odd morning here in Europe today as we waited out for those inflation numbers. I think a lot of participants in the market are very keen to see what that data point looks like. So early on, as we pick up from the Wall Street trade, this is how it looks red across the board for the Dow, the S&P and the NASDAQ. So we did break a three-day winning streak. There's been a lot of green on these markets in recent trades. Very strong intraday sessions have played out. We started to fade a day early and then we've actually snapped it now, as you can see, particularly on the tech sector. The NASDAQ down 1.7%, but it's been such a strong run for this component of the market and a big catch-up trade that's played out. But as we start to talk about the potential for much firmer inflation numbers, close almost to a 7% handle. I mean, 6.7 according to Dow, 6.8 according to Reuters, and there's a string of various different forecasts out there in the market. So it is a likely a red-hot number, and that will trigger potentially some concerns around interest rates, which is a negative story for the NASDAQ and the big tech components. Let's take you to the performance over the week, and you can see the contrast to the session yesterday. 3.4% high now for the Dow. So that pullback we saw on the NASDAQ was instrumental in stripping away some of those very strong gains on the NASDAQ. It had been the best performer of the US markets before that session yesterday. So you can see now trailing behind the Dow in terms of the percentage gains, but still incredibly solid right across the board. A big moving stocks to the downside. For the Dow, it was Boeing. For the others, it was Tesla. And as we know, there's been a bit of speed around Tesla in recent trades around the momentum. Let's get to the Asian markets. We are hearing a lot across these global markets that there might be a bit of risk aversion ahead of the data point today. And don't forget, a lot of Asian markets are going to be shut as the key point crosses. So 0.4 down for Australia, modestly south for the Chinese market. Hong Kong reversing 0.8, and we've got 1% down for Japanese stocks. US futures early on. Now, this is how we are perched. You can see it is also a slightly tricky equation for many traders and investors stateside, trying to guess what the data will look like. So it is cautiously weaker at this early hour. Jeff.
Yeah, Karen, thank you very much indeed for that. Let's get straight into some analysis and some calls with David Newhouser. He joins us from Livermore Partners, where he's the CIO. David, very good morning to you. How are you anticipating the inflation number in terms of portfolio construction? Have you taken any steps here to adjust positioning as we run into this hot number?
Yeah. Hi, Jeff. Hey, we're not changing our dynamics today in terms of portfolio construction. I think all along, our view has been that, inflation is going to run hot. It's going to get hotter. And, we've seen that throughout the year. I think that trend is now even continuing more as we're seeing more different variants of COVID, as we're seeing continued supply bottlenecks throughout. It's just going to lead to higher sustained inflation, which, as we know, the Fed has been honing in on lately. So it's tomorrow's number is going to be interesting. I think it's going to still run above trend. And our view still point is that, you want to own hard assets and shift away from sort of the growthier areas of the market like technology.
Notwithstanding the Nasdaq's decline yesterday, it's actually had a winning week here. So how robust is your call on moving away from the tech sector at the moment? Because every time we get a bit of a sell-off or some volatility, it does feel as though, like Pavlov's dog, the retail investor and maybe the institutional investor as well goes back to those technology stocks that have done them so well over recent years.
Yeah, well, look, I think it's hard to stay away from things that you have this low growth environment in terms of economies, given, we've had massive stimulus, which has helped reflect higher growth. But reality below trend, if you look at growth continually, it looks a lot lower without stimulus. So you look at it where we see rates in the one handle for the 10-year, we're seeing the 2 years starting to move up. So you're seeing a flattening of the yield curve. And I think that tends to see more investors dive into sort of the growthier aspects because they believe that in a lower growth world, you want to own high growth assets that keep up with inflation or obviously outperform inflation. I think this time, though, it is going to be a bit different. In the past, of course, we've had a Fed that's always sort of had the markets back. We've had this sort of Fed put or Powell put, as they say. That dynamic is definitely on the change today. We've noticed that sentiment shift from the Fed here in the past several weeks, and that looks like it's continuing. So every time, like you mentioned, that you've seen stocks start to come in a pretty good way, they've always rebounded. You always buy the dip. This time, I think it's going to be the potential for an error in terms of judgment on investing in sort of those growthy areas is going to be prevalent today. And you're starting to notice that. I mean, if you look at some of the things that, you and I have talked about in the past few months, some of the things even our hedge fund, Livermore, has been short in the past, things like ARK Investments or Tesla, of course, or even Meta, Facebook. I mean, those stocks have lately been underperforming. And I think that could be a telltale sign of things to come.
Like to hear it this time is different story. I want to get to the positioning around new economy stocks, and Tesla does fit into that. Maybe the others are less so when we talk about Facebook, Meta, big question marks around its future, in some ways around the younger audience. But Tesla in the new economy, you've seen other rivals as well in the space, others in renewable, very big multiples that have been encouraged by low interest rates for many, many months now, as we've seen through this pandemic stimulus phase. What happens next, though? Because if you're also cautious around the interest rate story, taking the shine off the valuations, you potentially still want to be positioned in some of these areas for the longer term. So how do you think about that?
Yeah, I think, look, the market tends to trend in cycles. So I think we've had, enormous period of stock outperformance, right? And a lot of that's been predicated with monetary policy, as we know. And then, of course, with COVID, we've seen a double dose, right? Where we've had monetary policy explode, and then we've also had fiscal policy, right? Where we've had $4 trillion of stimulus happen. The one thing that you look at, though, is we've seen this pullback, of course, in productivity, and that's where we've seen labor shortages, a tightness of supply, and higher inflation, like we're going to see in the morning. And as that's happened, again, initially, some of those sectors, like you said, technology, which has always prospered because of sort of the monetary policy effect. If we're starting to see a more hawkish central bank, because we know that lower rates aren't going to help bring jobs, people back from the jobs market to get into the employed, then ultimately, their job is their mandate, right? Which is inflation and employment. And, inflation is running extremely hot today. You're seeing yields obviously still trend negative. And I think the only tool they have in their toolbox right now would be to raise rates. That would be bad for obviously any high growth names, technology especially. So my viewpoint is, I think over the next several years, as you've seen more tightening in terms of monetary policy, it could definitely have an effect in terms of reining in tech valuation. And if you look at, Karen, underneath the current of the technology sector, the NASDAQ, which is having an explosive year, there's a number of companies that are trading below their 200-day moving averages that are actually in a bear market. So it's a bit troubling and also fooling people a bit as well.
David, while we're talking about red flags, then, can I ask you about the stock sales that we've seen stateside? When 48 top executives have effectively collected more than $200 million each from stock sales. This is 4 times the average, what we've seen from 2016 through to 2020, according to research. What do you make of that signaling function? Is it just timing? Is it just coincidence? Or is it insiders calling the top of the market?
I think it's actually a combination. So look, on one hand, some of these stocks have done, just so well, right, over the last several years. You'd be a bit foolish if you were an investor and an executive in some of these companies, and you're not looking to take profits and get some liquidity, right? You're seeing that from everywhere from Elon Musk at Tesla to Jeff Bezos to so many other executives. At the same time, I would also argue that there are a number of companies out there that are trading at what I would call fluff valuations, right? Which what Livermore would call. And those companies are really just a shell. And as those valuations have exploded due to all the fiscal stimulus and retail investor momentum, I'll just say, those executives are using that as a lever to take advantage of it.
David, big picture. You're in reflective mood this morning, I know, but we've got the highest print likely on inflation for 40 years. We've got the best jobs number here, I think, for 50 years. You're actually having a look back at what happened in the 20s and some of those other difficult market periods. To what extent do you think we are repeating history then when it comes to letting inflation run too hot and demanding a harsh policy response from central banks? Are we realistically going to see a 30s style recession or a 70s style recession?
Yeah, that's an interesting
Are you okay? Can you hear me okay? David, I think we've got some problems with your audio, so we're going to wrap it up here. But thank you so much for joining us once again. David Newhouser, the CIO of Livermore Partners. Maybe we'll come back to that at some point later on in the program. I don't know, with another guest, but because I think it's fascinating to what extent we may be rerunning the tape on some of these broader themes. I want to talk about the China new vehicle sales. We've just had some numbers through from the industry association here. New vehicle sales negative 9.3%. for October year on year. That's against the negative 9.4% expected. January, November vehicle sales coming in at 4.5%. The year ago figure was negative 2.9%. So that's at least a positive number. New energy vehicle sales coming in up 121% year on year. The January to November new energy vehicle sales coming in then at 166.8% year on year, according to the industry association. There was one other piece of news as well that I just wanted to put across your desk, because it fits in with this broader theme, I think, that we're seeing in the auto sales number here of some slowing in consumer demand and consumption patterns. And that's China's stock of unsold new homes hit a 5-year high amid weak demand. Reuters also putting out that snap this morning, but it's seemingly getting a little less attention than these headline auto sales numbers. Moving on, Japan's wholesale inflation rate hitting a record high in November, rising 9% year over year, and topping expectations for a rise of 8.5%. The Japanese Prime Minister Fumio Kishida said today that the government must be mindful of downside risks to the economy from chip shortages and supply constraints. He also says the government has no intention of tweaking Japan's sales tax from the current 10%. Still to come on the program then, we're on the starting blocks for Daimler Trucks, one of Germany's biggest auto groups, preparing to spin off a key unit in a big test for investor demand in the sector. We'll tell you more about that when we come back.
And we'll be continuing our inflation watch here on Squawk. And for more on that topic from both sides of the Atlantic, you can check out our podcast.
Tune in for Tech Chat. Welcome back, everybody. Ratings agency Fitch has downgraded property developers Evergrande and Kaiser Group to restricted default. That decision comes as both companies face mounting pressure to meet bond repayment deadlines, although neither of them has so far announced an official default. Kaiser Group has reportedly started work on restructuring its $12 billion offshore debt, while Evergrande faces over $300 billion in liabilities. The Chinese startup SenseTime is reportedly reevaluating its planned IPO after reports that the United States will now put the company on an investment blacklist. The artificial intelligence group had planned to set the final price for its much anticipated Hong Kong IPO debut due today. The action of the US government related to what it perceives as SenseTime's activities in the Xinjiang region. So this is human rights related. But Sam, as we bring you into the conversation, this is a headache for the bankers who seem to find out very late that this was going to happen.
Yeah, absolutely. Good morning to you, Jeff. I mean, you've got to love the timing here. And as you say, the bankers will be sort of scrambling to plan what to do next. And it does make you sort of wonder whether this whole situation will become a bit of a test case now for companies looking to IPO in the face of some of this pressure, because we first learned about this from the Financial Times, saying that the US would be putting SenseTime on this investment blacklist over its alleged ties to the what's going on with the human rights abuses over in Xinjiang. There's also some suggestion that this is perhaps to mark a Human Rights Day. Of course, Biden is hosting this summit at the moment on democracy, which, of course, China wasn't invited to, but it did come as SenseTime was, of course, really tying loose ends when it came to its Hong Kong IPO. It was set to price that today. Those shares are expected to start trading on December the 17th. We haven't yet heard anything from SenseTime, but what we have now seen is Reuters reporting that the company is certainly in talks to discuss the fate of this IPO with the Hong Kong Stock Exchange now. Now, the company had reportedly not been made aware that it could be put on this blacklist, and that really caught a lot of people that were working on this IPO by surprise. The US Treasury will reportedly be putting SenseTime on this blacklist. It's called the Chinese Military Industrial Complex Companies, which means that Americans won't be able to actually buy into the IPO, and that came after President Biden earlier this year actually signed an executive order banning Americans from being able to invest in these companies that have found themselves on this list over their alleged ties to the Chinese military on these national security grounds. Now, SenseTime is a leader in this facial recognition technology, which, of course, we know is widely used in China, but there has been some suggestion that the US is pretty concerned about just how this technology is being used, and particularly in the western region of Xinjiang with these Uyghur Muslims, Karen.
Thank you very much for bringing us that story, Sam. Much appreciated. Elsewhere on the IPO front, Nubank shares surged on the first day of trading, giving the Brazilian digital lender a valuation of nearly $52 billion. The company, which is backed by billionaire investor Warren Buffett, priced shares at $9 apiece and quickly became the country's third most valuable public firm. HashiCorp shares also moved higher in their NASDAQ debut, valuing the cloud software provider at nearly $16 billion. The company, which provides open source cloud software to brands such as Starbucks and Mercedes-Benz, priced shares at $80 each, raising $1.2 billion. I'm going to go digging into the origins of that name, Jeff.
Yeah, good luck with that. Daimler Truck will today make its debut in Frankfurt as the commercial truck unit is spun off from its parent company. The truck maker is investing heavily in electric vehicles with the aim of having 60% of its sales made up of electric vehicles by 2030. Annetta, good morning to you. We've obviously seen a lot of excitement in the United States around electric vehicles companies. As Daimler Trucks comes to the market here, do you think they can create the same kind of excitement around the idea of electric trucks?
Well, actually, it's not only electric trucks. We have a differentiation here. The short-haul trucks, which you can plug in overnight, they will be powered on electric basis, but the longer-haul trucks will be powered by hydrogen or some hydrogen technology, which makes more sense because an electric battery for like a long-haul vehicle would just be far too big and also too heavy to make sense commercially. So what we're seeing today is a Daimler Truck listing. It's not essentially technically an IPO, it's a listing of the shares, and the volume could be between 25 and 45 billion euro. So it's a big company. And for one day, they're also listed in the DAX, but then they have to go again. But they have, most likely they will enter it again just because of the sheer volume. So technically, 35% of the whole listing will stay with Daimler, and 65% will go to the existing Daimler shareholders. For 2 shares of Daimler, you get 1 share of Daimler Truck. So the rationale of the deal is quite clear because Daimler is concentrating on luxury cars, and the truck the truck business is catering to a completely different market. We have seen listings of truck business also from Volkswagen with Traton, for example, and they're targeting completely a different market, as I was saying. What is needed with Daimler Truck, if you compare them to the competitors, they need to boost profitability, and that's what their CEO, Martin Daum, is also promising for 2021. The order book is quite full. It was a bad year, obviously, with Corona, but 2022 looks set to be actually quite a successful one, depending, of course, on what's going to happen, and also how the supply chain bottlenecks will affect the company. But this is probably one of the topics I will be tackling with the CEO a little bit later here on the ground. So 2022 looks set to be a good year, at least what we're hearing from the company. They want to boost profitability because that's one area they're really lacking behind competitors. And they're also lacking a little bit when it comes to their electrification or hydrogen strategy. So a key question is whether they can close the gap to the competitors or whether they can't close the gap. And of course, the US market will be key here as well, a huge market for trucks. And also Asia is most likely a very interesting topic for them as well. So an exciting day for Daimler. I'll bring you both CEOs, the CEO of Daimler Trucks at roughly 9 o'clock, and then a little later at 10 o'clock. I'm going to also speak to Ola Kalenius, the CEO of Daimler. With that, over to you.
Thank you very much, Aneta. And speaking of rivals, Elon Musk has sold even more Tesla stock, netting almost $1 billion from the sale of 934,000 shares. But he also exercised stock options to buy over 2 million shares, meaning he's now exercised options to buy more than 12 million shares since the 8th of November. Volkswagen has confirmed Herbert Diess will stay on as CEO. Diess had come under fire following clashes with VW's labour unions after he warned tens of thousands of people could lose their jobs amid the company's transition to electric. VW's brand chief, Ralph Brandstetter, will take over responsibility for the Chinese business, while Diess will head up the company's software unit. Coming up on the show, ho, 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 just 15 days until the big man delivers you another pair of socks. Ahead, what to expect in this retail festive season and the year ahead.
Right now on CNN.
Here are your headlines. US inflation is forecast to hit its highest level since the early 80s, with an expected 6.7% jump, raising fears the Fed will be pushed to act faster. Asian equities take a leg down after US markets snap a three-day winning streak, with tech stocks leading the losses. And Daimler Truck sits on the starting blocks as it prepares to hit the open road and list in Frankfurt today. Daimler Truck executives Martin Daum and Ole Schelenius will join us later on this morning. And China's auto sales continue their recent slump, down over 9% in November. But new energy vehicles are still surging, up 120% on the month. The market has pressed paused, waiting it out for some big inflation numbers today. And Reuters is suggesting a 6.8% handle, Dow at 6.7. The market is primed for a red-hot figure to cross. And you could see some of the momentum coming out of markets yesterday. It's been an incredibly strong trading week. And the ranges we've seen are quite instrumental in just compensating for that wobble we had in the month of November. It's taken us up back towards some of those record levels, so just a couple of percent off the highs. But you could see it was a fairly sharp pullback for the tech sector, which has been leading the recovery this week, but a fall of 1.7% in session. Tesla, one of the weak names there in the S&P and on the NASDAQ. Take a quick look at treasury markets that are also primed for what we're seeing out of the inflation side. The yield on the short end has been marching high. We're at 0.71% there. At the US 10-year, we're at 1.50. So we're closely watching where we are today and what the data is going to do to some of the expectations out there, because a red-hot number is expected to quicken the pace of the taper and potentially bring forward a rate hike scenario. A weaker one, well, let's just see what happens to those expectations, or whether investors still think the setting is primed for some tweaking of monetary policy. I want to take you to Asia. A cautious all day, and typically when we have these big risk-on events on the data front stateside, these markets can cool off a little bit. You were seeing that across on Japanese stocks, trading down 1%. No doubt a lot of traders will try and hit the bars and then be keeping a close eye on the screens later on for the information. And you can see 0.75%, 1% down on the Hang Seng. Shanghai's off 0.4, and Australia down cautiously as well. The opening calls here in Europe, we have had a fascinating trading pattern. We've tried to keep pace with our American counterparts. It's been a very strong trade for, say, the French market, up 3.5% on the week. It's had 9 positive sessions out of 10. The DAX in Germany also up a solid 3% plus. And this is despite the fact these markets sold off a little bit yesterday. So we're looking at a little bit more reading today, a slight give back from what has been an incredibly strong trade. And one of the big themes was the Omicron variant. A lot of investors judging some of the lockdown restrictions as being potentially lighter than what they had feared. But still, we're waiting for more information on that front. And you can see it's just a slight cautious approach this morning, which is warranted given the significance of this inflation number later. Jeff.
Yeah, absolutely, Karen. Thank you. Let's talk about some of the corporate stories this morning. Bayer has won a second consecutive verdict over its top-selling Roundup weed killer. A jury in California rejected a mother's claim that the chemical giant's product had caused her cancer. Roundup-related lawsuits have dogged the company for years, costing it billions of dollars in settlements. We talked yesterday about the UniCredit Investor Day. Well, shares hit a new 22-month high after the Italian lender's chief executive, Andrea Orcel, unveiled a new 3-year strategy, which is aimed at expanding share buybacks and dividends. He also said the company is in a position to evaluate new potential mergers and acquisitions. 2 months ago, UniCredit pulled out of a deal with the government to privatize rival Monte dei Paschi di Siena. Shell, this is a fascinating story. Royal Dutch Shell is meeting with shareholders today to vote on a string of new, quote, simplified corporate proposals. Shell is vying to ditch its dual-class share structure and move its headquarters and tax residency to the UK. The company says the move to scrap its dual-class share structure would allow it to return more cash to shareholders, including through buybacks. Shell will still continue to trade in Amsterdam, London, and New York. And Karen, I was just having a look at the share price here. The performance of the integrated oil majors has been strong this year, we know, and on a year-to-date basis, Shell is up a little over 16%. One of the interesting aspects to the trade, though, is if you look at the announcement that was made mid-November about this simplification process, Shell is actually flat from that point on. It may have absolutely nothing to do, of course, with the announcement, but it does seem that even as a lot of investors were getting excited about the idea of increased share buybacks and what's perceived to be less burdensome taxation in the Netherlands if they focus their tax domicile in the UK, it doesn't feel as though, in any sense, the management is enjoying a premium on the announcement.
You've got to wonder what the motivations are here, whether it is about the tax situation, whether it is about some of those standards set in the Dutch courts about hitting this carbon target, and whether that was just too onerous for the company. Another big thought process here is what about the ability for this company to embark upon more twists and turns, which we know is incredibly necessary for the energy transition, the sale of certain assets. I mean, it's a very difficult regime in the Netherlands to navigate some of those headwinds. So potentially this unshackles Shell a little bit, Jeff.
Yeah, no, what'll be interesting, I think, is just whether the authorities in the Netherlands are able to do anything at this stage to catch a little bit of tax back from Shell before it departs here. I mean, the threat from some of the lawmakers was very clear that we will do whatever we can to disabuse you, firstly, of the idea that this is a good idea, and secondly, to try and claw back some taxes from Shell should it leave. The legislative process perhaps is going to be too slow in the Netherlands for parliamentarians there to do that, but we wait and watch to see what remedies, if any, are taken at this stage, because I think the Dutch government described this as an unpleasant surprise when the announcement was first heard. So yes, Karen, I think you're right. There are a few other reasons why the Shell management team may want to simplify the structure at this stage outside of this single issue of taxation. What further remedies the Dutch parliamentarians can bring to bear at this point will be of interest, and it's a story beyond today for us that we need to keep an eye on.
A lot of companies, you typically of this size, try to avoid sort of political stories or stories that blow up of a political nature. And I've got to say, this is almost like a landmine for Shell. And some of the tabloids on the newspapers describe the company as doing its own form of a Brexit here. So it's interesting to see how shareholders feel about how explosive the move has been politically, A, but also B, whether they think it's a good idea at this stage. Let's park that conversation there. We will continue it a little bit later on with a guest who's joining us. But in the meantime, when we talk about retailers globally, 72% of consumers will spend the same or more on holiday shopping this year, according to EY. In the latest of its research series into pandemic-induced spending patterns, it found consumers are becoming more climate-focused and demanding more money, more value for money. Let's get to Thomas Harms, global retail leader at EY. Thomas, there's been so many big themes here: disruption of normal consumption patterns, some pent-up savings, but also some concerns around inflation, supply chain bottlenecks. Just set the scene for this type of Christmas that we're expecting to unfold.
Yeah, good morning. So I'm coming with a good headline. So we are shopping for Christmas. And one of the reasons you mentioned already, 72% of the consumers want to spend more or the same for Christmas, according to our Future Consumer Index. But they also have money. They have saved money over the pandemic because they had no opportunity to spend. And I also see some excitement to go back into the stores. You see this in the cities, that the people that are there, that they are actually going into the store. So a huge opportunity for traditional retailer. But if they want to capture it, they really need to be engaged with the consumer, create an experience in store. And what I've also observed in many cities is that there is a need for safety. So if the retailer can build a kind of cocoon of safety in the store environment, that will benefit the experience.
Thomas, the holy grail for a lot of retailers has always been supply chain logistics. Just getting right, having the right product at the right time, not having too much of it, having it enough. And at this point, we've seen a huge disruption to supply chains. It does feel as though some retailers just had too much stock going into the pandemic. They tried to warehouse it. They're bringing some of it back out. Others simply just don't have the product. They haven't planned ahead for this demand story. What do you make of the challenge here to ensure that the products are at the adequate levels for some of these big retailers?
In the long term, definitely yes. For the Christmas season, I'm not worried about this because you want to give a gift to the ones you love, and that needs to be under the Christmas tree anyhow. So that will run for substitution. So you will buy something else if you don't find exactly what you need. For the midterm, the supply chain is really an issue. They need to become more agile and more responsive. And also the system that you source everything on scale from far away may be challenged so that you come to a more closer sourcing.
Thomas, you make an interesting claim in here about consumer awareness of the environmental impact of their purchasing decisions. But at 56%, which is the number that you've put in here, according to the Future Consumer Index, 56% then suggests 44% of people don't pay any interest at all.
Yeah, so if you can read it like this, but actually the question was, do you pay more attention to it than before? And 56% said they will pay more attention. That does not mean that the rest doesn't care. They only don't care more. I think here we also need to look at a telling-doing gap. But in principle, I think it becomes far more important. And you can see that also in the growth rate for brands and store formats that concentrate on sustainability, that this becomes really more important every day.
But this was the COP26 year. This was the year when we were all supposed to get behind a push towards net zero. If we can only manage 56% in COP26 year, what does that tell us actually about consumers' willingness to back up the messages we hear from governments and some corporates?
Well, I think that we need to do still some education around this. And the retail sector is a little bit on the hook here because they are clearly the ones that are closest to the consumer. On the other hand, even if the people don't say they pay more attention for 40% of the people that we asked, it will become a license to operate. They will take it for granted. So you better be prepared for this. And my advice is that you need to take sustainability very seriously if you are in retail.
Thomas, can I ask you about Omicron? At this stage, we've got more restrictions and mask wearing is back in the UK. I mean, other countries are still wearing masks. But what do you make of the impact on retail from here, particularly if we get stricter measures in place?
Well, I think a lockdown is economically for the retail sector nothing you can have a positive view on. The impact will vary significantly by subsector. And so food and grocery, for example, will not be as much affected. But for soft lines, it can really drive traffic in the cities down. And that will also then have an impact on their sales. The only thing you can mitigate this is by having a good online presence, because that's also clear from everything we do on research is that online is here to stay. And the better you are prepared to deliver your experience online, the better you are with these measures.
Thank you very much for joining us today. Thomas Harms with us, Global Retail Leader at EY. I'm going to just take you to an opening call we're getting on Biostock at this point. Seen up 4.2% on Lang & Schwartz in early hours. This after a Californian jury has found that Roundup, the weed killer that is made by Bayer, was not the cause of a woman's non-Hodgkin's lymphoma. And don't forget, this is a second trial victory for the chemicals giant over the herbicide. So what we've got has been a positive signal on markets. Let's push on and take a look at other corporates as Oracle jumped in extended trade after reporting its best quarterly top-line growth since 2018. The enterprise software maker beat estimates with revenue of $10.4 billion, boosted by increased customer spending amid the work-from-home push. Company forecasts for the current quarter also came in ahead of expectations. Over at Broadcom, we also saw earnings beat forecasts and the company issuing an upbeat outlook. The US chipmaker posted a quarterly profit of $7.81 per share amid the global ramp-up in 5G and cloud computing. The company also hiked its dividend and announced a $10 billion share buyback program.
The UK Prime Minister Boris Johnson is facing a potential major rebellion in Parliament over his decision to implement stricter COVID protocols. Several Conservative MPs have already said they will not vote for the proposals when they're debated in the House of Commons next week. The UK government's Plan B measures include mandatory face masks in most public indoor spaces and the introduction of COVID passports for large venues.
And warning, our next story is a little bit grim, but you may be wondering just how the insurers have fared over the last number of months. Well, death benefits paid by life insurers in the United States surged more than 15% last year amid the COVID pandemic. That was the biggest jump in more than 100 years. According to the American Council of Life Insurers, payouts hit $90 billion, but apparently it could have been worse. A lot of the death benefits paid were to some of the elderly in society, which meant the lifespan was lower on those particular insurance policies. So it could have been more if it had been younger people that had been caught up in this story. So interesting turn of events. Coming up on the show, master of its destiny, a powerful Europe. We'll get into President Emmanuel Macron's ambition for the continent ahead of France's EU presidency right after the break.
A news story has
back, everybody. US President Joe Biden has emphasized the US's unwavering commitment to Ukraine's sovereignty and territorial integrity in a call with his counterpart in Kiev, President Zelensky. The two spoke amid elevated tensions on Ukraine's border due to the Russian troop buildup there. The White House has warned it will respond with economic and other measures should Russian aggression continue. The new Chancellor, Olaf Scholz, heads to Paris later today to meet with French President Emmanuel Macron. That trip will be the German Chancellor's first in his new position, signaling a European focus for his government. Scholz and Macron have identified EU sovereignty as a key issue for their working lunch as pressures mount on the Ukrainian border, Karen.
France will take over the reins of the EU presidency in January. President Emmanuel Macron has insisted ambitions for a more powerful sovereign Europe will be at the heart of his country's tenure, as well as a focus on accelerating the continent's green transition. Let's get out to Charlotte for more. Charlotte suggests that Macron will be in a lot of meetings as he tries to plan for some of the objectives he's set out for Europe.
Yes, and it was, more than 2 hours of this wide-ranging speech and then questions from President Macron, typical Macron moment, presenting those priorities to the French EU presidency that starts in January for 6 months. And as you say, presenting how Europe can move from a Europe of cooperation to Europe being a power on the world stage. Take a listen.
If I had to sum up in one sentence the objective of this presidency, which will last from January the 1st to June the 30th, I would say that we must move from a Europe of cooperation with our borders to a powerful Europe in the world, fully sovereign, free of its choices, and master of its destiny. And that is the objective we must pursue. For the first time in almost half a century, we are facing existential questions on the climate, on the technological and geopolitical levels.
So among the many topics and proposals that mentioned yesterday by President Macron, he talked about a reform of the Schengen area to make it a more political process and creating a group and meetings more like the Eurogroup, having the ministers that work on those areas specifically to meet regularly to tackle this and work on protecting the outside borders of the EU and creating new emergency mechanisms to deal with situations like the one we saw at the border of Belarus and Poland. He talked about the regulation of online platform and their contents, talked about changing and reforming the budget rules in Europe. And of course, as you say, he's meeting with Olaf Scholz, the new German Chancellor, today in Paris. And he's expected to have a more sympathetic ear to potentially this kind of reform than with Angela Merkel previously, talking about strategic investment in some of the key areas and key industries for Europe to become a champion in areas like hydrogen, semiconductors, or the cloud, talk about relations with the neighbors, whether it was Africa, the Balkans, the European defense, all these kind of huge topics. So it was very ambitious for a European presidency, for rotating EU presidency, let alone for a man that might be out of the job and might have to go halfway through this presidency, because of course the French presidential election is in April. Remember, President Macron has not announced whether he's running again or not. Is the last name that is still a question mark. Of course, all expectations are that he will be running. You know that the EU and making a strong France within a strong EU has been at the heart of his first campaign. Of course, expected to be at the heart of his second campaign. Again, here, how would France and Europe's destiny work hand in hand? So if in any case, he will, this program shows that he's still working on his legacy of his mandate or mandates. We'll see in April what that means. But in any case, whether you agree or not with his vision, it's definitely an alternative to what we've heard from other candidates running in this election, some more gloom and doom, more populist kind of themes that we've heard from some of the front runners, according to polls, whether it's Eric Zemmour, this far-right ex-TV commentator, or Marine Le Pen, that are more skeptical towards the EU. This certainly offers an alternative, a very different position for France and Europe in the world, guys.
Charlotte, we know that Emmanuel Macron ran on the ticket of a bigger Europe, fixing some of the problems in Europe and ensuring a very strong unity with other members. What we've seen now, there's been just a stall speed in terms of progress in reforming Schengen. And Macron, having been passed the baton of the EU presidency, is it a gift? Do you think he can manage to get anything done that reinforces his chances of re-election around April?
Well, that's really the question. Some were really worried that this EU presidency would be pointless because nothing could be done, that Emmanuel Macron would be too busy working on his own campaign. But if anything, judging by yesterday's speech, this EU presidency will be just an extra platform for the president to defend some of the themes that really have been at the core of his previous campaign, and give him the opportunity to be seen as a strong man of Europe. Of course, Angela Merkel is gone now. Mario Draghi is still relatively recent as an EU leader on the scene. This EU president shows him that France is powerful, that this is thanks to him, that he's at the heart of things that matter. So that can be an extra platform. And also, during the campaign, remember that time is counted for the candidates to speak in media. You have the media watchdog that counts the time that people speak. This doesn't count for the president. Of course, being the president, being at the head of this EU presidency, rotating for 6 months, gives him an extra area where he can shine. And he's viewed as really the domain where he thinks he can really shine. That's always been at the heart of his mandate. So, and if anything, the speech yesterday shows that the EU will still very much remain at the heart of his campaign. Jeff.
Charlotte, thank you very much indeed for that. We're going to squeeze in a quick break. Jerome Powell may have retired the word transitory, but he said nothing about verganglich, the German word for transitory. German inflation data crossing the wire in just a moment. We'll have a look when we come back.
We put
Second hour Squawk Box, here are your headlines. US inflation is forecast to hit its highest level since the early 80s, with an expected 6.7% jump, raising fears the Fed will be pushed to act faster. Asian equities take a leg down after US markets snap a three-day winning streak, with technology stocks leading the losers.
Daimler Trucks sits on the starting blocks as it prepares to hit the open road and list in Frankfurt today. We will talk to Daimler Truck executives Martin Dohm and Ola Kalinas joining us later in the morning. We had some numbers on Chinese auto sales. They continue their recent slump, down over 9% in November, but new energy vehicle sales surging up 120% on the month.
We had the latest to read on the UK economy, just crossing data for October. UK October services output was 0.4% higher month on month. When it comes to GDP, that has crossed at 0.1% higher for the month. This is shy of a poll that was anticipating 0.4% improvement, so not quite hitting the numbers. In terms of the 3-month view, it is plus 0.9%, so just under the 1% that a poll had anticipated, in the range, but not quite hitting the target. Also on the services side, that 0.4% higher month underwhelms. That is shy of a 0.5% number anticipated in a poll. The UK Office for National Statistics says UK gross domestic product in October of 0.5% below its pre-coronavirus pandemic level. Also tallies up to 4.6% year over year. That is shy of a poll for 4.9%. So we're missing on a lot of these metrics this morning. Industrial output also a miss. It is negative, minus 0.6% on the month. The consensus was for a slight improvement of 0.1%. And if you think about that, barely positive was the low expectation. So a slipping negative is disappointing. In terms of what we've got on the overall year-on-year basis for industrial output, that is 1.4%. And that was also a miss versus the 2.2% expected. A quick line on what we're seeing on construction output, that is minus 1.8% month over month. A poll saw that as being slightly positive at 0.2%. So even construction, which is typically not impacted by a lot of COVID restrictions, that's been hit. And perhaps this is a nod to the supply chain issues that have been witnessed. Maybe they're slowing some activity down, and or perhaps just off a very high level. It just can't be sustained at this point. Manufacturing, that has come through flat on the month. A poll was showing us, actually I should say on the year, flat on the month is 0%. A poll was anticipating it would be flat on a yearly basis. Manufacturing output is 1.3%. A poll thought 2.2%, so a miss on that year-over-year number. And just to give you a line on services, I want to circle back to that again, because there have been some predictions that the latest guidelines by the government to navigate the Omicron variant could be negative for GDP. And we think about that typically through a services side. And where we've been over the course of the year, we've been up 5.4% over the year. So we have been growing, but the question is whether we get derailed to an extent with these latest restrictions, with the unvaccinated in particular needing COVID passes to go to some of those big venues or ones that are highly populated, Jeff.
Yeah, and they've told us, haven't they? Christmas parties should be off. No Christmas parties, which will be a blow to some who are
Did we have one? Were we planning it? Were we planning one? I must have missed that email about the office one.
No, I think ours have been killed. Ours are like the dodo. They've been extinct for some time, Karen, I think. But I'm sure generous management will be sending bottles of bubbly round to every desk later on in the morning. It does seem that the UK policy making at the moment does seem a little bit haphazard, if I can use that terminology. But obviously, it'll all come out in the wash next week when we see parliamentarians debate whether Plan B actually is the right plan at this stage. I wanted to move on to some of the data we had out of Germany just a few minutes ago. It's the November final CPI. So we've already had early doors prints on the preliminary. I have to tell you, no dramas in a sense that these just confirm the preliminary final CPI, the preliminary CPI call for November at plus 5.2% year on year. So that number confirmed in the final data, and the final CPI for the month-on-month number, negative 0.2%. But it is that 5.2%, I think, that will continue to grab headlines as we look forward to the US inflation data today, which we know I think the markets are getting a little edgy about in terms of what it means for tapering. So the number will come through at 14:30 Central European time. The figure penciled in by the economists at the moment, 6.7% on the year. There are some outliers, though, who think we may even get to 7%. But if we go to 6.7%, that would mark a 40-year high on this inflation series, going back to 1982. Only 2 years before that, of course, Fed Governor Paul Volcker had lifted interest rates to historic highs of over 20% in a bid to cool inflation, but inevitably exacerbating recessionary conditions. We've also had very big jobless claims numbers, a 52-year low in the week ending December 4th, coming in at 184,000, which was well below most expectations. However, continuing claims were surprisingly high at 1.99 million, nearly 90,000 above the Reuters forecast. Christian Nolting joins us, the CIO of Deutsche Bank. Christian, good morning to you. How important is this inflation print today, and how should investors be thinking about what to do next, depending on whether it is that 40-year peak?
Yeah, I think inflation is the main topic, and probably very, very important topic for 2022. We call it the rhino in the room. I think the German numbers, just as forecast, I think is somehow good news that we don't see a massively overshooting inflation. But as you rightly said, the absolute number is very high, so we shouldn't forget about this. And we don't think inflation is going back to levels we have seen before. So we will see higher inflation numbers slightly coming down because of base effects, but wages are there. Localization, so glocalization, as we call it, less globalization is certainly there to bring inflation higher, supply chain issues. And the same is on the US, so very important print today, I would say.
Yeah, but how do you react to it? Because we've had this curious situation where if you look at the shape of the yield curve, it's been flattening globally, and we've seen yields falling globally rather than rising, which doesn't make sense if you believe that this inflation is going to be stickier and it's going to force central banks to lift prime rates and ultimately reshape the curve.
Yeah, that's right. I think the market was also looking at Omicron issues, which could certainly bring down growth if there are further measures necessary. And it looks like that's the case. In some countries, we see that already. There's a lot of debate in other countries as well. I think that was the short-term play we saw on the yield side. Nevertheless, we do expect yields to rise next year. And from that perspective, how do you play that? Short duration, as many investors have, I think is very, very important. But we will also reduce our exposure in government bonds, have done this already. So really take out money out of fixed income, moving to equities, probably do a hedge in place as well, not to change the risk profile completely because you need some diversification in the portfolio. And also look at the alternative side, which plays a very, very important game.
Christian, it's Karen jumping in. As we stare out into 2022, one of your calls is Asia, the eye of the tiger. I started out my morning looking at various different forecasts for China, and they all just look challenging, tricky, how to play it around some of the government regulation, what Xi is trying to set up in terms of industries of the future. And the best call I saw was really from SocGen, that was most optimistic, saying China has potential upside in Asia. Do you agree? Do you think the China market is worth revisiting at this point?
I would say not at this point in time. I think we probably see another 3 to 4 really tough months from my point of view. But if you look for the whole 2022, I think there's an opportunity building in China because you see that there are measures taking place. They're shaking the market because regulation is taking place, which is obviously necessary from my point of view. Otherwise, you run into asset class bubbles. But you see, for example, in the high yield space, that massive increase in spreads. I think that's rather an opportunity for 2022. Not now, but I think down the road, certainly yes.
But to the point around having to pick particular winners in the Chinese market now, you can't just pick a theme. For instance, the consumption play was very easy for a lot of fund managers in recent years. Now it feels as though we have to go down the pathway of President Xi's winners, which stocks, which companies, which sectors are going to be particularly encouraged by the Communist Party. Doesn't that make it incredibly challenging to get into the mindset of what the policymakers are thinking in Beijing?
Yeah, I think it's challenging, but I think the theme is very important, what they say on common prosperity, really to make the middle class and the lower middle class rise. And I think there you could see also that companies would be supported and that companies, from my point of view, would be rather the winners. So the mid to smaller size companies there, which can profit from this common prosperity theme. And I think there is an opportunity indeed.
Christian, as you look at the equity markets then at the moment, sector-wise, just give us some sense of where you think the gains will be felt in the first half of 2022.
Yeah, as I said, inflation is a dominant theme, and we think yields are moving up from our point of view, and that's why you look at the financials, as they have a very high correlation to the yields. Obviously, we've seen this in recent weeks, upside and downside, but I think there is opportunity. I would also say in 2022, in the consumer area, the consumer coming back, let's see what happens with Omicron, but I think that's an area where we certainly look into on the consumer discretionary side as well. And then on the industrials as well. So that's the areas we certainly look at. Energy, I would say, has been very interesting this year. It's probably not that interesting in 2022.
Christian, also what gets interesting in Europe is politics, and we haven't spoken really about some of the concern in the market around politics in Europe for a while. It sort of faded off the agenda, but we've got the Italian presidency, the French elections that we're just talking about, and of course how this German coalition continues, whether it stays as functioning as it has been just in its infancy. What do you make of the headline political risk in 2022?
Now, first of all, I say German coalition is now in place 2 days, so that's really in infancy, but it looks at this point in time quite stable. And I think there's quite a high approval of the German people for that coalition contract, I have to say, if I look at polls. So from that perspective, I would call it stable. Then France takes over EU presidency. I think that's important. And as you rightly said, that goes with the French election. So that will be interesting to watch who is really winning that one. We will know more in April from that perspective. I think for the EU is very important, the German-French coalition, if you want. And that's stressed also these days, if you see where German politicians go first. So Foreign Minister was there yesterday. Scholz, if I'm not wrong, will be in France today. So I think that's really important. And that's why, yes, French elections are very important, but I don't expect a massive derail there, to be very honest, at this point in time. But it can always change close to the election. So certainly very important to watch.
Yeah, and Christian, just picking up from that point, we've seen some slowing down in the manufacturing order book in Germany, and I guess mostly that's about the investments that the German government, the new German government, may be about to greenlight to galvanize the improvements in the telecommunications industry, the bridges and the roads and so on and so forth. Who is going to benefit in Germany at a corporate level? Is there a mini theme that we can develop here where we look at domestic German businesses that deserve to be re-rated on federal government spending?
So I think that there's a lot of focus, as you have heard, on ESG, on really climate change, and I think their companies certainly can profit from. The other aspect I want to mention is there's a whole new ministry on digitalization. So and that's together with the traffic. So that's there's a lot of focus on this one. And I think that's the two areas where actually there needs to be a lot of rebuild done or build at all, because Germany is clearly not leading there. And I think that's an interesting focus from that perspective as well in Germany, but also probably in Europe, because it's not only Germany.
Thank you very much for joining us today. Best of luck with the forecasts, and Merry Christmas to you.
Thank you.
Christian Nolting, CIO.
Thank you, same to you.
Thank you so much, Christian. And let's take a look at what's coming up on the show. On these starting blocks, one of Germany's biggest auto groups prepares to spin off a key unit in a big test for investor demand in the sector. We'll be right back. morning, shares surged on the first day of trading, giving the Brazilian digital lender a valuation of nearly $52 billion. The company, which is backed by billionaire investor Warren Buffett, priced shares at $9 apiece and quickly became the country's third most valuable public firm. And HashiCorp shares. I got to the bottom of the name of this HashiCorp and the origin of it. The co-founder is Mitchell Hashimoto. That's where it comes from, as simple as that. The company's shares also moved higher in their NASDAQ debut, valuing the cloud software provider at nearly $16 billion. The company, which also provides open source cloud software to brands such as Starbucks and Mercedes-Benz, priced shares at $80 each, raising $1.2 billion. And a Daimler Truck, which today will make its debut in Frankfurt as the commercial truck unit is to spin off from its parent company. The truck maker is investing heavily in electric vehicles with the aim of having 60% of its sales made up of EVs by 2030. And Jeff, one of the big themes we're seeing in this energy transition, whether it's the autos, whether it's the big oil companies, is the sum of the parts recognition. You know, big conglomerates that were sort of effectively cobbled together and had a massive footprint in various sectors. That's just coming apart a little bit. It feels like we are seeing this recognition that perhaps separation is a good idea at this stage. And we've all seen it over the years, these corporate trends, they come and go, and you've got to wonder whether down the track we look at a different trend and there's more consolidation again. Jeff.
Yeah, there's just setting aside Daimler for a moment in terms of the industry and the points that we could make about EV and hybrid and so on and so forth. I think it's fascinating that what they've decided to do here is ultimately a spin-off and then a hive-down listing into the German market. Because initially this was being talked about as an initial public offering to the general public, which would see the companies list in Frankfurt, and then obviously everybody would be able to participate. But this is a slightly different approach to get the shares into the market. And if you go and have a look at Daimler's own website, they explain very clearly that this is about avoiding some of the volatility and the risks associated with that volatility when it comes to getting their shares onto the market. And I think it's fascinating that here we are discussing market sentiment, and here is a company that's chosen a slightly different way to get its shares onto the exchange to avoid some of the nascent volatility that we've seen here. And it is very clear that the IPO route is not the haven it was 12 to 18 months ago. And if you look at a list of IPOs that we've seen, say in the United States, which has been prolific over the last 18 months for bringing new companies to the market, quite a lot of those companies are actually underwater on their IPO price, and particularly if they used a SPAC vehicle to do it. So I think it's fascinating that in the staid old capital markets of Europe, that Daimler Trucks has chosen a method which helps it avoid some of that volatility and risk that we have seen around new capital market issuance.
Jeff, good points. And speaking of volatility, we are setting up for a rocky day in Daimler stock. Early calls that it could fall 17%, which is a fairly significant signal that we're seeing. Let's get out to Annetta for more. Annetta, I'll just get you to comment too on that share price action we're seeing in the early hours. But one of the other points too is just picking through some of the detail around the performance we're expecting to see in the trucks division. And one of the areas that, again, looks like will be the strongest is financial services, where the returns that they're forecasting will be higher than pretty much anything else in the business at 14%.
Yeah, well, that's what we have seen with other car makers as well, that the financial services business is actually having the highest margin of the business overall. But let me refocus on Daimler, and the share price reaction is quite expected because obviously with the spin-off, you take away a substantial part of their revenues as well. What we are expecting is a market pricing between 25 and 45 billion euros. So it's still quite opaque what the price range of those shares might be. From the rationale of the deal, is very much applauded by analysts. Analysts have been calling for such a move for quite some time because from a business sense, it doesn't really make sense to do trucks and cars because it's a completely different market. And now going forward will also be more or less completely different technologies. Whereas you do electrify cars, you don't just electrify trucks. What you use uses a hydrogen technology for the long haul, at least. The short haul, you can operate them with electric batteries, but the long haul, like the normal lorries and trucks which you're seeing on the roads, they need to have a different technology, and it completely makes sense to split them off from your normal business, and that's why Daimler is as well doing it. They hope, of course, to reach a higher market capitalization through the delisting of the truck business, and then they can use their balance sheet much better, can concentrate on R&D much better, and can refocus on their markets. What analysts have been telling me, which is quite interesting as well, is that most likely this means that Daimler Truck will become much more efficient than being together with Daimler, because they can't just hide behind the big Mercedes brand. They just need to be much more efficient, much more profitable. And that's what the CEO, Martin Daum, is also now promising for next year, to really make Daimler Truck more profitable in terms of margin developments. Because if you look at the margins and you compare them to the other big competitors like Scania and also Volvo Trucks, they are lacking behind quite a bit, but they're not lacking behind when it comes to the volumes. They have a huge order book, and they are one of the biggest truck makers of the world. What they need is to get more efficient, and that's what they are now promising. Of course, also promising ahead of that listing today. So what happens in terms of share allocation is if you're owning Daimler shares, you get 2 for 1 Daimler shares. You get Daimler Truck shares for that, and 35% of Daimler Truck will sit with Daimler, and they will keep that. With that, back to you.
Yeah, no, it's fascinating, Annetta. Thank you very much for explaining exactly how this deal works and how the company intends to realize value. And I think the very interesting story we've got at the moment, which is what Per Lekander talked about yesterday, is whether you go with the new entrants into the market, the sort of Amazon-backed truck company, or whether you go with the OEMs who are gradually turning themselves into EV businesses to take on the likes of Tesla and its fleet and its aspirations as well in this space. We're going to hear from the CEO of Daimler Truck today, 9:10 CET. Ola Kalinas will be with us. The CEO of Daimler and Mercedes-Benz will join Street Signs at 10 Central European time. I ought to tell you about Sense Time as well while we have you. The Chinese startup is reportedly now reevaluating its planned listing after reports that the US will put the company on an investment blacklist. The AI group had planned to set the final price for its much anticipated Hong Kong debut today. Sam has more on the story.
The US is reportedly putting SenseTime, the Chinese AI company, on an investment blacklist today over alleged human rights abuses against Uyghur Muslims in Xinjiang. The move, reported by the FT, coming on the very same day the company planned to price its Hong Kong IPO. We have since seen Reuters reporting SenseTime is in talks about the fate of that listing with the city's stock exchange. Shares are due to start trading on December the 17th. Now, according to the FT, US Treasury will reportedly put SenseTime on a list of so-called Chinese military industrial complex companies, meaning US investors won't be able to buy into the IPO after Biden signed an executive order banning Americans from being able to trade in companies that have found themselves on this list over their alleged ties to the Chinese military on national security grounds. SenseTime is one of the leaders in facial recognition technology, which is widely used in China, but has raised concern in the US as to how it's being used. The move is reportedly part of a wider measure against countries to mark Human Rights Day. The IPO is expected to raise up to $767 million, which SenseTime says it plans to pour into R&D of its AI technology. But of course, it's not the first time it's been targeted. The company was already put on a trade blacklist in 2019, which banned it from buying products from the US without government approval. In Singapore, I'm Sam Vardas. Back to you.
Just coming back to the Daimler Truck story and keeping our audience on their toes this morning and making sure you have the volume turned up. I mentioned that the stock is set to fall, according to Lang & Schwartz, 17.8%. I think our strap there on the bottom of the screen is set up, but it's down is the direction, just to make that clear, and hopefully you do have the volume up. But since then, we've also had an update suggesting that we could see a 16.4% fall. So some of those positions even being trimmed before the start of this IPO later on this morning. Now, coming up on the show, it all change at Shell, where the company's general meeting kicks off in just a few hours.
A very good morning, everybody. Welcome back to Squawk Box. In your headlines, European markets are set to open lower this hour as German inflation jumps more than 5% in November on the year, while US CPI is expected to hit levels not seen since the early 1980s. China's auto sales continue their recent slump, down over 9% in November, but new energy vehicles are still surging, up 120% on the month. Daimler is sharply lower in pre-market as it prepares to spin off its truck division in Frankfurt today. Executives Martin Dome and Ola Kalanas join us this morning. And buyer shares are higher in early trade after the company wins a second trial victory against claims its Roundup weed killer causes cancer.
to revisit the Asian markets today in the Friday trade. Don't forget, we've got a cautious all day playing out as many of the markets waited up for the big inflation print stateside later on today. So it's a tricky act going into the weekend for some of these markets. And you can see it as risk off. Japanese stocks are trading weaker by 1%. We've got a patch of green around the tech-heavy Shenzhen composite, but Shanghai's reversing. Hong Kong trades down as well. So more information is what these markets are waiting out for. It's been a very strong trading pattern in Europe too. Yesterday we did peel off a little bit, but on the back of what have been incredible gains, the French market's been up 3.6% so far of the week, 3% on the DAX in Germany, and about 2.8% on the FTSE. So you can see we are looking to give back some of that territory this morning. So a modest fall is what we're anticipating from the start today, Jeff.
Thanks very much indeed, Karen. Let's catch up on some of those corporate stories. Bayer has won a second consecutive verdict over its top-selling Roundup weed killer. A jury in California rejected a mother's claim that the chemical giant's product had caused her cancer. Roundup-related lawsuits have dogged the company for years, costing it billions of dollars in settlements. UniCredit shares hitting a new 22-month high after the Italian lender's chief executive, Andrea Orcel, unveiled a new 3-year strategy aimed at expanding share buybacks and dividends. He also said the company is in a position to evaluate new potential mergers and acquisitions. 2 months ago, UniCredit pulled out of a deal with the government to privatize rival Monte dei Paschi di Siena. Royal Dutch Shell is meeting with shareholders today to vote on a string of new simplified corporate proposals. Shell is vying to ditch its dual-class share structure and move its headquarters and tax residency to the UK. The company says the move to scrap its dual-class share structure would allow it to return more cash to shareholders, including through share buybacks. Shell will still continue to trade in Amsterdam, London, and New York. Let's bring in Christopher Coupland, head of the European Energy Equity Research Group at Bank of America. Christopher, good to have you on the program this morning. I think we were looking at the share price of Shell earlier, and obviously it's had a decent uplift year to date, but it seems to have gone sideways largely since this announcement was made about focusing the tax domicile in the UK. Do you think there's any relationship between the share price movement and this announcement?
I don't think so. Good morning, everyone. I don't think that's the case. I do expect this announcement to find relatively broad support today at the general meeting. And I think that's borne out by feedback talking to investors around the world. I think this is a step in the right direction for the management to take to simplify what is a vast conglomerate. And I would expect this to enable them to increase flexibility around future steps. So I don't think this is the last step we'll be talking about.
Yeah, it's interesting. I was just looking back on some of the taxation data, and Shell paid $340 million in taxes and royalties in the Netherlands in 2019. Clearly, you can understand why legislators in the Netherlands are angry about this move. But just by bringing the dual structure to an end and focusing the domicile in the UK, will that actually significantly reduce the tax burden?
I don't think that's the main motivation behind this move. Quite frankly, as you know, this is something we've been waiting for more than 15 years, ever since the original unification agreement was signed in 2005. And I don't think that taxation, certainly from my expectation in terms of cash flow outlook for next year, is the main reason for this step. In fact, what I expect to see is an acceleration of cash being able to return back to shareholders. That, I think, has become rather cumbersome under this dual listing structure, and I would expect that to move forward into 2022. In fact, you're seeing some acceleration today as we speak. The company is probably run rating per quarter at about $2.5 billion buybacks at this point in time, and collapsing those dual shares should allow that rate to roughly double in theory. So I think that's another very important message why and reason why shareholders are looking forward and, in my view, will broadly support this step.
Christopher, also cited has been this ruling, a directive from the Dutch courts, that the company reduce its carbon emissions by 45% by 2030. To what extent do you think that was also a motivating factor for the company?
Yeah, I think it makes a great headline, but I don't think it's actually the motivation behind this at all. In my view, net zero, the company's decarbonization strategy, is not limited to one jurisdiction. That happens to be the jurisdiction where its tax residence has so far been based. I believe decarbonization will continue, and in fact, most recently, Shell made an announcement to target by 2030 a Scope 1 and 2 emission reduction emission reduction of about 50%. So I don't think that that drive will change because of the move of where you are headquartered from a tax perspective. And frankly, we have argued for some time here that this court ruling is unlikely to be a unique situation. I believe the entire integrated oil industry will continue to remain under pressure, not just in the Netherlands. In my view, there is nothing special about the jurisdiction used there in order to arrive at the court ruling that the Hague District Court did earlier this year. So I think that that question remains alive and well, whether your tax is headquartered in the UK or elsewhere. And in fact, that question remains alive and well for many other oil companies around the world.
Christopher, I know you spent a lot of time working out the future of these companies, and you call it navigating big oil's redemption roadmap into 2022. I wonder when we see a move like this, whether this is going to be the first of many moves by big oil across the world, whether they do move to jurisdictions that enable them to have more flexibility, some perhaps that are friendlier when it comes to carbon emissions and the transition. Do you think we are going to see lots of moving pieces around headquarters in coming years?
I don't think so. It's certainly not part of our what we call redemption roadmap. I think that move is quite particular because of Shell's dual listing structure. We've seen some similar situations in other industries, to mention Unilever or BHP. But I don't think this is necessarily going to lead us to a wave of big oil companies changing their headquarters. I think that is a pretty unique, so to speak, Royal Dutch situation, as long as we can still use that name. So I believe much more important for the entire industry, and partly behind this move is what I mentioned earlier, that need for the sector to accelerate cash returns coming back to shareholders. That is underway, but in my view, it can happen a lot faster. And that's step number one, and probably the easiest step on this industry's redemption roadmap. There are others that will need to follow, and that won't be that straightforward. And one of them, thinking about more creative ways of structuring your corporate activities, whether it's through listing subsidiaries independently, whether it's through equity combinations with new partners, that is also certainly going to become easier on paper for a company that only has one line of shares.
Christopher, I think it's a terrific note, this Roadmap 2020, and it very clearly explains some of the challenges around expanding CapEx, even as balance sheets are pretty much healed and repaired at this point. What I'm very interested in is how the oil services sector has failed to keep pace with the performance we've seen in the upstream integrated oil companies. Does that difference in performance continue because of that reluctance to break the CapEx discipline that we've seen?
Yeah, I think it's going to be quite tricky, actually. So I would hesitate to suggest there is going to be a fast narrowing of that gap. And one reason why the redemption roadmap is underway is that remarkable restraint of the E&P industry in terms of allocating more capital towards more activity and suggesting to shareholders that what they really want is growth. We don't think that's the case. What shareholders want is consistency and managing a financial framework through the cycle. And whether we like it or not, most investors still tend to treat this current oil and gas price environment as a bit of a peak. It might be extended for a few more quarters, but certainly that peak is partly owed to the capital discipline of the industry, which we can observe not just in big oil companies such as Shell, but also amongst smaller E&P players, whether they are listed or indeed whether they are operating under an OPEC government rule. So in our view, there are only a very few and select pockets amongst the oil services industry that are going to benefit from increased pricing power and a somewhat tightening of supply and demand. We've highlighted for some time tubular goods as one of those niches where you've already seen prices move up remarkably this year. We're looking at, for example, in the US, an almost doubling of pricing. That, I don't think, however, is an indication of what you should expect across the entire oil services framework.
What was interesting, I think, at Houston, at the recent oil Congress there, you had all of these CEOs who felt very comfortable, I think, in the surroundings that they were in, talking rather hubristically about how the renewables industry really isn't the near-term threat that many would like to describe it as, and that the oil businesses are going to be around for a whole lot longer than I think though many of those attending COP26 would like to believe. These comments were made in the comfort of an oil event, obviously, but do you think that is a narrative that actually is quite accurate, that we do need to reset expectations about how quickly the renewables companies and the energy supply from renewable technologies is going to displace oil and gas?
I think there is a lot to it. Yes, you're right. And, we have to differentiate a little bit about who is speaking and what they're saying and what they're doing. Here in Europe, Shell is one example. You see CapEx from the oil and gas industry moving into low carbon and renewables already to the tune of 20-30% of what the industry is spending. Could that be more? Yes. But why can't it accelerate any faster? Because projects are very hard to get off the ground faster. This is an industry with an incredible growth track record. We have, through COVID, installed more renewables per year than we've ever done before. And yet, I actually believe capital is not the bottleneck here. We need to unlock that project pipeline around the world. And, I'm based here in London. We've got the world's largest offshore wind fleet operating here in the UK today. And yet it still takes you from announcement to completion of the next project more than 5 years. So yes, I think that theme and that warning, if you like, is a fair thought, particularly in a world where we've seen not just oil prices, but a lot more extremely gas prices remind us of that fact. And that is nothing to do with someone withholding spare capacity, such as you could argue OPEC is still successfully doing in the global oil market. Gas prices have recovered very fast, largely because of demand recovering incredibly fast, much faster than we expected in places like China. And that's happening while demand for coal has increased there too.
We appreciate the comments, Christopher.
It's an increasingly complex backdrop, and some of those conversations, I think, will continue well beyond the end of oil.
Christopher, thank you so much for joining us today. We appreciate the remarks. Christopher Coupland with us, head of the European Energy Equity Research at Bank of America. You may have seen we are taking some live shots out of Germany today. This is around the Daimler Truck listing later on this morning. And you can see currently Theodor Weimer, who is the Deutsche Börse CEO, giving some remarks. We may just listen in to see what he's saying about this.
Than I've ever thought of. You're more than a truck builder. It gives you the responsibility for the most fundamental pillars of our world. Your purpose statement says it best. And I'm citing, for all who keep the world moving. What a wonderful purpose. As such, many companies feel very much related to you. We provide the infrastructure and the systems for secure capital markets. It's a very basic and humble undertaking, but trust me, without functioning capital markets, none of all the people here in this room would be driving the fancy cars they have come here in with today. Your decision to spin off Daimler Truck today from the mother brand pays testament to the significance of your company for the global commercial vehicle market and the necessity to change the lane for further growth and profitability. It's an emancipation from a parent company, which is quite literally a shining star among the global brands, standing like no other for German engineering and sparking desire and passion. There, the parent's journey is no longer yours, Martin.
Theodore Weimer there talking about the Daimler Truck listing today. We are closely watching these developments and all the major executives there. One of the big issues will be the Daimler stock price today. It is called weaker. And just to update you about the process around this listing today, there's no range, no pricing range, no offer price, but we will get a 9 a.m. CET crossing of a price. So we're watching out for that today. And of course, these developments, but plenty of nice references to the relevance of trucking in the scheme of things. And don't forget, we've been talking about global supply chain shortages for many, many months during this pandemic and how trucks sort of fit into the equation. Very big news here. So we are covering this story very closely. We are going to be hearing from the CEOs of the businesses. Daimler Truck today, 9:10 CET. Ole Schelenius, who is the CEO at Daimler, and Mercedes-Benz will be joining Street Signs at 10 CET. And of course, Martin Daum as well will be up first up at 9:10. Still to come, UK GDP disappoints, but the Chancellor insists things are on track. We'll have more right after the break. And coming up, master of its destiny, a powerful Europe. We'll get into President Emmanuel Macron's ambition for the continent ahead of France's EU presidency. That's after the
break. Right now on
back, everybody. Let's have a look at some data that we've had out this morning. The UK economy grew by a weaker than expected 0.1% in October. That was weaker than a pre-pandemic reading of 0.5% for February of 2020. UK Chancellor Rishi Sunak says the economy is well placed, but that there could be bumps in the road. The weaker numbers come as the Bank of England ponders whether to hike rates at its meeting next week. German inflation rose at its fastest pace in almost 30 years in November, posting a harmonized increase of 6% year on year. Energy prices were up more than 22% year on year, reflecting a wider trend across Europe. Karen.
US President Joe Biden emphasized the US's unwavering commitment to Ukraine's sovereignty and territorial integrity in a call with his counterpart in Kiev, President Zelensky. The two spoke amid elevated tensions on Ukraine's border due to a Russian troop buildup. The White House has warned it will respond with economic and other measures should Russian aggression continue. New German Chancellor Olaf Scholz arrives in Paris later today to meet with French President Emmanuel Macron. The trip will be Scholz's first in his new role, signalling a European focus for his government. Scholz and Macron have identified EU sovereignty as a key issue for their working lunch as pressure mounts on the Ukrainian border. And France will take over the reins of the EU presidency in January. President Emmanuel Macron has insisted ambitions for a more powerful, sovereign Europe will be at the heart of his country's tenure, as well as a focus on accelerating the continent's green transition. Let's get out to Charlotte for more. Charlotte, it feels like a gift for Macron, who's wanted a bigger Europe and more say on a global stage, just as he counts down to the election, even though we're still waiting for him to officially declare his candidacy.
That's right, Karen. And some were expecting maybe that this French EU presidency that starts in January for 6 months would be a bit of wasted time, that this would be paralyzed and won't be useful time because the President Macron would be just focused on his electoral campaign. But judging by the speech yesterday, it looks like things would be very different. He spoke for more than 2 hours between his speech and the questions being taken from a wide-ranging speech, really a typical Macron type of exercise, where he explained that he wants to move on Europe for a Europe of cooperation to Europe being a key player on the world stage and being a sovereign power. Take a listen.
S'il fallait résumer en une phrase,
if I had to sum up in one sentence the objective of this presidency, which will last from January the 1st to June the 30th, I would say that we must move from a Europe of cooperation with our borders to a powerful Europe in the world, fully sovereign, free of its choices, and master of its destiny. And that is the objective we must pursue. For the first time in almost half a century, we are facing existential questions on the climate, on the technological and geopolitical levels.
So among the many topics and proposals mentioned by President Macron yesterday, he talked about a reform of the Schengen area and creating some political processes to deal with the issues in the Schengen area, like some of that we've seen with the Eurogroup, so how the ministers of the different countries get together regularly to discuss some of the key issues, and also some emergency systems to deal with the external borders of the EU and tackle issues like the ones we've seen at the border of Belarus and Poland recently. He talks also about reforming budget rules, and of course he's hosting Olaf Scholz, the new German Chancellor, today. So you might get a more sympathetic ear, of course, from this new team in place in Berlin that he had with Angela Merkel on that topic. And of course, the Franco-German axis being incredibly important for any of this potential agenda to go through within the EU and all these reforms. He also mentioned about regulating content of online platforms, creating some investment strategy to secure some European champions, some key industries, just like the cloud, semiconductors and hydrogen, for example. Talked about relations with neighboring countries, whether it was Africa or the Balkans. Talked about European defense. It was a huge amount of topics that the president presented yesterday. So It was a very ambitious list of program by President Macron, let alone for a man that might be out of the job in just a few months. So it'd be very interesting to see how this tackled.
Charlotte, thank you very much for that. We are taking some live shots now ahead of the Daimler Truck listing, and we are hearing from Martin Baum at this stage, the CEO. Stay tuned. We'll bring you some of the pricing action.
A news story has
European stock markets are open for the Friday trade. Already signals have been weaker as we've been counting down to this open. It has been an incredibly strong trading pattern. So a little bit of fatigue coming into the markets, but it also sets the scene. You're seeing some live shots coming through from Frankfurt ahead of the Daimler Truck listing. Do you want to be coming to market with an offering, a realignment of the business on a slightly downbeat day? And it's all about inflation stateside today. That's why we've got caution in these markets. Investors have had an incredible run on a recovery trade around the Omicron variant this week. But as we get set up for the Friday trade stateside, it is all about this red hot inflation number, 6.7, 6.8%, depending on which source you're looking at. The market thinks that this will be pivotal for monetary policy. So we're closely eyeing that, as well as the developments at a corporate level coming through from Germany today. But a quick look at the stock strip 600, 410s down the early push. It's been such a strong week. This market has been up more than 3% before the open. So we're giving back a little bit of that territory. Let's switch over and take a look at some of the sectors and see what's on the move today. What you're seeing out of Frankfurt, very instrumental for the auto basket, because one of the biggest stocks, of course, has been Daimler. We've been seeing early signals that there'll be a big retreat to factor in this realignment of the business.